Good morning and happy Monday to you. This is NDTV Profit. You're watching All You Need to Know, and my name is Alex Matthew. Let's get you the top stories this morning. Let's start with the headlines. US futures trade flat after benchmarks end last week on declines. That's on mixed jobs data. All eyes are now on the US CPI data that will be out on Tuesday. Asian markets follow suit. All benchmarks open in the red. Japan's Nikkei 225 plunges over 2% after the country averts a technical recession. The government asks banks to clean up gold loan books, notes malpractices at some banks and some branches. That's an NDTV Profit exclusive. Media reports suggest that Tata Suns may be looking for alternative ways to avoid a forced listing. And India signs a trade agreement with 4 European nations and expects inflows of as much as $100 billion. Let's get you a quick global check now. US futures are trading flat as we speak, but Wall Street saw cuts at the end of last week. The tech-heavy Nasdaq losing the most ground, but more dramatic shifts were visible in the bond market as well as in the currency markets. Bond yields have fallen even more, with the 10-year Treasury now seeing at just about 4.06%. And you also had the dollar index, which dropped below $103, and that's quite significant. That's after job market showed signs of cooling based on data released on Friday. Non-farm payrolls increased by 275,000 for the month, while the jobless rate moved higher to 3.9%. That job data was actually better than expected, but more importantly, the job growth in both January as well as December were revised sharply lower, bringing the 2-month total lower by as much as 167,000. The early rises in the Asia-Pacific region have started weaker. The Nikkei 225 was lower by over 2%. It continues to be the case, and that's after data this morning showed that Japan avoided a recession, and that has implications obviously for the Bank of Japan's easy monetary policy. That central bank meets in about a week or so. Now let's turn to the latest cues from the F&O space here in India. We're starting a new week. Let's see where we're headed. Samina is joining in to give you some perspective on that. Morning, Samina.
Good morning, Alex. It seems like we've had a good end to last week, right? Yeah. The markets closed at record highs on the 7th of March before the long weekend, and that is a positive cue as we go into a brand new week of trade. I mean, if you look at the kind of chart play out, the F&O activity, very obviously the markets could be making an attempt to 22,400, 22,600 if it turns out to be a good week for trade. But it'll be a northward journey focused on in terms of movement towards the upward move. That's the Nifty 50 spot. Trades at close at a premium of 44 points on the Nifty 50. Open interest has seen a decline of 6.5% in terms of the Nifty 50. Bank Nifty as well was a little shaky in terms of Friday's trade. Remember, it's ended a 2-month sort of gain and took a bit of a breather in terms of trade. You saw a Nifty Bank ending slightly lower, but you've seen an increase in premium on Bank Nifty to trade at levels of 64 points higher. And the open interest has also seen a decline of 10% on Bank Nifty. So while Bank Nifty is going to be a little bit of a tough spot into this week's trade, the Nifty 50 itself could see some activity on the long side. Well, let's take a look at the call and put action and take you through all the stocks that are going to be fairly active in today's day of trade. That's pretty much what the picture looks like. Maximum call open interest was added at levels of 22,500. This was followed by 23,000, as you can see, and 22,800. That clearly indicating that that's going to be the trading range. You are gunning for 23,000 on the upside. 22,500 becomes an important level of support, or rather the market attempt in the first couple of days of trade. Well, on the put side, you saw maximum open interest addition at levels of 22,500, 22,400, followed by 22,300. So not too much left to guessing in that sense. It's going to be a tight trading range, 22,600 to 22,800. On the upside, side. And the best case scenario, 23,000 is what you're seeing. Quite a bit of open interest addition, which indicates that that's the range that the markets will be focusing on. So that's the calls and put distribution on the screen. Lots and lots of stocks that will be in action. Couple of counters have seen long unwinding. Stocks like GM will be in focus, but remember they are in an F&O ban, so don't expect fireworks on those counters despite a very heavy news flow on those. Stocks like Apollo Tyres have seen an increase in OI by 20%, followed by Tata Chem, SAIL, Tata Power and M&M. Tata Chem, of course, we've seen activity picking up here on expectations of an IPO by Tata Suns. The stock was up 12%, gained 40% in the last 5 to 6 days. Will be counter to watch out for. You've seen activity in terms of open interest, but what's most important to track is it trades very close to resistance levels, and unfortunately for them, there are reports now that Tata Sons may not go with an IPO that may limit the value unlocking. But all in all, Alex, it looks like we're setting ourselves up for a good morning. The trading range is 22,600 to 22,800. Of course, the most bullish scenario for the week is 23,000, which looks far-fetched, but nevertheless.
You never know. Thanks so much, Samina, for getting us those details. Let's get you more action for the financial space, which, as you know, has been absolutely buzzing on the back of regulatory action. This time, it's an update from the Finance Ministry. It has now aimed its guns at public sector banks this week. Sources have told NDTV Profit that the government is seeking a review of their gold loan books. We've got Vishwanath Nair, who's picked up this exclusive information. Vishy, what does this mean? What was the reason for the Finance Minister's, or rather the Finance Ministry's interest in these books?
Right, good morning, Alex. So the Department of Financial Services has actually written to public sector banks asking them to review their gold loan portfolios. This, of course, follows what the RBI did at IIFL Finance, where it said that IIFL Finance cannot extend further gold loans because the RBI found material lapses in the way that they were conducting their business. Now, what are the lapses that the Finance Ministry has found with the public sector banks? Well, essentially, what the Finance Ministry is saying is that in certain bank branches of at least 2 large public sector banks, there were issues with the quality of the collateral that they were collecting against those gold loans. So 18-carat gold jewelry was being recorded as 22-carat gold jewelry. In certain cases, just to fix that month-end number on the loans extended, gold loans were being extended without any collateral at hand, and that became a big issue because this was just boosting that month-end number, which would then be reversed in the following month. This was being done by certain branches to meet their monthly targets. That's what sources are telling us, and this the Finance Ministry found was questionable. So now they've asked every public sector bank to review how their gold loan portfolio looks like. Now remember that during COVID, the Reserve Bank of India had eased the LTV ratio from 75% to 90% for gold loans for banks. During that time, a lot of public sector banks which were not in the gold loan business or were not actively in the gold loan business started extending these loans because this was probably the safest option during COVID when the risks on the retail loan portfolio were high. So now, after about 3 or 4 years, now this situation is coming back for reckoning. Public sector banks are being asked to review their entire portfolio, so expect some amount of tightening at these banks.
Thanks so much, Vishy, for getting us those details. Of course, we have to talk about a lot more regulatory action, and you'll find that in just a short while on the editor's cut. For now, let's turn to certain action from the trade perspective. India has signed a trade agreement with 4 European countries, and I will contend that you may not have heard of one of those countries. Of course, 3 of them are quite well known: Switzerland, Norway, Iceland. And the fourth one is Liechtenstein. I must admit that I wasn't very familiar with this. But to tell you about what this entails and what the details of this deal are, Janani is joining in to give you some perspective. Janani, there is an interesting bit which relates to investments that are baked into this deal. What can you tell us about all of the details here?
Good morning, Alex. That's right. India on Sunday signed an EFTA agreement, or the European Free Trade Association country agreement, with, like you said, Switzerland, Norway, Iceland, and Liechtenstein. It's very important to note that this is important for 2 reasons. One, this is one of 3 anticipated trade deals ahead of the Indian general elections happening in the summer of 2024, and also that a 100 billion investment promise is woven into this deal, which is the first of its kind. How exactly is this investment going to flow in? Now, it said that the four countries will look to nudge their private firms to invest in India in a metered way, 50 billion US dollars in the first 10 years after the agreement comes into force, and another 50 billion in the subsequent 5 years. It's also supposed to give a direct job prospect for about 1 million Indians, and indirect job prospects we don't know yet. What's interesting from this, of course, is also that an investment subcommittee will be formed, and they will review the progress of this and also look at whether rebalancing needs to be done if A, inflows don't come in as anticipated, or if any of the underlying conditions like economic growth or certain geopolitical tensions change the status quo as it stands. What does get cheaper for Indians? Perhaps we might not get a lot of export potential, considering that our exports to these four countries are quite low, Switzerland being the biggest trading partner. But we are cutting import duties on Swiss chocolates, on watches, on Swiss wines. So Swiss wines go from about 150% import duty to about 175 in a metered way over the next 10 years. We also are looking at Swiss watches, stopwatches, them pocket watches going down from the 20% duty they are at now. And in another 7 years, it'll become zero duty. Machinery, almost effective immediately after the agreement comes into force, will go from 10 to 0. Like I said, chocolates would go from 30% to 0 in about 7 years of time. So, like I said, this is one of 3 anticipated deals. The UK FTA and the one with Oman is the one we'll be watching out for next. The full story is on the website for our viewers.
Right. Thanks so much, Janani, for getting us those details. Indeed, you can check out the story on NDTVProfit.com. It's time for a quick break. We'll be back on the other side with stock-specific action and a few more important stories that you need to pay attention to. Do stay tuned.
Amul has completed 50 years in India. PM Modi will attend the Silver Jubilee celebrations of the Gujarat Cooperative Milk Marketing Federation, the owner of Amul. At one point of time or the other, we've all grown up with Amul butter or milk for sure. The famous Amul girl created in 1967 is family. We all recognize her. But as the brand grows 50 years old today, do you remember the full form of Amul? It is Anand Milk Union Limited. From producing 250 liters of milk per day since the time Amul was formed back in the mid-90s to today, where Amul has over 36 lakh dairy farmers and produces nearly 300 lakh liters of milk per day, the brand has had a long journey. The story goes way back in time. In the 1940s, dairy farmers were worried. The middlemen exploited their ways of profitable income, and a poor milk production system made their living difficult. Tribhuvan Das Patel and Verghese Kurian identified these issues and helped in the formation of the first milk union called Kaira District Cooperative Milk Producers Union in 1946. The cooperative model gave farmers direct ownership of the dairy industry. The union helped them process, market and sell milk and milk products without the interruption of intermediaries. And it was in 1955 that this union chose a brand name for itself called Amul, which means priceless in Sanskrit. And then, in 1973, Amul Dairy, along with 16 other district cooperatives, formed the Gujarat Cooperative Milk Marketing Federation, which has now completed 50 years in India. Amul also started India's white revolution that made our country the world's biggest maker of milk and milk products. The brand follows an umbrella marketing technique which has helped GCMMF prevent association clashes and keep an open door for the patrons to coordinate in creating items. As per a report by Statista, the annual sales turnover of Amul from 2011 to 2023 has consistently risen, recording about 55,000 crore rupees of turnover in 2022-2023 alone. And did you know, Amul has also held a Guinness World Record for having the longest continuous run of any advertising campaign that has ever taken place anywhere in the universe. Amul Doodh Peeta Hai India and Utterly Butterly Delicious will always strike a chord. Let us know which famous advertising phrases of Amul do you remember.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing.
Welcome back. You're watching All You Need to Know. It's time to look at the key stocks to watch out for in trade today. Of course, we've talked about a couple. Among them, of course, the Tata Group of stocks. But we've also got DB Realty, Hindustan Aeronautics, and a couple more to watch out for. Anushi is joining in to tell you why. Morning, Anushi. Why are we including these stocks in your list today?
Morning, Alex. A whole lot of bunch of stocks today. So I'll start off at DB Realty first, which is in focus ahead of its qualified institutional payment of about 1,500 crore. So this is at an indicative price of about 258 rupees, which is about of 8.5% of discount compared to its earlier price. Now, this is in focus ahead of the company's plan to repay its debt and kickstart of certain of its projects over here. So DB is definitely in focus. Now, moving on to Dilip Buildcon, this is in focus ahead as it emerges as the lowest bidder by the NHAI in Tamil Nadu. This is for a 550 crore of road project over there, which would be in a hybrid annuity basis. Again, the completion period for this is estimated to be within 36 months of the project. So that is Dilip Buildcon. Now, next on the list is PNC Infratech, which has executed agreement for HAM project in Madhya Pradesh. This is with a project cost of about 1,174 crores. So definitely a focus on this one. The company also informed the exchanges that it has completed about 1,062 crore of another project it had in UP. So two updates for this one. Moving on to Torrent Power right now. So Torrent Power is in focus as the company has received a letter of award of about 1,540 crore. This is in line with their focus to increase their renewable capacity now, which now would be at 3 gigawatts compared to its current positioning of 1.7 gigawatts. So this award was from the Maharashtra State Electricity Distribution Board. So that is there. And last on the list, we have Hindustan Aeronautics, which is in focus as government has approved the acquisition of 34 light helicopters by Dhruv. So again, over here, if you have to take this in consideration, the company of this 9 would be received by the Indian Coast Guard, while the others would be for the Indian Army. So that is the whole list of stocks to focus for today.
Got it. Thanks, Anushi. Now, most of those stocks are on account of order wins, but we've got some more details to talk about for the likes of Interglobe Aviation as well as RVNL. And we've got Varsha joining in to tell you about those stocks. Varsha, what are you picking up? Morning.
Good morning, Alex. So few stocks which should be in focus today, starting with Interglobe Aviation, wherein promoter Rakesh Gangwal is going to sell almost 5.8% stake in the company. Now, this stake sale has been revised from 3.3% to 5.8%, for which floor price has been set as 2,925 a piece, and this floor price is at a discount of almost 5.6% as per Thursday's closing price. Now, Gangwal's stake in the company will decrease to almost 5.9%. Then we have RVNL, wherein RVNL URC JV has received a letter of acceptance from Madhya Pradesh Metro Rail Corporation for various projects. Now, the total value of the project is almost 543 crore, and RVNL share is 51% in the JV, and contract need to be executed within 3 years. Then we have Shyam Metallics, wherein they've got a business update for Feb, wherein sponge iron sales volume is up almost 2.2x, while steel billet sale volume is up 26.5%. And then lastly, we have Gensol Engineering, where it has emerged as lowest bidder for Gujarat Urja Vikas Nigam battery energy storage project, which will add almost 450 crores to revenues.
All right, thanks so much, Varsha, for giving us those details. Updates from the insurance space. Life insurance companies' new business premiums for the month of February are in. And in fact, revenues have surged as much as 48%. LIC, in fact, reporting the strongest growth on a year-on-year basis in new business premiums. SBI Life has reported the highest revenue among private peers. You have new policies, however, that have only risen by about 9%. So some of that, in fact, could be a base effect playing out. LIC's seen its premium grow as much as new business premium grow as much as 13%. HDFC Life up about 27.8%. SBI Life up as much as 26% or thereabouts. ICICI Pru also strong growth, up as much as 34%. And the grand total, of course, is up over 48%. Now, let's get you some details from what brokerages are making of this data. We've got Mahima joining in to give you some perspective on that. Mahima, what are they saying?
Right, Alex. So firstly, overall, on the insurance data that has come out, well, there was a Citi note on this. They've said that SBI Life remains the top pick in the insurance space, and they've said that tepid growth in ticket size and there is some kind of single premium mix down YOY. Their Q4 estimates have remained benign. Well, it expects medium-term re-rating underpinned by tailwinds, and these tailwinds can be in form of pension landscape, channel diversification, product innovation. And they said that strong growth in individual regular pay policies has been witnessed. Now, moving on to company specific action, well, in terms of HDFC Life's individual APE growth surpassed their private peers after 4 months. So this is a good thing for HDFC Life. And they've said that individual APE market share was 90 BPS up. And for ICICI Prudential Life, well, the individual APE market share remained flat YTD, and the trends in premium mix, channel-wise sourcing strategy and cost ratio remain monitorable for this for ICICI Prudential Life. Moving on, Max Life, well, Max Life has outperformed its peers. However, overall 4-year CAGR growth, if we see for individual APE, is around 12% versus that of 16% of peers. And for SBI Life, they've said that it continued to witness market share accretion. And lastly, for LIC continued to recoup market share in group business.
Got it. All right, let's talk about the financials and specifically on banks. We've got a Bernstein report that is quite interesting, and specifically on State Bank of India, right? It's downgraded the counter with a target price of 780. What are they saying specifically?
Right, so as you rightly mentioned, they've downgraded SBI to market perform with a target price of 780. Well, they're saying that it's time to switch back to the private sector from the public sector banks because they're seeing that less promising trajectories for PSBs on weaker deposit growth and lower liquidity buffers. Now, they're also saying that aggressive pricing in loans and deposit will result in muted earnings growth. And they've also said that there is a valuation gap which is narrowed down significantly. So these are the reasons that Bernstein has given for SBI, and that is why they've downgraded SBI.
Got it. All right. Thanks so much, Mahima, for getting us those details. Now, it's good news for Mumbaikars. A southbound corridor of the Coastal Road project between Worli and Marine Drive. It's the first phase of this project is set to be opened for traffic today. For the time being, only cars and buses will be allowed on the Coastal Road and all other vehicle types, including 2- and 3-wheelers, will be barred. No tolls have been imposed as of now. That brings us to the end of this particular edition of All You Need to Know. Do stay tuned. Lots more coming up over the course of the day, starting with India Market Open in just a few minutes. This is NDTV Profit.
Hello. Good morning, ma'am. I'm speaking from XYZ company. Are you looking for a job or a job change? Have you been receiving unwanted calls from spam numbers? Are you tired of being offered new jobs, insurance schemes, or free health checkups? Well, today we will look at an interesting survey report by Local Circles on pesky calls that received 60,000 responses. Most unwanted calls are related to financial services, 54%, and real estate, 22%. In fact, the report has taken names. 40% mobile subscribers have identified Bajaj Finance as a top offender, HDFC Group as the second biggest pesky caller. The report reveals that 60% of people received 3 or more spam calls on an average day every day, and 92% of people registered on the Do Not Disturb list still get pesky calls. So is being listed on DND working? Clearly not. But the report also recorded a minute relief as per which 6% people don't get any such phone calls. This relief comes after the TRAI directive to banks, insurance companies and other commercial entities. TRAI is the Telecom Regulatory Authority of India. In fact, the Department of Consumer Affairs has constituted a committee comprising members of different regulatory authorities, telemarketing companies and cellular industry to draft the guidelines to address the issue of pesky calls. So yes, pesky calls are still a worry, but there is a little relief too. Can you ignore them though? Toll-free numbers are identifiable, so institutions have found a new way. According to the report, calls from different mobile phone numbers that seem to belong to companies or brands have risen from 29% in February 2023 to 36% now. And look at the change in trend. Real estate selling has risen from 18% last year to 22% now. However, job offerings have decreased from 10% to 4%, and in the case of those selling financial services, the calls have slipped from 60% to 54%. So the bigger question is, will the nuisance of pesky calls end anytime soon? There should be a system where pesky callers are blacklisted at the Aadhaar level, so they have the risk of not getting a new SIM. Also, brands on whose behalf the contracted callers are calling also need to be held accountable by the Department of Consumer Affairs, so brands institute the right consumer outreach practices both with employees as well as third-party contractors. For more such updates, stay tuned to NDTV Profit.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple.
If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money. Welcome to India Market Open. It's been 4 straight weeks of gains. It could be a week of consolidation. Morning, Tamanna, but there's so much data. You've got India CPR, you've got US CPR, you've got global flows, and of course, 4 straight weeks of gains. But it still remains a buy on dips kind of market, right?
You know, this is what happens when you come off a long weekend of trade. The news flow is just enormous. So many things have happened over the last 3 days. It's really been busy, and you know, let's break it out for you one by one. We'll be talking about all the events which are going to impact trade today, and there's a host of them. Let me begin with what global markets look like, at least on Friday's close. It was a day of sell-off on Wall Street. Definitely the Nasdaq the most hit, down over 1%, thanks to Nvidia. So finally that Nvidia steamroller took a pause, and there was a drop over there in Nvidia stocks, 5% down. But remember, week on week it's still about 6% up, so it's just a pause over there. Jobs data came out on Friday, and that was important because US jobs in February have run hotter than expected at 270 175,000, way above estimates. Jan jobs data has also been revised upwards. So on the face of it, an economy that's growing too fast, bad news for rates. But on the other hand, unemployment rates have also gone up. Wage growth has been low. So unemployment at 3.9% was higher than what was expected. On the face of it, the Fed is on track to achieve what it wants, which is lowered inflation without impacting growth. So if you put those two together, the outlook could be positive. And that's what you're seeing as far as bonds are concerned. The US 10-year early this morning, at least, was at 4.05% on the back of this jobs outlook. So that's a positive. I want to pull up Asia. Asia has not had a great start to the morning, and we'll pull up all the indices. Look at the Nikkei, about 2.5% down. So following what's happening in Wall Street as well, Hang Seng at least up in the green. We'll quickly look at the Indian implied open and see what we're set up for, because there's so many factors at play today, and so far we're looking like we're up in the green and set for a good start to the day. But so many stories will play out, whether it's the Tata Group stocks, whether what's happening in banking and financials, insurance companies, all of that is going to be on the anvil. Just a quick look at what the fund flows were like at last close, which was Thursday for us, before I hand it to Samina for the trade setup of the day. And the figure I found interesting here is look at the FII buys. We haven't seen that robust a figure in a while for a single day, at about 7,300 crores for FIIs. DIs have also been buying. And what Amphi data, which came out over a Friday, is telling us that there is a rejig by mutual funds as well in the kind of companies they're buying because of SEBI's push for lowering their risk to small and mid-cap stocks. So all in all, that's at least the global piece of it, but we're set up for a decent day, Samina.
Indeed. In fact, we'll be playing catch-up, right? You had Thursday and Friday global cues to react to, and like Taman indicated, it's been a long weekend, so you're coming back to trade after a few days, and hence the euphoria and the excitement may actually continue. But just to add to Tamanna's point about FI activity, remember FPIs have made a comeback in the last 2 months. For the month of March, that number stands at 6,139 crores, following a 1,540 crore buy figure that we saw in the month of Feb. Jan is when we'd seen a massive outflow of FPIs to the tune of 25,743 crores. Beyond equities, FPIs have been aggressively buying in the debt market as well. That number stands at 1,025 crores for the month of March so far. But as we go into this week, a quick check of what implied Nifty is indicating too this morning. Global cues, like Tamanna indicated, are almost mixed, but it looks like we are setting ourselves up for a gap-up opening. A 100-point open on implied Nifty is what we have as we gear up for trade. Lots of factors to watch. While a trade will be about specific sectors, sector rotation may continue in today's day of trade. But remember, 7th of March saw the markets close at a brand new high on the Nifty and the Sensex both. Markets were volatile, but nevertheless ended on a positive note for the 4th straight week. Similar trend is expected as we go into trade this week. The market continues to be a buy on dip, and that clearly is the strategy, not just for the benchmark, but for sector-specific trade as well. Well, if you look at option data, that indicates that 22,500 is expected to be a crucial level of support coming in for the Nifty. The next hurdle will be 22,700, and 22,400 and 22,000 on the downside are going to be important levels of trade. So 22,000 and the 400 on the downside, and 22,700 is going to be the trading range for this week as well. Well, you could see a week of some consolidation. Minor profit booking cannot be ruled out, given that the last 4 weeks have been pretty solid and have been a northward journey for the index. A couple of data points that will give the market some direction. You've got inflation coming in from the US on the 12th of March, expected to be pretty similar to what we've seen over the last few months. You've also got inflation data coming in from India. Now, this is going to be critical because this is the last inflation reading before the RBI policy meets on the first week of April. Well, apart from that, from data that we've picked up, it seems like the broader markets are underperforming the benchmark. So what we've really seen is a small and the mid-cap space decline in last week's trade, and expectation indication that trade is now moving to the large cap space. So if you look at the bias is the next leg of rally will come in from some of those large cap names. names. Couple of IPOs. You've got 7 companies that will go out and raise money. You've got 5 listings as well that are lined up this week. So, Tamanna, it's going to be a busy week. But what's interesting is after many, many months, it seems like the bias will now for a change and eventually move the large cap index. And we saw that last week while the Nifty did okay, the mid and the small cap index actually went home with pretty significant cuts.
Especially the small cap stocks definitely had significant cuts. And you know, Samina, this is right on course to what has been discussed on this channel right from the end of calendar year 2023, that rotationally that's going to happen. You also have policy push now in that direction. But speaking of large caps, at least one set of companies which are going to be under pressure today is Tata Group stocks and Tata Chemicals in particular. So I just want to start up with the sort of news flow we've seen over the weekend and what impact that's going to have. So now this Tata Chemicals story in itself is quite interesting. You will remember that this stock rallied about 34% just in the last 4 trading sessions. This was the close that you saw on Thursday, and I just want to pull up for the last 1 week if we could. Now, newspaper reports over the weekend, starting actually with the Times of India, reported that Tata Suns is looking for ways to avoid listing their IPO. Now, you know that they need to because of SEBI rules from 2021, which has said that they have to be categorized as an upper level NBFC. So they're supposed to list. The deadline for that is September 2025. There was a Spark Capital report which said that if they have to list, Tata Chemicals would be the best play. And that was all it took for that stock to spark massively. Now, these reports that suggest that Tata Sons might be looking at alternatives to this could really see some backslide or some sell-off in these counters. So that is one that I would look for. The reversal of the IPO outlook may see a sell-off. The other one to keep in mind is, of course, SBI, and we're going to try and have this conversation later in the day as well, because there's a Bernstein report out on India financials which has downgraded SBI to market perform with a target price of 780. Now, this is quite significant because it says they see less promising trajectory for public sector banks on weaker deposit growth and lower liquidity buffers versus private banks. Now, in a market which has been completely gung-ho about public sector banks versus private banks, this is a reversal of mood, no doubt about it. And we'll have to wait and see what the impact is, not just on the SBI counter, but on the PSB space as well. Another reason Bernstein gives this, it says aggressive pricing and loans and deposit will result in muted earning growth. They say the valuation gap has narrowed significantly. Remember, what was going for public sector banks were their relatively lower valuations. Life insurance stocks are the other one. You had Feb data coming in. And now typically, yes, in Feb you might see good data because remember, before year end, anyone who wants to do the tax savings sometimes does use these instruments. So perhaps that's one of the reasons that you saw Feb revenues for life insurers surge 48%. LIC had the strongest year-on-year growth in new business premiums. SBI Life reported the highest revenue among private peers. There's a clutch of brokerage notes out this morning as well, which are underlying the positive sentiment. So look out for an LIC, an SBI Life, an ICICI Pru, and all of them could be seeing some upside. Just the thing to note about LIC is that their market share has fallen 520 basis points to 58.6%. They're still dominating, of course, but you're seeing a consistent slide in the behemoth's market share as well. SBI Life's revenues saw the strongest growth of about 30% on a year-to-date basis. So insurers, life insurers, public sector banks, Tata Group, especially Tata Chemicals, definitely on the radar. But there's so much more to cover, isn't there, Samir?
It is, and it's going to be another bad day, down day rather, for JM Financial. We'll take you through the latest updates that took place between Thursday and today will be the first day of a stock reaction coming in on JM Financial. SEBI has barred JM Financial from taking any new mandate for acting as a lead manager for any public issue of debt securities. This SEBI order comes after its investigation into a specific public issue of debt which was executed in 2023, where JM Financial was the lead manager and involved 2 other JM Financial entities, which is JM Financial Products and JM Financial Broker. SEBI has observed that these transactions involved all three JM Financial entities, so an arm's length distance was not seen in these transactions amongst the three entities. In fact, the moves were predetermined and done in a synchronized manner with unnaturally high retail subscription. That is what is going to put JM Financial back in focus this morning on back of being barred to be the lead manager of any of those NCDs going ahead. The stock will be reacting negatively. Of course, JM Financial has said that they're cooperating as and when they've been required to do so. Well, moving on from there, another company that will be in focus, Interglobe Aviation. Watch out for this one. The co-founder Rakesh Agarwal is reportedly considering doing another round of stake sale. There were reports in the early part of the weekend where this quantum of stake sale was about 3.3%, but there are some reports this morning that indicate that the stake sale could be to the tune of 5.8%. This stake sale will raise about 6,600 crores, the floor price set at 2,925 rupees a share. Well, this is part of the Rakesh Agarwal strategy where he has been gradually offloading or reducing his stake in Interglobe Aviation. Well, another one to watch out for is going to be Rail Vikas Nigam. This is actually a fairly big one. They've secured an order worth 1,298 crores from the Himachal State Electricity Board. The stock went home flat, but the counter could see a big reaction because this order win is a significant one in terms of its order book. So those are the three on my list, but I guess the list continues, Tamanna.
Yeah, and RVNL actually is going to be a hot one today because they have one, as you said, from the Himachal State Electricity Board and the other one from the Madhya Pradesh Metro Corporation as well. But just a word on JM Financial. I mean, that stock was actually in recovery mode on Thursday's trade, up 3%, with the idea that, that whole fear was overblown. Now comes this sledgehammer on, they've been banned or barred from, NCDs as well, and that part of the business. What is going to be the spillover effect really is the question, and we're going to be discussing that more on Editor's Cut, but want to watch out for just a couple of stocks. I want to talk about the real estate pack. And Samina, this is a story that you're going to be detailing, but exciting. REITs now in small and medium section of real estate have also now been allowed. So that's a 50 crore sort of a pack. The minimum investment has also come down. Is this going to be a good investment or not is the question. So I would watch out for real estate stocks, definitely. DB Realty is another one. We reported that they will be raising up to 1,500 crores versus a QIP with a green shoe option of 500 crores. The issue price is 258 a piece. So DB Realty, another one that should be on your radar. And HG Infra is the other one. Actually, a whole host of them in terms of order wins, and we'll get Anushi to give you those details later on the show. But HG Infra one that I want to put out there for you. They've been declared as the lowest bidder for 945 crores on an NHAI contract for a highway construction project in Andhra Pradesh. So all that and more coming up. But let me go across now to Alex on the Editor's Cut with the attempt to put all of these stories into a bit more perspective, Alex.
Absolutely. Thanks so much, Tamanna, for that. We'll start with the regulatory action on JM Financial because this probably has implications for the wider space as well. I do want to read, and Vishy is going to break that down for you. Samina is going to talk about the small and medium REITs, the implications of that for you as an investor and also for the space as a whole. But on the JM story, I'm reading the statement that they sent out last week after the RBI action. They said, after a careful and detailed review of the order issued by the RBI, we strongly believe that there have been no material deficiencies in our loan sanctioning process. That was on the loan side. There was practically no response to the SEBI action. There was joint action by the SEBI and the RBI. Now we know why. But what is the latest action now?
Yeah, so just about the statement now, right after the SEBI action, the only statement that came from JM Financial was that they are unable to ascertain the financial impact of this action and that they will cooperate with SEBI. They didn't sound so cooperative with the RBI. But just to put things in perspective, what SEBI essentially looked at was one NCD issuance. Now, of course, they're saying that they're looking at other stuff. But at this point in time, the debenture issue is what led to the action that SEBI's taken against JM Financial. There they found that JM Financial Products was acting as a lender to investors. They were getting retail investors who come in and buy into these debentures, and then on the listing day, they were selling the securities that were bought by these retail investors to institutional investors, which is essentially JM Financial Services. So they acted as the lender, the operator, and the borrower. So that became, according to SEBI, that was a shocking sort of set of events. And the way that this was done, with the timing that it was done in, looked like it was planned well in advance. The problem happened because they promised certain returns to these investors. The securities were actually sold for a loss. It's unsure which debt issuance they were talking about, but sources
2023.
Sources say it's Piramal Enterprises because that's where the timing matches. But we're not getting into that part of the story. This action follows. Just a day before that, the Reserve Bank of India said JM Financial Products has been, showing some lapses in the way that they were doing the debenture financing as well as IPO financing business, and therefore they've barred from lending against securities.
But two questions on this. One, you've laid out what they did. We've also spoken about what the SEBI has said. What does this mean for JM Financial, one? And the second part is the wider space. One would assume that if one entity is doing this and they've said on the RBI action that this is industry practice. So what does it mean for the industry?
For JM Financial, as far as they're concerned, lending against securities and their debenture financing, debenture lead manager business, all of that goes away, right? And that's a problem for the entity because they were a large player in the NCD market. Now they can't do that business going ahead, at least for the foreseeable future, because SEBI investigation is likely to take another 6 months, and then after that there will be, of course, some amount of back and forth between the two entities. We'll see what happens. For the industry, there's a problem because the RBI has already sounded alarm bells about dependency of NBFCs on the bank financing route. So NBFCs were anyway shifting that fundraising to the NCD market. Now, if there are questions raised about the NCD market, then where exactly do these NBFCs go and raise money? Because they need those funds to actually go out and lend. And if there is some amount of ripple effect on these entities, that's going to be a problem because if the NBFC industry can't grow, then you can't support that bank financing in tandem.
Okay, interesting. So fallouts beyond just the issuance, and also, by the way, Sajith was talking about implications for SME IPOs and the possibility of oversight, regulatory oversight. The SEBI chairperson, of course, has gone on record to say that the IPO market has seen froth, and perhaps you could see some action there as well. All right, so a lot to unpack, of course, and we'll get more details over the course of the day. But let's turn attention to another interesting piece as well, which has to do with the real estate space. And interestingly, Samina, small and medium real estate investment trusts. I guess to a certain extent they want to get into the residential space or make that more lucrative. What are the key highlights here?
Yeah, Alex, I think the whole weekend was buzzing with what SEBI has done. They are ahead of the curve, interestingly. But let's just break this down for people who are confused whether this is good news for the real estate stocks. Is it great news for an investor? Let's start by telling you what a REIT is, right? A REIT, for a very simple reason, is like a jar where investors pool their money in, and that money is used to buy an asset. Currently in India, you've got 4 listed REITs, the likes of an Embassy, a Brookfield, which were allowed up until Thursday to only invest in commercial real estate or malls. What the SEBI has done is they've come out and said that now smaller REITs, so the REITs, the traditional REITs have, of course, like the embassies of the world, are fairly large, has come out and notified that small, medium REITs will now be allowed. They will be allowed to have smaller sort of quantums of investment or smaller jars of money. And more importantly, I think what got the street excited is that you can now invest or have fractional investment in residential real estate, which means that the SME REIT can go out and actually buy an apartment, buy a floor, buy a second home, a villa. The minimum size of REIT has got to be 50 crores, going all the way up to 500 crores. the investors have skin in the game because what they're really trying to do is protect investors, right, of 5%. Now, if you take a step back, are we saying that retail investors have never invested in fractional investment through real estate? Of course they have.
Yeah.
It's just been in a relatively unregulated market, right? By doing this, the regulators ensuring that there is some amount of protection that's brought in for fractional investment in residential real estate. But of course, when we say retail investors, I don't know how retail it's going to be. It's 10 lakh rupees is the minimum ticket size. Yeah. So you're still looking at a segment that is considered more ultra HNI in that regard. So while this is great, gets a thumbs up, a lot of real estate companies like the likes of a Godrej Consumer are sitting on unsold inventory in places like the Godrej Properties in Thane and New Bombay would probably go out and look at the
even the smaller developers.
Structure. Yeah, so that comes in from a real estate sector play, right, where these counters will do well. But for an investor, now let's take a step back. India is a low rental residential yield market. Currently, rental yields in India are in the range of 2 to 3%. At best, you're looking at a 4%. How do you earn on a REIT? You get your rental yields and you get capital appreciation. Let's not forget that while rental yields are the 2 to 3%, where that's one function of returns coming in for investors, the other one is capital appreciation. We've all seen, right? Real estate has seen an appreciation now after many, many years of underperformance. Yeah. If I have to peg a number to it, an annualized return, it's no more than 5 to 6%. Correct. Secondly, the bigger chunk of capital appreciation...
In certain markets, I must point out. In markets like Mumbai.
You mean best case scenario?
The larger markets,
yeah. But what also is worth noting is when the appreciation comes in, it comes in from buying the land, building it, and then selling it. So the appreciation is from buying the land, right? What the REIT and SME has said is the regulators said you can only invest in properties that are 95% completed, which means they're already yielding rent and the appreciation has been taken. Beyond that, how does capital appreciation happen? It's going to impact the NAV only if you're going to go out and evaluate the real estate in some cases, or in other cases, sell the real estate. So you're not really going to see the chunk of capital appreciation coming in for a very long time. The other thing that I heard from one of the analysts yesterday was they said that while this is great, cost of compliance is also going to go up. So
why is that?
Too, because now you're going to have to you have to review your assets. You've got to do a lot more paperwork. You've got to get a lot more auditors in. While it was unregulated, it was easier because while there was a risk involved, the returns were slightly higher, right? But with being regulated, cost of compliance goes up. Getting a REIT to listing is also going to take some money.
So, quick question on this in terms of operations. This has come through. Would you have the same entity float multiple REITs because of the ceiling size of 500 crore, or is it each REIT will be only 500 crore?
Each REIT can go up to 500 crore, so that's one unit, right? I think the challenge is more on the downside because how many homes can you, I mean, think about it operationally. How often do you come across an apartment or a floor that's 50 crores? It's not very often. So the REIT might have to buy maybe an apartment in Bandra or in Bombay, a holiday villa in Goa, one in Bangalore. But all of that is very difficult to manage, operate and run. The other thing that I noticed was while all of this provides, and I mean, the fact that you have REITs that are listed, it's liquidity, which makes things easier. But because it's so early on, if you as an investor go in and invest in a REIT, and assuming you want liquidity in a few months, will these REITs be able to provide that liquidity, right? So because early on, things are going to be tough. So net, step in the right direction. As an investor, returns not very exciting unless the India landscape changes and rental yields go up to 5-6%. Commercial REITs are still far more attractive because you're looking at a 9 to 10% yield in that market. So good news, I guess, more for real estate companies as opposed to investors.
I guess, but to the point on fractional ownership, and this is the last point I will make, maybe you can counter that, is that for so long we've talked about real estate as a part of your investment portfolio and how, because of the chunky size of the assets, you can't really count your residential, your home, you can't count it as part of your assets. But if you have a 1 CR portfolio and you're saying, okay, 10% allocation towards real estate, it's possible.
Indeed, it is possible, but I'd still pick a commercial REIT over a residential REIT at 9% and capital appreciation. And more importantly, while Alex indicated 1 crore, let's not forget 1 crore in India is categorized as an HNI.
Absolutely.
So if this is for retail investors looking at getting a piece of the pie, you might want to take a step back. That's not really what's going to happen. But like we said, the industry is giving this a thumbs up.
That's a very fair point. All right, let us know what you think. Would you consider fractional ownership? Do you think that it's affordable? Do you think that the value of 10 lakhs should be brought down? All of that on our social media platforms in the comment section. We'll be back on the other side with more action before the start of trade, so do stay tuned.
The farmers' protests have been making headlines. Indian farmers have demands such as legal guarantee on MSP, pension and debt waiver, no hike in electricity tariff, reinstatement of Land Acquisition Act 2013 and more. But while the protest becomes important from the point of view of elections and politics, it's not just India that has its farmers agitated. The streets of Spain, Belgium, Hungary and Poland have been roaring with protests by farmers too. Around 1,400 tractors took part in a protest in Poland and roads were blocked across the country. What do they have a problem with? Rising production costs, falling sale price, stringent regulations. They say that the European Union is not doing enough to stop cheap imports from Ukraine, which is affecting the demand for local produce. They are also not happy with the European Union's Green Deal that's designed to zero out pollution by 2050 because it limits the use of pesticides, which in turn affects yield. In Greece, farmers have demanded lower electricity prices, tax-free diesel and subsidized animal feed. In France, farmers have been fighting for improved pay and protection from foreign competition. The French government offered 400 million euros, that's $436 million, in various measures in reciprocation to their problems over low earnings, heavy regulation, and unfair competition from abroad. In Germany, farmers are against the government's decision to phase out tax concessions on agricultural diesel. Their argument is that this will lead them to bankruptcy. In Romania, the protests stem from anger about low prices for produce, rising costs, imports of cheap foodstuffs, and constraints imposed by the European Union's drive to fight climate change. In the United Kingdom, farmers are struggling to keep up with weather changes and war-related supply chain disruptions. The whole of Europe seems to have the agricultural sector in pain as climate change becomes a central focus and production prices increase. And no, it doesn't end there. As per Down to Earth, since 2023, farmers have protested in 67% of countries in South America region for a variety of reasons, such as wanting better export exchange rates and reduced taxes amid an extended economic downturn and Argentina's devastating drought, which have severely damaged crops and agricultural output. And look at this data. Farmers' protests have happened in 12 countries in Africa, 11 countries in Asia, 24 countries in Europe, 8 countries in North and Central America, and 2 countries in Oceania in just a year's time. So let's boil down all this worry to 5 main reasons, India included. Pricing of produce, delayed compensation or subsidy, unfair effects of climate change, policies and regulations, import and export duties, and supply chain discrepancies. What does it say about the world of agriculture? Does it just question politics and governance, or does it hint at a bigger problem, a potential global food crisis?
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Welcome back. You're watching India Market Open. Quick look at the implied open before we come to what you can expect on the F&O side of things. And yeah, we're still looking like we're headed for a positive start. Focus on banks, financials, and of course Tata Group stocks. But Samina is now joining in with what to expect on the F&O side of things after a long weekend. Samina, the outlook overall positive?
Indeed, it's been 4 straight week of gains, and that's what we saw on Thursday before we went in for the long weekend. The Nifty closed at a record high, just shy of 22,500. And of course, this morning you're opening to an implied Nifty figure, which is indicating to a massive gap up of about 100 odd points. The Nifty 50 premium also stands at 44 points. It's actually improved from the close that we saw in terms of Thursday. Open interest is around 6.5% versus 5.5% that was seen in terms of Thursday's trade. Well, a quick check of what the action really looks like. Remember, for this week, you're going to see 22,600 or 22,800, which will act as a key level of resistance for the Nifty. On the downside, support remains at 22,300 and 22,400. Well, let's take a look at all the activity. Maximum open interest call addition was seen at 22,500, followed by 22,800 and 23,000. So that indicates to you what sort of activity we are seeing on the call side in terms of maximum open interest being added. On the put side, maximum open interest addition was seen at levels of 22,400. But that's Bank Nifty for you after 2 months of underperformance. Remember, Bank Nifty made a record high all the way back in December, and since then there's been some resistance to go back and make new record highs. Bank Nifty closed out in terms of trade, and futures are indicating to a large premium of about 65 odd points, and open interest is down about 10% versus 11.1% that we'd seen earlier. Well, that's pretty much where the action is in terms of stock-specific trade. There are lots of counters that will be in focus. More importantly, what you want to watch out for is counters such as Mahanagar Gas, ICICI Bank, Manappuram Finance, Tata Chemical, Dixon Technologies, where we've seen a decline in open interest indicating to some sort of long unwinding. In terms of short built-up counters such as SAIL, Apollo Tyres, M&M, Manappuram Finance, AB Capital and BHEL have been fairly active. So what we're setting ourselves up for is another positive session. It's been 4 straight weeks of gains. It remains a buy on dip strategy. But what you want to keep in mind is because we've gained for the last 4 trading weeks, today or this week could be a week of consolidation and minor profit taking. But we have with us Amit Goel now, who's joining in with his top strategies for trade. Amit, good morning. Thanks for joining in. Amit, from what we are picking up in the F&O activity and the sort of technicals this morning, 22,600 to 22,800 is going to be important resistance for the Nifty, and support remains at 22,400. How would you trade the Nifty to begin with?
Yeah, hi, good morning, Samina, and good morning to all your viewers. Thank you for having me here. As you've very rightly said, Nifty has been on a tearaway run. We've had 4 consecutive weeks of positive closes, and we have been printing new all-time highs every week. Right now, what I say is, I tend to agree with you that, excuse me, I tend to agree with you that we will possibly see a bit of profit booking from some of the weak counters, especially given the news flow, which has not been very positive, at least in the NBFC side. Even the overhang of Tata Suns, listing, causing some bit of negativity in the Tata Group, could possibly pull down the Nifty as well. So what I would like to do is I would like to play the range in Nifty, keeping a broad range of 22,400 and 22,800, and set up a simple short triangle or an iron condor.
Right. Amit, we'll talk about Tata Chemicals and some of the other Tata Group stocks because, like you said, these are going to be fairly impactful today, at least in terms of what the Nifty does. But very quickly on Bank Nifty, the last time it hit or made a record high was all the way back in December. Any trade on Bank Nifty this morning?
Bank Nifty has been, not really participating in this rally, so to speak, especially because the biggest, what I would call the captain of Bank Nifty, which is HDFC Bank, having a large exposure in Bank Nifty, has not been performing. That is the reason why I feel that Bank Nifty, in spite of SBI Bank, ICICI Bank, and others performing well, has not really been able to print new highs. I don't see that trend changing anytime soon. I don't see HDFC Bank picking up pace anytime soon because of the overhang in terms of the fundamentals. So I still feel that even Bank Nifty also might possibly trade in a range though the trend and the bias remains on the upside. So even in Bank Nifty, I feel, especially with this NBFC news flow, curbs from RBI on various NBFCs, including IIFL, JM Financial, and others, possibly could have a negative sentimental impact on the financials. Given that, I don't see a tearaway gap up in Bank Nifty, and so I would still, again, both the indexes, I would like to play a range. In Bank Nifty, the range would possibly be 47,500 and 48,500. Same short strangle or an iron condor in this as well.
And Amit, I believe you've got a trade on PVR Inox. The stock's largely been an underperformer, but did a pretty smart pullback in terms of Thursday's trade. Gaining about 3% odd. Way forward, what is the strategy on PVR Inox? Sorry, Amit, I guess you...
I guess I have a little bit of sore throat. But anyways, continuing with PVR Inox, I'm trying to steer away from all the news and the momentum news flows, which is happening in the financials, in the Tata groups, and I'm trying to look at a counter which has not been really, which is kind of out of the favor. It is kind of out of the view of the broader market, but has been silently forming a base. If you look at the weekly and the monthly chart, we have formed a double bottom type of a base at the support levels in PVR Inox, and the kind of move it has been giving in the last 2 weeks makes me believe that we might head up in this counter. So I feel that the target on PVR Inox is around 1569, 1570 odd levels, and I would enter at about the current market price, giving a stop loss of 1354. This is the cash market strategy. But if I were to play this in the options market, I would set up a bull put spread, selling the 1400 put and buying the 1360 as an offset, giving me a net profit or a max theoretical profit of 5,500 odd levels, and keeping a stop loss at 1388 levels, which is on an hourly closing basis. If the price closes below 1388 on an hourly closing basis, I would probably make a loss of about 1600 rupees, which is a fair bit of loss, and I would get out of this counter. This gives me a 3.5:1 kind of a RR. So this is the trade that I would play.
Thank you, Amit. Thank you for taking out the time to join us. You do have a pretty bad cough. Hope you feel better soon, and we will catch up with you soon. Well, that's what it looks like, Tamanna. It's going to be a trading bias with an upward bias, but the range remains 22,400 to 22,800. No major outperformance expected on Bank Nifty, and Amit, of course, had a strategic long call on PVR Inox.
Yeah, Amit, take care, and take care of that sore throat especially, and I hope you have a great day. Now, a lot of stocks in focus today, and I'm going across to Anushi now, who's joining us with more companies that have had news flow over the last 3 days and should be on your radar. Yes, Anushi, what's on your list?
Hey, morning, Tamanna. So, whole list over here, starting off with DB Realty, which is in focus ahead of its 1,500 crore QIP. Now, this includes about 1,000 crore of QIP with an additional green shoe option of about 500 crores at an indicative price of about 258. So, if you had to look at last closing price, about a 8.5% of discount over here. Now, these proceeds are to be used for the company's debt repayment and to kickstart off certain of their projects. So, focus remains on this one. Next on the list is Dilip Buildcon, which has emerged as the lowest bidder by NHAI in Tamil Nadu for a 550 crore road project over here. For the same for this, the completion period is estimated to be within 36 months. Moving on to PNC Infratech, again, this is also in similar guidelines over here, in which they have executed an agreement for MP Road Development Corporation for about 1,174 crore. But apart from that, the company has also executed another 1,062 crore of contract construction for UP. So again, PNC Infratech remains on focus. Next on the list is Torrent Power, which has received a letter of award for about 1,540 crore. This is for the Maharashtra State Electrician Distribution Company, and in line with their capacity to increase the renewable capacity to about 3 gigawatts from the current positioning of about 1.7 gigawatts. And last on the list, we have HAL, wherein government has approved the acquisition of 34 new Dhruv choppers, which are to be manufactured by Hindustan Aeronautics. Of this, 9 choppers would be used for the Indian Coast Guard, and the remaining for the Indian Army. Again, this is the decision remaining in line to boost the company's domestic production related to the same and replace the old choppers. So these are the whole list of stocks that definitely should be in focus today.
Cool. All right, thank you so much for that, Anushi. Another set of companies that will be in focus today, and one stock in particular is Tata Chemicals, because of the kind of news flow that we have seen all through the last week. The 4 trading sessions of last week saw the Tata Chemicals stock up nearly 34%. You're seeing just the chart for Thursday, but if you pull up the weekly chart, you'll see the kind of run-up that we've seen. Now, a lot of flip-flop on whether they could list, Tata Sons could list, could not list. Before we get to our expert, I want to get Sajit Mangat, my colleague, in to just get some perspective. Now, Sajit, this is a 2022 RBI decision which has said that if you're a CIC of a certain level, you now get classified as an upper level NBFC. Basically, if you're a holding company of the size of the Tatas or Tata Sons, which is the mothership, so to speak, of all their group companies, you need to now list because you're classified as an upper NBFC. This is known for a while. What happened in the last week?
So let's put a context to it, basically, right? We used to have too big to fail kind of banks, which RBI has already classified. Over the last couple of years, there have been cases of NBFCs failing, and they want to ensure that there is no systemic risk to that. So they classified it based on the scale of
this is the IL&FS fallout?
It's the IL&FS fallout which happened, and they have now classified NBFCs based on scale-based regulation, which means that how big is your scale in terms of how much of leverage you have on your balance sheet, whether it's off balance sheet or on balance sheet, and you based on that you classify into base level, medium level, and the upper layer. And then there's a top level. There's no one in the top level as of today, but there are around 16 NBFCs which fall under the upper layer, in which 2 of the Tata Group companies are falling, which one is Tata Sons Private Limited. Remember, it's a private limited company, which is a holding company for the group. And then there's Tata Capital Financial Limited, which is the financial services company of in the Tata Group. Now, within the Tata Group, if you look at how this financials have been broken down, so Tata Sons is now the holding company or the promoter for the insurance companies. Tata Sons, along with Tata Investment Corp, is a co-sponsor for Tata Mutual Fund. And Tata Capital is doing the lending business, cards business, wealth management, and others, which is happening. So there are 3 entities which are there. One is already listed, Tata Investment Corp, and you remember Tata Investment Corp is also running up every day around 5% for the last couple of weeks. If you look at that,
that's because of the semiconductor play or for whatever reason.
They are not into semiconductors. They're very clarified. It's coming under Tata Sons, which is there. The point being is that now it seems that because of that regulation, within 3 years you have to list, and your disclosure norms will be as good as the listed company disclosure norms, even if you are not listed. So that's what the RBI regulation very clearly says. Now, by September 2025, if you are not listed, you have to list. Now, that's where the report comes in and says that, okay, within the next 1.5 years, Tata Sons has to list, and there's a valuation which they have been putting in, and then there is companies who are holding stake in Tata Sons, which includes Indian Hotels, Tata Chemicals. They're also running up. Tata Chemicals running nearly 40%. Not on the back of ash
we saw this Spark report, which ended up saw Tata Chemicals run up. My question is that over the weekend you had a reversal of that view with a couple of newspaper reports saying that they're going to look for other alternatives. Before we get to Mahantesh Sabarat, who's waiting by, I just want to briefly understand from you, Sajit, that if the Tata Group does not want to list Tata Sons, they do have those options as well.
That's right. So they have to do a financial restructuring of the Tata Sons, wherein all the financials will have to move to one of the entities or 2 entities which they have. They have an NBFC and they have Tata Capital, and then they have to work out a way where the leverage is brought down in Tata Sons to a certain extent that it does not have to do that. But as current as rules stands currently, they have to go and list by September 25. And it seems that the RBI will not give any things unless the classification of Tata Sons changes from a CIC to a normal company, which is happening. So there is a lot of these negotiations or discussions happening within Tata Sons on this issue now that this has been blown up after the report. That there will be some kind of restructuring in a way that Tata Sons does not. Remember, Tata Sons moved from a public limited company to a private limited company after the mystery fight which happened, and they don't want to list in any ways, and it's held majorly by the trust, and they don't want to list it because the whole concept of philanthropy coming in from Tata Sons to through the Tata Trust will be lost the moment it becomes a private limited company or a listed company with profit as one of the motives which coming in, right? So that is something which is there, and I don't know how they're going to manage the jugglery part of it, but they're never interested in listing Tata Sons.
But they have significantly reduced their debt as well in the last 9 months. And while I know we talked about how Spark sparked this rally for these counters, and please correct me if I'm wrong, Sujit, but there was also a report earlier by Kotak Securities that had said the Tata Group was considering selling 5% stake in Tata Sons through an IPO. So while Spark led this rally, there were also reports by other brokerages indicating similar sort of
See, the 5% number is not a new number. If your valuation is more than 1 lakh crores, you can come out with an IPO of minimum 5%.
So they can even do just that, right?
Look at LIC, right? They came with 3.5%. Right? Because it was more than 1 lakh crore valuation. But the point is that whether you intend to list or not, the intent is not there to list.
Then they've been very clear about it. This was sparked by Spark, and now it's been unsparked by a media report.
And they have to now...
I don't know now if it's sparked or unsparked. I want to get Mahantesh in. He's also joining us in this conversation. Mahantesh, very good morning, and absolutely fabulous to speak with you on NDTV Profit. I want you to weigh in on this whole situation because the fact that Tata Sons, as per the current rules, will have to list by September 2025 was known for a while. What we saw simply last week was a calculation that if they list, which of the listed entities will benefit the most, and which is why the Tata Chemicals play came into place. What do you think the impact will be of what we've seen over the weekend? Source-based reports, remember nothing official from the company, source-based reports saying that they're looking for options to avoid listing, including juggling or rejigging the balance sheet.
Good morning, Tamanna. So firstly, my first take is that all this is speculative. You did mention that a lot of this was already known. The CIC norms were put into place in 2016. Actually, they originated in 2011. 2016, there were major changes, and over a period of time, the CIC norms have been changing. Having said that, you should understand that the CIC norms have a set of conditions, one of which is that the CIC company should be accessing public funds. It is very simple for Tata Sons to really stop accessing public funds a year and after to just go out of the radar of the CIC. There are other conditions as well. The investment company should be holding more than 60% of equity in its group companies. Again, it is very easy for Tata Sons to drop off that radar of 60% bar. While there is another condition which says 90% overall investments, which include debt, not just equity, but debt instruments as well to make it 90%. So there are various conditions which the CIC norms have to be met with for a company to be called CIC. And then there is still another escape route available through the RBI norms, which says if you have just insufficient conditions that satisfy the RBI, you can be called as an unregistered CIC. So all this is available, all this is known, all these escape routes and all these norms kind of escape routes are available to the Tata Group per se. I don't know why the speculation has suddenly begun.
So what do you do today, Mahantesh? Key question. People who have maybe bought into Tata Chemicals, Rallis, the whole pack actually saw quite a jump up, Tata Investments, all of those group stocks. Do you think that the outlook will now turn negative short term? Fundamentally, what do you make of these as investment plays?
And so it is very simple. If the stocks run up, what does a typical fund manager do? He starts booking profit, right? He starts reassessing the portfolio weights that he has. A short-term rally in stocks that a portfolio manager would have held would lead to weightages going up for those companies. So naturally, there is a process that will come into place, which will, from a risk management perspective, which will say that you should reduce the portfolios. I think that is what is likely to happen with most of these companies. And speculation is something which we have seen time and again in a efficient market. Speculation doesn't last too long. It corrects itself quite sharply.
Hi, it's Samina joining in as well, and we've talked about how this Spark report to its private wealth clients sparked this rally in stocks like Tata Chemicals, went to record highs despite falling soda ash prices. But I want to do a little bit of a detour and talk to you about what's happening in Tata Investments. We've tried talking to multiple people, unable to make sense of what is justifying or explaining the rally that Tata Investments has been witnessing. Let's not forget that this is a holding company which is rare and trades at a premium, unlike other holding companies that should be trading at a discount. But a 5% circuit every single day. What does an investor do? What does an advisor tell his investors to do?
So it is very simple again. The liquidity in the stock is very tight, and therefore when you corner a set of investors start cornering the stocks, it will rally. And it will continue to rally for quite some time until there is some selling pressure that comes in over a period of, and that selling pressure has to come from the same persons who have actually cornered the stock. There is nothing really that is happening with Tata Investment Corporation apart from the fact that they have plans to invest in the growth capital of a set of group companies. Whenever there is growth capital getting infused, both the companies, the investee as well as the investor company, stand to gain in terms of valuation, which is like the present value of future flows that you are likely to get. The assessment done by different sets of analysts would vary, but then when such assessment becomes a little irrational, you will not see the rally, holding on for too long. I believe that something similar is happening here. There is a lot of investments being planned ahead by the Tata Group company. Particularly look at the way the airlines is being targeted by the Tata Group company in terms of growth and consolidation. Probably Tata Investment Corporation would have a role in that ahead. And you also have the digital side of the business of the Tatas growing appreciably well. Particularly the consumer-facing one. These businesses require a little bit of growth capital, and I believe Tata Investment Corporation is the one that is likely to provide that ahead.
Mantesh, so very quickly, if you're an investor with moderate risk profile who already has gone out and bought Tata Investments, the stock is up 300% in the last 6 months, would you recommend selling the stock?
So, it's risk profile to risk profile, right?
Yeah, so that's why I said moderate risk profile.
If you are holding a single stock, obviously it means book profits, right?
Okay.
But if you're not holding a single stock, most likely Tata Investment Corp doesn't exist in many portfolios, and even if it does, it would have existed with a very small fractional holding kind of thing. It's better to trim the holding.
Okay. Thank you so much, Mahantesh, for joining us today. You may see quite a move in Tata Chemicals and other Tata Group stocks today. But remember, fundamentally, nothing changed a week ago. Nothing changes today. As per the rules of this moment, they still have to list by, September, October 2025. So that hasn't changed. We don't know officially from the company if they have a way of avoiding this completely. So keep that in mind. Sudeep Shah joins us now. He is Deputy VP Head Tech and Derivative Research at SBI Cap Securities. Sudeep, very good morning to you, and I'll come to you, of course, on Tata Chemicals and what you should do there. Let's begin with that.
Good morning. Absolutely, it's the talk of the town now. Tata Chem, Tata Investment, and all these 3-4 Tata names. Now, but I would just like to, before we speak about what to do in these stocks, let us understand what has happened with the Tata stocks in the last 4 or 5 sessions. It's especially Tata Investment and it's Tata Chemicals. The rest, if you say TCS, Tata Motors, or Tata Consumers, all these stocks were in a decent uptrend, and with or without this news, all these stocks, Tata Motors and everyone was decently placed. Now, this IPO news is only, I feel, affecting 2 or 3 companies such as Tata Chem, Rallis, or Tata Investment for that matter. And to just take Tata Chemicals first. Now, what has happened in Tata Chemicals is, like, in the last few months, we had seen Tata Chem making a lower top, lower bottom. The stock was either in a range between, say, 1150 on the upside and 900, 880 on the downside. Since last, I guess it's from September, October 2022, it has been trading in this range, and a lot of short positions was built. So with this news, when this has come, maybe in the first week of March, on the 3rd or 4th of March, so that has led to sharp short coverings. Apart from the valuations game in Tata Chemicals with respect to the Tata Group IPO, it is the short positions which have got squeezed, I feel, and this has led to a big rally here. So I feel with the news that has come in the weekend, we might see some cool off in Tata Chemicals. But overall now, with the range being broken on the upside, I feel levels of 1220, 1230 will now act as crucial supports, because these are the previous swing highs which have been taken out by a huge volume. So I feel 1220 on the downside for Tata Chemicals will act as a strong support. And regarding Tata Investments, now, nothing's fundamentally changed in the company or on the results front. It's just that the IPO news has made this talk of the town. And from the current levels, if you see, it's November 2023, the stock was in around 4,000, 4,050 levels. It's almost double in less than 3.5 months. And this has never happened in the history of Tata Investment Corporation, such bigger gains in such a small time. So I feel this stock could now cool off, and fresh buys are not warranted at this level, even if the stock hits a couple of lower circuits or goes down till 8,000, 8,500 levels. I feel one should avoid Tata Investment Corporation and look for stocks such as Titan, Tata Steel, TCS, Tata Motors, which are doing predominantly well, irrespective of this news.
Right, so even if it hits a couple of lower circuits, don't buy right now. 1220 is the support Sudeep sees. Sudeep, we need to come back, get your picks, and of course levels for the Nifty, Bank Nifty, but that's after a very short break. Stay tuned.
Hello and welcome to NDTV Profit. Today we will talk about tattoos and the worth of this market. The history of tattoos in India can be traced back to prehistoric times when tribal people were captivated by drawings on stone or wood walls. Their attempt to replicate these figures through needles gave birth to the practice of inking skin. Over the course of time, tattoos were embraced by tribals as a mark of bravery, war, religious beliefs, customs, marital status, protection from the male gaze, and so on and so forth. Today, in 2024, tattoos have become a means to express thoughts, individuality, personal experiences, and sentimental designs. The industry is estimated to generate over 20,000 crore rupees per year. What is driving this growth? One of the key drivers behind the growth of the tattoo market is the rising demand for customized and unique designs. Improved technological equipment for making advanced, safer, and painless tattoos have boosted the market. The laser technology for removal or modification of tattoos have also added to the surge. Increased exposure and promotion of tattoo designs on social media have led to widespread influence of tattoo culture on the youth. Take a look at these figures now. As per Fortune Business Insights, the global tattoo market is projected to grow from $2.04 billion in 2020.
Welcome back. You're watching India Market Open. Implied Nifty indicating to a pretty solid start this morning. A 100-point gap up cannot be ruled out in the first few minutes of trade. Of course, remember the week will be one of consolidation. Minor profit taking after 4 straight weeks of gains coming in for the index. Sudeep, before we go into pre-open trade, you want to take our viewers through your top trade recommendations this morning? Sudeep, I can't hear you.
Yeah, sorry. So the first trade that I have is on Larsen & Toubro. See, while the markets have been moving steadily in the last week, we have seen large caps outperforming. So Larsen & Toubro, L&T was in an uptrend. Post that, in the month of February, we have seen some consolidation, profit booking, and once again the stock is now back above its 10 and 20-day exponential moving average, and the daily, weekly, and the monthly chart setups are quite strong now. So I feel from the current levels, L&T can be bought with 36.20 as a stop loss and 3800, 3830 as targets. Now, the second stock that I have is PNB. In the last 1 week, we have seen PSU banks once again outperforming, and the indices have crossed and sustained above its February month's swing highs. So overall, I feel there could still be a decent bit of action in PSU stocks, and PNB from the current levels is well placed to capitalize that move. In an uptrend on all the time frame charts, and even from a shorter term perspective, the stock has sustained above its important key support zones around 124, 125. So this can be bought with a 125 stop loss and a target of 138 and 142 on the upside.
Do you have a trade on Nifty and Bank Nifty this morning at all?
I feel, post this gap up opening, indices could consolidate, specifically if we say Nifty, it could consolidate between 22,400, 430 on the downside and 22,600, 630 on the upside. So it would be more of a consolidation day initially, and more strength I feel would be there in the Bank Nifty, because this index is specifically outperforming Nifty 500 by a margin. Now, if you see it on a ratio chart, it's creating higher highs on the relative strength chart. So I feel Bank Nifty could still outperform, and Nifty could consolidate post the gap up opening.
Right. It looks like it's a flat start. The Nifty is higher by 76 points, actually. Pardon me, not a flat start. So it's not looking too bad in terms of pre-open trade. Slightly lower than what the implied Nifty was indicating too. A quick check on Tata Chemicals in pre-open trade and JM Financial before we move on and continue our conversation with Sudeep. 10% cut in pre-open trade. Now, that's not looking good, but I don't think that's how it's going to play out this morning, or not that severe, at least, the pain. JM Financial down 8%, not looking as bad as Tata Chemicals, which really has no negative news flow in that sense. So it was, the stock, of course, ran up on reports by Spark, and now on back of other reports that an IPO may not be likely for Tata Sons. The stock is correcting 10%. Let's not forget, in both those scenarios, the IPO was not expected for the next 18 months. So bulls were really just getting ahead of themselves on that counter. If I can get Tata Motors and Tata Investments as well, I think Tata Investments also might take a bit of a break this morning. And it is finally, after weeks and weeks of outperformance and hitting upper circuit, this is the first day in nearly 2 months that Tata Investments is seeing a gap down of 5% in trade. Tata Motors is looking flat. You've also got a few other names like JM Financial that are seeing a cut of 7%. The circuit, remember, has been revised on JM Financial to 10%. So that could explain why you will see losses being capped on the counter. Tamanna, it's it's harsh, 10% on Tata Chemicals. I mean, in their defense, they never said that they were going with an IPO, never did they deny it or contain it. The stock went up on expectations, and the stock is now declining again on speculation.
So ideally, there should have been a statement, on the back of all of this, that whether there were plans or not. And I think the expectation also from the Tata Group, largely that if you need to come up with an IPO, which means more scrutiny, you will not run away from it. I just want to mark out Torrent Power. So they've got an LOA from the Maharashtra government. That's up this morning. It's an LOA worth 1540 crores from the State Electricity Board. Torrent Power is having a pretty decent morning. Let's pull up M&M as well. There's a positive HSBC note, but not too much action, at least in pre-open. So as the pre-open rates settle, I just want to go across very quickly to Mahima to speak about a key brokerage note on the insurance space. Then we'll come back and ask Sudeep his view on it. So insurance numbers were out for the last month, and Jefferies as well as Citi have given its thumbs up to the Indian insurance space. Mahima, what are those notes saying?
Right, Tamanna. So, talking about Citi on India Insurance, well, SBI Life remains their top pick. They've said that tepid growth in terms of ticket size has been observed and single premium mix is down YOY. Well, they've also said that Q4 FY24 estimates APE, in terms of APE, have remained benign and expects medium-term re-rating underpinned by tailwinds. These tailwinds can be in the form of pension landscape, channel diversification and product innovation. And they've said that strong growth in individual regular pay policies have been observed. Now coming to individual stocks, HDFC Life, well, HDFC Life's individual AP growth surpassed that of the private peers after 4 months now, and performance of non-HDFC bank channels relative to private industry will be a crucial monitorable. Then moving on to ICICI Prudential Life, well, individual AP market share were flat YTD. Trends in premium mix, channel-wise sourcing strategy and cost ratio will remain the key monitorable in this. For Max Life, they've said that Max Life has outperformed its peers. However, if we see the overall 4-year on CAGR basis, the individual AP growth was at 12% versus that of 16% of peers. And for SBI Life remains again their top pick, and SBI Life continued to witness market share accretion. And lastly, LIC, where LIC continued to recoup market share in group business. So this is what Citi has to say about the insurance business.
For that, Mahima, Sudeep Shah with us. I'm also joined now by Deven Choksi of DR Choksi Investments. Very good morning to you, Deven Bhai, as well. Let me come to Sudeep very quickly on some of the insurance picks, and we're going to be expecting a movement over there. And SBI Life, maybe you don't talk about specifically, but ICICI Pru, LIC, anything that you like there, Sudeep? What would be your play here?
Yes, so out of all these names, HDFC Life is a bottom reversal pick. It's not that trending on the upside, but I like ICICI Pru, which has done really well in the last several sessions. It has even given a decent breakout of the falling trend line that it has started since July 2023. So it's a breakout there on the short to medium term charts from a ICICI Pru perspective. So that stock looks good with 565 as a support, and on the upside, I guess the stock could go all the way up to 625, 630. LIC is rebounding from a key support. Now, let's not forget there was a big rally in LIC in the prior few months. So it has just retraced a bit. The overall long-term charts are still bullish. So post that bullish move, there has been a retest, and I feel with this news, 1000 zone 995 could act as a strong support, and we could see the resumption of a rally in LIC. And this also could be bought with a 990 stop loss on the downside, and on the upside, 1100, 1150 levels look likely.
Deven, good morning. It's Amina. Deven, we would have started with the markets on any other day, but this morning, I think it's all about Tata Sons, or rather has been all weekend. Yeah. First, that report sparked by Spark to its private banking clients how Tata Chemicals was a good way to play the Tata Suns IPO. And then, of course, news reports on the weekend which said that Tata Sons is considering other ways than an IPO to, of course, fulfill the regulators' requirements. Tata Chemicals on back of that gained 40%. The stock in pre-open is down 10%. I mean, this is this is a classic case of how retail investors get stuck in counters without much know-how. I mean, Tata Chemicals is struggling with falling soda ash prices. If it wasn't for Tata Sons as a trigger, this stock would have probably declined 10% as opposed to gone up 40% before the decline.
Yes, I mean, good morning. And you are spot on, actually. The soda ash, the glut has happened, I think, because of the China dumping. And to a greater extent, I think the expectation is that I think the stocks getting cleared sooner than later. But that is still far away. So maybe if you are counting next 4 quarters on the fundamental side, maybe I think we could be seeing some amount of stock clearance happening on the imported side at this point of time. And maybe next quarter onwards, our domestic companies would start stabilizing on production as well as on supply. So you're absolutely right. I think the fundamentals are still catching up. I think they have not yet done any change out there. Unfortunately, I think the stocks have seen, I think, a very sharp decline in previous quarters. Now, I think with this news coming in, probably I think the expectations have started increasing. Also because of the fact that Tata Chemical is per se holding the other Tata Group companies in their portfolios. So to a greater extent, I think the valuation unlocking could mean that I think some better numbers coming also even in the balance sheet of Tata Chemicals. So this is a guesswork. As I see it, I think neither I would have calculations ready on this particular subject because there is no clarity. But that's where I think the market is a little bit more, I think, gung-ho about. Should this unlocking take place, I think the market believes that I think the valuations would probably start getting re-rated. I would be the person who would rather like to look at the event to unfold and then possibly, I think, look at the possibilities of creating the valuation unlocking. Till that point of time, I think one should stay put on, or one should not, I think, get into the crazy rush of buying the stocks in the portfolio. Yeah, eventually, some good companies in the Tata groups, they will perform well. But I think not on this news, I think that one should buy into the portfolio.
Right, yeah. So, okay, that's the Tata Chemical story. It is off the day's low point, at least in pre-open trade. But Tata Investments as well. Devin, do you have any idea what's happening on this one? It's up 90% this month. It's the first morning when you're seeing a little bit of a gap down and an opportunity for investors to get in, if that. Would you recommend it?
Again, I think not sure about the calculations, the valuations, and I think on the low liquidity, the stock price has gone up. So one will remain a little mindful about, I think, all the possibilities. I would buy with clarity. That is fundamentally very important to me. So I think one would really wait for the clarity to emerge on the decisions taken by the Tata Group. And that's where probably I think one will have to wait before buying into the portfolio.
You know, the other set of companies that we should look at this morning and as pre-open rates have settled down is your healthcare space. You're seeing Max looking pretty good. Max Health, Oro Pharma, Alembic, Torrent Pharma, Abbott as well. Devin, are we seeing a bit of a defensive play today? Because once pre-open rates have settled as well, you're seeing the same sort of range-bound trade that we may see all day today.
So as I understand, Tamanna, I think the market is trying to play the rotations, the sector rotations, the stock rotations. If I think many of the frontline pharma companies have achieved the price goal, which otherwise up till now they have been struggling with. So in recent months, I think these frontline pharma companies have actually achieved the appreciation which they were supposed to get it, I think, for the full year. I believe that I think there's some amount of profit booking taking place, and I think the mid-sized pharma companies are attracting that money into it. So our markets currently are driven significantly by the liquidity movement. Entry and exit also depends significantly on entry and exit moves. So in my viewpoint, I think neither the mid-cap, mid-sized pharma companies or for that matter frontline pharma companies are doing anything which is exceptionally different than what they've been doing in up till now quarters. So to a greater extent, I think fundamental story remains intact. But whether I think this price action justifies, I would think that it is largely because of the shifting of the funds from one end to another end, for which I think they are getting the tailwind. And I think the stock price is around rally at this point of time, more technical in nature than anything to do fundamentally in nature as far as I think the outlook is concerned in the business.
Deep, very quickly, 2 minutes, two stocks, NLC and Rail Vikas Nigam, both are expected to see a pretty solid gap up. If we do get a gap up, would they make good trades for the day, you think? Would you think there would be buying opportunity despite a gap up on both those counters?
Yeah, see, just we'll take both the stocks one by one now. Looking at NLC's chart, that is much better placed than RVNL. And if you see NLC, it has taken support at a very important level around 222 to 23 levels. And it's now crossing above all its short-term moving averages. So I feel from a chart standpoint, NLC looks better placed. And till 239, 237 holds, we feel that the stock could move up to 255 on the upside. The second stock, RVNL, it's at its important support. Even if it gaps up around 260, 262, I feel it should cross 268 for a big move up to 300 levels. So till the time this does not cross 268, 269, there were several instances where it had taken resistance at this zone. So I feel 270, 268 zone is very critical for the stock to cross for the resumption of the up move that we had seen in the last December.
Right, that's the call coming. RVNL and NLC are going to be two stocks you want to track in early minutes of trade. It's expected to be a positive start, more or less an expected line, so no surprises there in terms of the kind of opening that the street is going to see. 22,500 is the kind of range you would see in terms of today's trade. Well, stock-specific action will drive the street. Rotational buying is what would keep activity up and alive in terms of the Nifty movement. Not too much expected action from the benchmark itself. It's going to be stock-specific trade in the broader markets that will be keeping up traders' activity in today's session. But a quick check on how we've opened up. We are reacting to bunched up cues from global markets as well. And it's actually not half as good as what implied Nifty was indicating too. We were expected to see a gap up of 100 points, but this is actually a downside bias in terms of trade. So like I said, there was an expectation that consolidation and profit booking cannot be ruled out. And that's really what's happened first thing this Monday morning. The Nifty itself is lower. Bank Nifty is trading once again much lower, 150 points, underperforming the benchmark in a big way. Broader markets, interestingly, are doing better than the benchmark. This is a corollary from what we saw in terms of last week's trade. The mid-cap and the small-cap index was seeing some pressure. Small-cap index, after a 3% fall last week, is up marginally this morning. The mid-cap index also not doing too badly in trade, but the Sensex and the Nifty both trading slightly lower. Like I said, a morning of consolidation is what we've had in terms of trade. The breadth of the market's not too bad. So that is a little bit of heart that bulls will be taking from. Let's not forget the Tata Group counters are the ones that are putting pressure or would be putting pressure on the index as well. Well, the top losers this morning is Tata Motors. Remember, they also own about 1 to 2% stake in Tata Suns. Tata Steel is well trading lower. Metals generally are seeing a weak morning. You've got Power Grid and BPCL seeing some sort of correction. Indusin, Tech Mahindra, LTIM are some of your losers. On the gaining side, SBI Life, so insurance is looking like a good play this morning. SBI Life is up 1.5%. Hero MotoCorp is looking good. Ultratech, Bajaj Twins, UPL are trading higher. No real trend, no real triggers in terms of what you're seeing on the Nifty 50 at least. So no stock-specific news is driving some of these counters, apart from insurance and Tata Group companies that are reacting to news flow. But apart from that, Tamanna, surprisingly, it's very, very somber this morning, contrary to what we saw in implied Nifty or were expecting, at least in the first few hours of trade this morning.
But absolutely. But think about it. There is so much of, trepidation and uncertainty on so many stocks. You have a negative Bernstein note on SBI. You have no real clarity on what's happening with financials, what the spillover impact of JM Financial is, and maybe all of that also playing out to some of that nervousness. But let's look at Tata Chemical, Tata Investment and Rallis to start off with and see what's happening there. Yes, down on all of them. We also saw that on the Nifty with Tata Steel, Tata Motors. So you're seeing the Tata Group in focus over here. And this is essentially now that there are reports, remember no official statement from the company yet, that they will look at ways to avoid listing by 2025 September, by the way. Anyway, this was a long shot. JM Financial is one that we should look at this morning. A fresh whammy, this time from SEBI on NCDs. And what they have talked about is very serious. If you go through that SEBI note where JM Financial was funding people to invest in NCDs and then buying on the other hand through their brokerage arm. So that seems to be a problem. That stock 8% down again. M&M is one we should look at. HSBC has maintained a buy with a target price of 2,300, mildly positive there, nothing too exciting. We'll pull up the insurance pack and we saw SBI Life doing well on the Nifty. The Feb figures are good. There's a Citi note out as well. 2% up on LIC. ICICI Pru is up about 4% up, but we should look at others. SBI Life and HDFC Life also doing quite okay when it comes to the insurance play. I'll quickly just pull up Z Entertainment, and we didn't quite cover this in our trade setup, but it is a newsmaker. There's a management rejig. Rahul Johri is out. The investment officer now reports directly to Puneet Goenka. So they're trying to make some changes there to shore up investor confidence. Their stock up 1.5%. Torrent Power is the other one, 1,500 crore LOA from the Maharashtra government. In fact, the state power unit, and that stock up 3.5%. So no massive moves, stock-specific news perhaps, but the Tata Group companies continue to be the flavor this morning, Samina.
For all the wrong reasons, Tamanna, though, unfortunately, those counters are getting hit pretty badly. The Nifty also at 22,499, 22,500. It seems like it could be a morning where we've started off quiet, but see some buying that emerges as we go into the second half of trade. Tamanna's highlighted pretty much all the counters in focus, but I'm just going to add a few to the list. I'm not sure if those were covered, but NLC on back of an order win, Rail Vikas Nigam, that was already mentioned. Interglobe Aviation on back of the promoter reducing its stake in the company is seeing some pressure. The stock is down 2.5% to 3% each. You've got stocks like Lemon Tree, despite the fact that they are on an expansion spree, the counter is trading weak. HAL, I want to pull that one up. They had a big order win last week, and the stock has gained really well. It's up 11% in the last 5 odd trading days. This morning as well, a 2.5% up move coming in on that. ICICI Pru from the broader markets is looking good, 3.5% there. You've got Suzlon Energy seeing a pretty good gain of 3.5% there too. You've also got a few other counters that are moving in terms of today's trades. So if I can pull up Suzlon, like I said, 3.5% gain on Suzlon is what we have. To add to that list, you've got Alok Industries, it's up 5%. Macro Tech, remember they concluded their QIP last week. The stock seeing a big move this morning, 6.5% on that one. Paytm is up 2.5% as well. Z, while we're at it, there's been some management rejig at Z. Interesting to see how the counter is doing, 1.5% high. But the morning definitely belongs to insurance companies. The likes of GIC also looking good. Ethos up 4.5%. The Nifty, though, Tamanna, is somber. It is sulking despite the fact that there are a few gainers because the losers clearly are taking all our attention this morning.
So technically, it opened and hit a new high. It's I would say, not very pacey, but not exactly sulking. Very muted. Flat with a negative bias at the most. So, yeah, this is a kind of morning for perhaps consolidation as well. Let's get quick views from Sudeep and Deven on what the opening has looked like. Sudeep, anything exciting that you've spotted since we've opened? I'm seeing real estate stocks are doing not too badly right now. Macro Tech up about 6.5%, 7%. Again, a fundraise over there, which could be driving the counter.
Yeah, so looking at the real estate stocks, DLF, Macrotech, both these stocks are right now breaking out on the upside. DLF also looks good for 960, 970 on the upside, and Macrotech also has broken all its important resistances. And I feel from the current level, that stock also could do well and go up to the levels of 1300, 1320. I feel if someone is making a fresh entry here, then should keep a stop loss of 1220 on the downside for Macrotech.
Any top picks for the day, Sudeep, looking at how, the charts have opened? And is there anything that you would touch in the Tata Group pack right now? Because it's not just Tata Chem, of course, 10% down now as we speak. Tata Tele, Indian Hotels, all of the companies are seeing that pressure. Anything that you would pick up right now, or you would stay clear for some time?
See, if I have to pick up some stocks from the Tata Group, then as I shared in the morning also, that I feel keeping both these stocks aside, there are few stocks such as TCS, Tata Motors, which still are decently placed at the current levels. Now, even TCS is broken out on the upside. It is trading near to the upper end of its consolidation band. And I feel that is unaffected by this news. So that can be looked upon. The second stock that we can look upon is Tata Motors, because even from the current levels, I feel that the trend is firmly on the upside. It is just that this news surrounding the Tata Group is giving a good buying opportunity, a good dip at lower levels. And it's just 1% in case of Tata Motors right now. So I feel a level between 1015, 1025 would be a decent entry point with a stop loss at 1000 rupees.
Okay, so 1000 rupees stop loss. Tata Motors could be a good buy at this levels, and you're already seeing a bit of recovery there. Deven bhai, your take on Tata Group stocks and insurance stocks this morning. Are you seeing an opportunity in Tata stocks, and what would you do with the insurance play?
So I think the fundamentals of Tata Consumer, Tata Motors, they remain pretty strong. Tata still is giving a good amount of, I think, confidence, largely because of the fact that on one side, the input cost is under control. And on the contrary, I think it promises to improve going forward. And on the other side, the demand scenario remains pretty strong for the commodity per se. So all in all, put together, I think the Tata Steel as a commodity company, I think is showing a good amount of prospects for growth going forward. So selective companies within the Tata Group, they continue to hold good promise, including Tata Elxsi for that matter, or Tata Power for that matter. So we remain selectively bullish about the company and their prospects. And any corrective downsides, I think one which we got recently, Tata Power, I think are the opportunities that we probably consider for adding them to the portfolios.
Right, just very quickly, if I can get PVR Inox on the screen. Remember, we had an F&O guest give out a buy call on this one. One very important factor to note for all our viewers is Amit Goel indicated that on a closing hourly basis, 1380 is an important level of support. So if you are tracking this counter, watch out for 1380 on an hourly basis to see if the stock should be if you should be considering cutting your positions. But until then, it remains a long trade by Amit Goel. Apart from that, Sudeep, I'm going to come to you. You had two buy calls on PNB and L&T. A quick update on both those counters in terms of trade, because the viewers are listening and executing those trades. It would be nice for them to know how do you feel about it after the markets have opened.
Absolutely. PNB, I feel, has even shown more strength post-opening, and it is trading at its highest levels and closer to 132.60, the highest level on 16 Feb. So even all the lot of other PSU banks are also showing positive traction. So I feel overall as a pack, PSU banks can still be looked upon, and specifically PNB. The second stock which I have shared is L&T. So if you see L&T also, that stock also is decently placed, maybe 0.5% down, but overall 36.20, 36.30 seems to be a good support zone. And I feel from the current levels also it can be added. And the upside levels are intact, closer to 37.40 and 37.80 on the upside.
All right, we'll take a very short break. Thank you so much, Sudeep and Deven, for speaking with us today. We're going to take a break, but we're coming right back. Piper Serica's Abhay Agarwal joins us on the other side to take you through what your next move should be in this market. Stay tuned.
Amul has completed 50 years in India. PM Modi will attend the Silver Jubilee celebrations of the Gujarat Cooperative Milk Marketing Federation, the owner of Amul. At one point of time or the other, we've all grown up with Amul butter or milk for sure. The famous Amul girl created in 1967 is family. We all recognize her. But as the brand grows 50 years old today, do you remember the full form of Amul? It is Anand Milk Union Limited. From producing 250 liters of milk per day since the time Amul was formed back in the mid-90s to today, where Amul has over 36 lakh dairy farmers and produces nearly 300 lakh liters of milk per day, the brand has had a long journey. The story goes way back in time. In the 1940s, dairy farmers were worried. The middlemen exploited their ways of profitable income, and a poor milk production system made their living difficult. Tribhuvan Das Patel and Verghese Kurian identified these issues and helped in the formation of the first milk union called Kaira District Cooperative Milk Producers Union in 1946. The cooperative model gave farmers direct ownership of the dairy industry. The union helped them process, market and sell milk and milk products without the interruption of intermediaries. And it was in 1955 that this union chose a brand name for itself called Amul, which means priceless in Sanskrit. And then in 1973, Amul Dairy, along with 16 other district cooperatives, formed the Gujarat Cooperative Milk Marketing Federation, which has now completed 50 years in India. Amul also started India's white revolution that made our country the world's biggest maker of milk and milk products. The brand follows an umbrella marketing technique which has helped GCMMF prevent association clashes and keep an open door for the patrons to coordinate in creating items. As per a report by Statista, the annual sales turnover of Amul from 2011 to 2023 has consistently risen, recording about 55,000 crore rupees of turnover in 2022-2023 alone. And did you know, Amul has also held a Guinness World Record for having the longest continuous run of any advertising campaign that has ever taken place anywhere in the universe. Amul Doodh Peeta Hai India and Utterly Butterly Delicious will always strike a chord. Let us know which famous advertising phrases of Amul do you remember.
Welcome back. You're watching India Market Open. It's a tepid day for the markets. Range-bound trade completely flat. The Nifty just about 5%, 5 points down, just completely flat at this point. Tata stocks are the ones which are in news. You're seeing some signs of life in, life insurance companies because of good Feb numbers. Telecom not doing too badly this morning, but overall, no great direction. Now, what should you do in a market like this? Abhay Agarwal, founder of Piper Serica, is joining us on the show. Abhay, great to speak with you again. Just wanted to start with, I would say, the news of the day or the newsy pack of stocks of the day, which is on the Tata Group. Earlier, we were asking our experts whether this is an opportunity to buy into some of these companies, well-run companies, most of them well-valued companies, and now a slight negative sentiment because of news flow based on speculations. How would you look at the events around Tata Chemicals, Tata Investment in the last few days?
Yeah, good morning, Tamanna. Great to start the Monday morning with NDTV Profit. We have been watching this whole Tata story unfold. We haven't participated in it because, frankly, there's too much of speculative interest that comes in from, some of the short-term investors looking for an interesting play for the short term. And the problem is that it's not really limited only to Tata Group, Tamanna. It's, we are seeing that in a market that is not topping out or getting into a consolidation zone. There is a lot of news-based price volatility, whether it is positive news or negative news. There is tremendous amount of volatility that I think generally the investors should be careful about, placing their bets on base of a certain expectation of an event. And I think this is a classic examples. We are very positive on all of Tata Group companies. I think they are run very well. Valuations are not stretched. So from a long-term investment perspective, all of them are good, but buying them only on the basis of this news is I think a little premature, I would say, Tamanna.
Abhay, hi, it's also Samina joining in. I'm going to move focus on the Tata Group companies to all the action, the overdrive SEBI has been in, and of course, the regulator in every way. JM has been barred now from being the lead manager on issuances of NCDs. The stock, of course, is reacting negatively for very obvious reasons. But if I have to extend this conversation, do you think this could have a contagion effect on other capital market players, and we could see some pressure building up in terms of what the regulator has been doing?
Yeah, Samina, good morning. This is so. I think first of all, I would like to compliment both our regulators, RBI and SEBI, that they have been on the ball. They have been very proactive. They have used data science, data analytics, using technology very well to figure out discrepancies. Because what they are reporting now, the data that they are using to back up their actions, is clearly based on pretty deep analytics. It is not possible for somebody to humanly do that. Now, in every sector, and I would not go to the extent of calling players good players or bad players. I think there could be oversights, there could be genuine mistakes. I don't know. But clearly, this action is going to give all capital market players, all capital market intermediaries, anybody who we call capital market infrastructure companies, a pause for thought to say, don't get carried away. If there is a law, stick to both the spirit and the wording of the law. Don't interpret it to suit your own convenience. So I think in the medium to long term, this is a great move. It will clean up the capital market otherwise is pretty strong. So I'm not worried about the capital markets in India, but there is always room for improvement, and there's always a room for pausing to take corrective action. So I think this is what it has done. And, so for longer term investors, it's absolutely good. For short term investors in some of these stocks, they may feel the pain. But I'm sure these companies are strong enough to recover from this and get on.
Does that mean, Abhay, the stocks like IFL Finance, JM Financial would be on your buy list? I mean, at some point, they do become attractive, I'd imagine, right? The price, the risk reward becomes favorable for some of these players. And also in that same breath, you do own Angel One and CDSL. Is it time to take some profits off the table on back of stretch valuations there?
Yeah, so Samina, we also have CAMS in our portfolio, and we see Angel One, CDSL, CAMS, and these have been multi-year holdings. I think we have had them since all of these stocks came up with their IPO. They have done well for us, and we see them as very core participants of India's capital market growth story. So we are, let's say, at about $4 trillion market cap. We're going to $6 trillion market cap over the next 3-4 years. We're going to go to 10 will become 12. So the direction is quite clear. Now, in that situation, if you have companies like these that we named, and none of them are buy recommendations, by the way, as a disclaimer, but directionally, if you look at them, the leadership positions have already been created. Angel One has a 20% market share in retail broking. You have CDSL in a dual player market along with NSDL. You have CAMS along with K Fintech in a dual player market. So industries are consolidated. Valuations may look stretched, but that's also dependent on the predictability of earnings growth and also the quality of earnings. So that is why I think if you need to back India's capital market growth story, I think these are great choices. On the first question, whether we look at some of the fallen stocks, yeah, absolutely. We are always looking to get in if there is a overreaction technically, and that gives us a buy opportunity. We would always be open to that, Samina.
Just a quick look at what's happening with NMDC. Singapore iron ore futures have, I would say, crashed 4.5%. And you're going to see a bit of pressure there. Let's pull up NMDC steel as well. 2.5%, 3% down on NMDC right now. Abhay, I wanted to get your take on the real estate pack. The index is looking decent today, led by a macro tech. There's QIPs, on offer for a couple of companies trying to raise money. But also what SEBI has done over the weekend by notifying small and medium REITs.
How much of an impact do you really see this having?
I think this is a good move. I think it allows smaller investors to add real estate in their portfolio in small units rather than subscribing to the big REITs which are focused only on commercial property or actually buying a house property. So I think this is a good way to create a new asset class and at the same time give money to the REIT managers so they can invest on behalf of investors in residential projects. I think it's a good outcome, a good opportunity that will become bigger and bigger. Also on the real estate part itself, the whole real estate sector has gone through a very extended consolidation phase, starting with the demonetization, then subsequently there was RERA implementation, and then the GST implementation. I think there were continuous series of changes that has completely restructured the real estate sector, made it cleaner, more transparent, and created it into a good asset class for investors to own these real estate stocks. And I think that's what we are seeing in terms of real estate stocks performance over the last 12 months. And I think this new edition of REITs for individual investors, I think it's a very, very positive move. I would welcome it. It allows even small retail investors to allocate to real estate in their portfolio.
Okay, so it is an opportunity for investors to allocate real estate in their portfolio. I don't know if 10 lakhs as an entry barrier is a bit high when you're talking about retail investors. Maybe that needs to be looked at, and real estate stocks may be a better option. Abhay, I wanted your take on the insurance play as well. LIC is losing market share, down another 520 bips in the month of Feb, but the overall AEP growth has been good. Even for the insurance pack, the numbers in Feb have been good, perhaps tempered by a year-end flood. But overall, do you like anything in the insurance space? What would be your best bet? And would it be life insurance versus general insurance companies?
Yeah, so we track insurance very closely, Tamanna, because we also have a private equity fund where we have made investments in some private insurance companies. Right now, we do not have any insurance company in our portfolio, and for the single reason that the valuations are quite stretched. So while insurance is going to be a long-term story, as just like capital market story that we discussed, but so far maybe we are wrong, but we have shied away from adding any of the large insurance companies in our portfolio. There is one standalone health insurance company, the largest one, that we are looking at closely. Maybe at some point of time we'll add it to the portfolio. But I think insurance is a very, very long-term story in India. Next 10 years, 20 years, it will just keep growing as there is product innovation, and as the regulator also gets the confidence that these companies can innovate and bring value to their policy buyers. So we track that space pretty closely, but again, the valuations haven't really corrected. The private companies are still at 4 to 5 times embedded book value. So we would probably wait for a better timing to add them to the portfolio.
Very quickly, what stocks currently feature on your shopping list? What is it that you're waiting to correct and go out and add to your portfolio? And also your top 2 holdings in your portfolio that you're currently still constructive on and maximum overweight on.
So one sector that I've been talking about and I think is going to see inflows this year is the large cap pharma space. And I think we have a couple of stocks, large cap stocks in our portfolio already. They are not our top holdings, but we will keep adding to them. And the reason for that is that, again, just like real estate, this is an industry that has consolidated for the last 4 or 5 years, finally seeing pricing improvement in the US, finally seeing reduction in raw material prices from China and locally. And also, product pipeline is very robust. Some of them have 150 products that will get launched from a single company in the US and in India. So I think this is one sector, the pharma sector, that can hit a purple patch this year. And the second sector, Samina, we are looking at closely is the agrochemical space. Again, small companies and large companies that cater both to Indian farmers, Indian agri sector, and the international markets. I think these are the two sectors that we believe there is a lot of value under participation, and we are happy to make our bet with a 2 to 3 year perspective.
Anything specific here, Abhay, you can add in these spaces, especially in large cap pharma when you're talking about, and in the agri space?
So in large cap pharma, again, not a buy recommendation. These are stocks in our portfolio. We have Dr. Reddy's and Divi's. We believe both these companies have done a lot of innovative work. Divi's more so because of the CDMO business that gives them an annuity-like income that keeps growing. And Dr. Reddy's for the reason that it has probably the strongest pipeline of launches over the next 12 months in US and in India. And then in the agrochem space, we have Bayer India, which is one of the largest players in Indian agrochemical crop protection space. And we have a small cap stock called Dhanuka Agritech. And we are in the process of researching more ideas in that space.
Yeah, so agrichem is looking interesting. Thank you so much, Abhay. Always a pleasure to speak with you. And talking about the pharma play, on the other side, we're speaking with Lupin. Stay tuned for that.
Hello. Good morning, ma'am. I'm speaking from XYZ company. Are you looking for a job or a job change? Have you been receiving unwanted calls from spam numbers? Are you tired of being offered new jobs, insurance schemes, or free health checkups? Well, today we will look at an interesting survey report by local circles on pesky calls that received 60,000 responses. Most unwanted calls are related to financial services, 54%, and real estate, 22%. In fact, the report has taken names. 40% mobile subscribers have identified Bajaj Finance as a top offender, HDFC Group as the second biggest pesky caller. The report reveals that 60% of people received 3 or more spam calls on an average day every day, and 92% of people registered on the Do Not Disturb list still get pesky calls. So is being listed on DND working? Clearly not. But the report also recorded a minute relief, as per which 6% people don't get any such phone calls. This relief comes after the TRAI directive to banks, insurance companies, and other commercial entities. TRAI is the Telecom Regulatory Authority of India. In fact, the Department of Consumer Affairs has constituted a committee comprising members of different regulatory authorities, telemarketing companies, and cellular industry to draft the guidelines to address the issue of pesky calls. So yes, pesky calls are still a worry, but there is a little relief too. Can you ignore them though? Toll-free numbers are identifiable, so institutions have found a new way. According to the report, calls from different mobile phone numbers that seem to belong to companies or brands have risen from 29% in February 2023 to 36% now. And look at the change in trend. Real estate selling has risen from 18% last year to 22% now. However, job offerings have decreased from 10% to 4%, and in the case of those selling financial services, the calls have slipped from 60% to 54%. So the bigger question is, will the nuisance of pesky calls end anytime soon? There should be a system where pesky callers are blacklisted at the Aadhaar level, so they have the risk of not getting a new SIM. Also, brands on whose behalf the contracted callers are calling also need to be held accountable by the Department of Consumer Affairs, so brands institute the right consumer outreach practices both with employees as well as third-party contractors. For more such updates, stay tuned to NDTV Profit.
Different people believe in different things. In cricket, some hail the king, some believe.
With a clean as a whistle record on US FDA inspections, a healthy pipeline of launches coming up, and some very interesting and impressive launches done over the last 12 to 18 months. I think Lupin has come out of the pharma pack smelling like a bed of roses. The question only is, as the conversation shifts to reducing pricing pressure in the US and more, what can happen to the pharma space at large, and how would Lupin fare within that? We get in Mr. Ramesh Swaminathan. He's the Executive Director and Chief Financial Officer of the company, about the prospects for calendar year 24 and maybe beyond. Mr. Swaminathan, good having you. Thanks so much for taking the time out. I would love to understand, how do you think about the space? Because when one looks at your performance, it is not depicting what the space entirely has gone through. Sure, most generic pharma companies have done well, but you've done exceptionally well. So first, let's start with, how is the industry, how are the industry prospects looking to you?
Firstly, thank you for having me on, and a very interesting question that you're presenting to me. So let me roll back the clock a little. Over the last few years, the industry dynamics have changed quite a bit. And if you look at, what was perhaps an El Dorado for all the companies, this is really America, it's turned out to be a bit of a famine, in recent times, more because the fact that the OSD business was actually undergoing a big, there's a lot more competition. It actually arose because of the fact that there was channel consolidation, and there's a lot more entry of a lot of manufacturers from India itself, and both actually contributed to, in fact, in some ways, a price erosion of a very different kind. It is also the changes that were brought out by the US authorities in terms of GDUFA that actually meant expedited approvals and the like. So all of this actually meant that there was a lot more price erosion, and what was actually, as I said, a feast for quite some time turned out to be a bit of a famine. We were also impacted in some ways because of our, OAI situation across various factories and the like. Then came in COVID, which actually impacted all the companies. And there was, of course, no inspections happening at that point of time. And that's where we actually touched on nadir, so to speak. In the last few years, Lupin has been focusing on three things. One is getting our record right on the factory front with the regulators, and there, as you very correctly pointed out, we've done a fairly good job on that. There are a couple of more factories to go, but it's a question of time. The second, we actually focused a lot on getting our cost structure right, and I could talk about it at length. And third is, we wanted to get our buoyancy back when it comes to the top line across various markets, and that's where we actually did a fairly good job, and the results are there to see. Speaking about, in fact, the cost front, we did a number of things. Firstly, we focused on what we, the businesses that we actually wanted to close down, which are not making monies for us, is essentially the specialty business in America. We also cut down on, in fact, the NCE spends, because that is not yielding the results, whilst the risk is what they are. We also looked at, in fact, a lot of inefficiencies across the system, in terms of looking at, in fact, the gross margins, worked on, in fact, alternate vendor development, looking at routes to synthesis for various molecules, looking at productivity of labor from potentially the factory end. So we rationalized a number of people out there. We rationalized people at the R&D end and so on as well. And we also added a number of people on the ground in terms of the sales force in America and other markets where we thought it was important for us to do so. And all of this actually have started yielding pretty good results. On the top line front, whilst we had a very impressive number of products that we wanted to bring to the table over time, because of the fact that we had OAI across various factories, we are not able to kind of launch it because we were not getting the approvals also. And over time, they lost their potency. But in the meantime, we had also pivoted to more complex products because the industry was kind of pivoting to that. And we have been very successful in focusing on the respiratory portfolio, and going ahead on the injectables and the like as well. And of course, in recent times, we've had pretty good launches, which brought the buoyancy back when it comes to the American market. We launched, in fact, 40% of our turnover in America today comes from the respiratory portfolio. We had Albuterol. We also had, in recent times, we have had Spiriva. But we have we bought into brands like Zopinex. We have Brovana, which we brought to the table a few several quarters ago. And likewise, we did the same thing across various of the markets. We actually see respiratory and injectables as being global platforms, and we would like to lever this portfolio across various markets. In Europe, for example, we have Foster, and that was first introduced in UK, and over time we kind of the generic version was launched in various of the markets as well. So that pivoting has really helped us to kind of grow the margins, and I would think going forward things are only going to be better.
Could you explain that? I mean, one, there are two parts to my question actually. One, having a great control on the cost structure is welcome if that is accompanied by maybe reducing pricing pressure or better pricing as opposed to just price erosion, that only aids. Now, the conversation has been around mild price erosion. To your mind, because this is such a cyclical business, are we at a stage in the cycle from where we could move from a mild price erosion to maybe better pricing as well, or is it difficult to predict, especially in the US market?
So I actually addressed some parts of it in my previous answer when I spoke about the fact that there has been channel consolidation, and that obviously meant the prices were eroding. So there are other factors that I spoke about also. But things are changing a bit because a lot of companies that had got into America thinking that it's going to be an Eldorado forever, and saw that the returns are not so much really. So to the extent they started shedding their portfolio, and a lot of biggies also started doing that because a lot of the products had turned to to inconsequential margins, so to speak. And it's not very different with Lupin. We also shed some parts of a portfolio. So much so that there was actually a shortage of products in America. Even as the date that we're speaking, it's close to about 350 odd products. It's also come forth because of the fact that a lot of companies closed down because, as you would know, inflation was prevalent across the globe, including America, and interest rates are rising. When interest rates are rising, a lot of those companies which had levered themselves from a debt perspective found it unviable to carry on business, and that meant factories are closed down. And because of a combination of shedding a portfolio and the closing down of, in fact, supply locations, meant that prices were a lot more stable because of the supply situation itself. That's hopefully this will stay this way for some time, given the fact that it's not going to be easy for companies to kind of open up newer factories and the like as well. And people have shed their portfolio. It's not easy to come back again. But I mean, as I said, it's still early to kind of predict that, because essentially, there are more than about 150 producers of generic products applying for the American market. And for any molecule, we are looking at 20, 25, 30 players, so to speak. So even if the figure comes down by half, it's still going to be pretty intense competition. So I am, whilst I'm pretty hopeful and, I would think that this benign regime would certainly stay for some time to come. I need to take it, on a quarter-on-quarter basis. As of now, it looks like it's going to be stable, but you never know for the medium term or, for that matter, the long term.
The farmers' protests have been making headlines. Indian farmers have demands such as legal guarantee on MSP, pension and debt waiver, no hike in electricity tariff, reinstatement of Land Acquisition Act 2013 and more. But while the protest becomes important from the point of view of elections and politics, it's not just India that has its farmers agitated. The streets of Spain, Belgium, Hungary and Poland have been roaring with protests by farmers too. Around 1,400 tractors took part in a protest in Poland and roads were blocked across the country. What do they have a problem with? Rising production costs, falling sale price, stringent regulations. They say that the European Union is not doing enough to stop cheap imports from Ukraine, which is affecting the demand for local produce. They are also not happy with the European Union's Green Deal that's designed to zero out pollution by 2050 because it limits the use of pesticides, which in turn affects yield. In Greece, farmers have demanded lower electricity prices, tax-free diesel and subsidized animal feed. In France, farmers have been fighting for improved pay and protection from foreign competition. The French government offered 400 million euros, that's $436 million, in various measures in reciprocation to their problems over low earnings, heavy regulation, and unfair competition from abroad. In Germany, farmers are against the government's decision to phase out tax concessions on agricultural diesel. Their argument is that this will lead them to bankruptcy. In Romania, the protests stem from anger about low prices for produce, rising costs, imports of cheap foodstuffs, and constraints imposed by the European Union's drive to fight climate change. In the United Kingdom, farmers are struggling to keep up with weather changes and war-related supply chain disruptions. The whole of Europe seems to have the agricultural sector in pain as climate change becomes a central focus and production prices increase. And no, it doesn't end there. As per Down to Earth, since 2023, farmers have protested in 67% of countries in South America region for a variety of reasons, such as wanting better export exchange rates and reduced taxes amid an extended economic downturn and Argentina's devastating drought, which have severely damaged crops and agricultural output. And look at this data. Farmers' protests have happened in 12 countries in Africa, 11 countries in Asia, 24 countries in Europe, 8 countries in North and Central America, and 2 countries in Oceania in just a year's time. So let's boil down all this worry to 5 main reasons, India included. Pricing of produce, delayed compensation or subsidy, unfair effects of climate change, policies and regulations, import and export duties, and supply chain discrepancies. What does this say about the world of agriculture? Does it just question politics and governance, or does it hint at a bigger problem, a potential global food crisis?
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. The case for a chat today, particularly in a day like this, which is following a week of some fairly strong regulatory action, we talk about 2 or 3 things. One, whether earnings or a market correction will moderate valuations, if at all. 2, whether the RBI action will keep NBFCs under the heat. So that's the second part of the conversation. And third, what we saw the whole of last week, which is PSUs came under pressure, except for PSU banks, everything else came under pressure. And whether this is the beginning of the peak of the PSU rally. And somebody who called some of these trends out really well, way early, is Nirav Sheth, CEO of Institutional Equities at MK Global Financial Services. I remember, viewers, Nirav's comment to me sometime in 2019 or 20, wherein midway through the interview, he said, Neeraj, you're looking for the big headline on your interview? The headline is that PSU banks will outperform private banks. This was somewhere in 2020. And the historical performance is, well, vindication of his belief out there. Nirav, great having you. Thanks for taking the time out.
Thank you, Nirav.
So, Nirav, let me start off with whether you are skeptical of the valuations, as a lot of people on the street are, or do you believe that the strong Indian growth, policy continuity, etc., 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 will keep valuations higher?
So, do you want to buy good stories cheaply? You want to buy that.
do you get that on a platter? Usually doesn't happen. All of us want corrections, but when corrections come, they will come with a specific reason and a serious doubt, which means that you may not be necessarily able to pull the plug then. I mean, the markets were down 30%, the stocks were down 50-60% after pandemic. None of us had a template in terms of how things will play out, right? How many of us actually went and bought anything over there, right? So I am still of the view that we are obsessively focused about valuations, which is important and a key determinant of your long-term returns. But I think we are not giving enough emphasis to very strong economic momentum and what I would also call very strong political momentum. I have not seen 70-80 basis points upgrades in GDP in a long time. Your income tax returns are compounding at about 26-27%. Your direct taxes, indirect taxes are up by about 15-16%. The leading indicators, the PMIs, right, for services is above 60, for manufacturing close to about 55. And this is when, the entire global world seems to be sort of slowing. Just don't look at India, right? So US is making global highs. Europe has made global highs. Japan is all-time high after 1989. Right, because economic momentum globally has been better than expectations. You are at the fag end of your interest rate cycles, and yes, so I am very constructive on the markets, and that doesn't mean that markets can tell you another 10%. They can. We don't know. But if you dig deeper, harder, there are enough ideas around in the large cap space and also in the mid and small cap space. And I reiterate that over the next several years, I expect the broader markets to outperform the narrow markets, because I would call it democratization of the earnings. A large part of the economic, companies are getting big benefits out of what is happening in the country.
In fact, some of the themes, Nirav, that have come up in the last 2-3 months, or 2-3 years, excuse me, are all themes which are not present by necessity in market cap in the top 100 companies. So I would love to understand, because in the last 2 years, your conferences have had a slew of these mid-cap companies which are promising earnings growth, which are very promising stories. Maybe valuations might be expensive currently, but look very attractive from a growth perspective the next few years. What is it that stands as first amongst equals, or as firsts amongst equals within this mid-cap universe for you in terms of earnings growth or promise?
So I think you have, big surprises in the capital goods sector, right? So let's say, for example, and I struggle with this, right? So for example, there is a very high degree of visibility when you look at the investments that will happen in power. And I'm talking about thermal power, to renewables and stuff like that. None of the capacities have come up in the last 10-15 years, right? So the transformer companies, the boiler companies, the EPC companies, there's a big chain over there. Likewise, I'm struggling to figure out, what is happening in data centers, right? 1 megawatt will cost you about 40 crores, and we are talking of some serious amount of capacity that is coming up. We are talking about investment that is happening in the smart meters, and 250 million smart meters over the next 3 years. Each one of you will cost about $10,000. So there are big numbers we are talking about. The interesting thing is, when you usually talked about capital goods 5-10 years back, it was largely old economy, right? So a lot of the infrastructure is going in, including in digital infrastructure, in data centers, in stuff like that, right? So e-commerce, electrification. And therefore, it's important that you try and analyze, how this ecosystem is going to spread. Think about semiconductors. You're not talking about small numbers. You're talking about almost about 1.4 trillion now, which has been officially converted to 3 guys, going to set up capacities in the Fed. So I see this space to be very, very interesting going forward. And a lot of the companies, I believe, will get listed, right? So today you got L&T, you got BHEL, and then there is a big tail, and then you do your work and try and figure out where you want to be. But I'm a great believer of manufacturing, comeback in India, and I believe that capital goods will have a role over the next several years.
Okay. Nirav, so the valuations are you reckon here the story is the same, that earnings growth will make up for valuations? Because when I look at the MNC cap good companies, while they were priced to perfection, ABB, for example, was priced to perfection at 4,200, but then come the results, then come the commentary, and the market suddenly realizes that, hey, a stock at 80 PE or whatever the PE may have been then is also okay because of the earnings growth and the commentary, and the stock bumps up 15-20%. So it's not that the market didn't know it was expensive, and yet good results are making up for it even in one quarter. So how are you playing this? Are you buying the cheaper second tier non-MNC cap goods, or are you comfortable even with the MNC cap good companies which have got the technology advantage?
See, it's a very good question. And, this is a conversation that I have with a lot of my clients. It's not very easy to see 10 years out, right? So, while I'm very confident about what's going to happen in terms of the capex recovery and stuff like that, I think the way to go forward is by having a very diversified portfolio, right? So I would create a portfolio which will have probably an equal weight in Siemens, an equal weight in ABB, maybe even an underweight. But I'll create a long tail, right? Which is like owning a lot many stocks. And which is on coming back to my point that I made earlier, I would expect BSE 500 to outperform Nifty 200, Nifty 200 to outperform Nifty 50 over the next several years, right? Because I see earnings moving away. And I'm talking about the growth, not necessarily about absolute. The growth in the larger, broader markets will be significantly higher than in the top 50 companies. And eventually the market prices are driven by earnings growth rate. So to answer your question, I would have a diversified portfolio. So for example, if you just look at the largest small cap mutual fund in the country, the suspect is Nippon Small Cap. They would have close to about 250, 260 odd companies. And I think that is the way forward. I think you can today, given the diversification that the economy offers, you can actually create a portfolio of 300 companies and do very well.
Okay. Fair point. Nirav, the other thing is the kind of changes that are coming on the regulatory side for some spaces, and I'm kind of keeping it narrow to power for now, because last week this whole conversation around the change in the bidding process for renewable energy or wind energy brought about a serious correction in some of those names as well, related names. And the companies are coming out and saying, hey, look at the targets, look at the things that have already been given out, and we are fine for the next 3, 4, 5 years, baat hi baad mein dekhenge. I'm trying to understand, when you look at such things, how do you react to them?
So I think now, for people like us who are great believers in, free market capitalism, laissez-faire approach, and now with the benefit of hindsight, we also appreciate that there are market failures that tend to happen, right? So you can't leave everything to markets. To that extent, I have become far more accommodative about regulatory, interventions, if you want to call that. We've seen that with RBI. We tend to again focus very much on the negative impact, while we completely forget that, they're systemically taking risks away, right? So, and they've done a wonderful job. For example, the fact that SEBI's intervention in terms of the leverage that you have against the small cap stocks. Now just think of it. Every time you've got corrections in the broader market, your mid caps tend to fairly hold on to their own. So there is no collateral damage, because earlier you used to leverage the small cap stocks and buy the futures and stuff like that. Right. So over a period of time, you realize that, there is an element to it. Right. So, and in some of the cases, you may give away some basis points of growth. For example, if RBI is, very conscious about the growth in unsecured loans and you're raising the risk weights, maybe you'll grow a bit slower but you will grow longer as well, right? So you will not have big peaks and big troughs. That incidentally should improve your valuations as well.
Okay. Nirav, stay on, so much more to talk about. Have to talk about the big PSU piece with you on the other side, because that's the other key talking point, and a bit about metals, because metals are certainly under pressure today. Viewers, stay tuned. We are in conversation with Nirav Sheth of MK Global.
Hello and welcome to NDTV Profit. Today we will talk about tattoos and the worth of this market. The history of tattoos in India can be traced back to prehistoric times when tribal people were captivated by drawings on stone or wood walls. Their attempt to replicate these figures through needles gave birth to the practice of inking skin. Over the course of time, tattoos were embraced by tribals as a mark of bravery, war, religious beliefs, customs, marital status, protection from the male gaze, and so on and so forth. Today, in 2024, tattoos have become a means to express thoughts, individuality, personal experiences, and sentimental designs. The industry is estimated to generate over 20,000 crore rupees per year. What is driving this growth? One of the key drivers behind the growth of the tattoo market is the rising demand for customized and unique designs. Improved technological equipment for making advanced, safer, and painless tattoos have boosted the market. The laser technology for removal or modification of tattoos have also added to the surge. Increased exposure and promotion of tattoo designs on social media have led to widespread influence of tattoo culture on the youth. Take a look at these figures now. As per Fortune Business Insights, the global tattoo market is projected to grow from $2.04 billion in 2023 to $3.93 billion by 2030 at a compound annual growth rate of 9.87%. This is a sharp rise from 3.8% year-on-year growth between 2017 and 2022. As per Custom Market Insights, the diamond jewelry market is expected to grow at a compound annual growth rate of 5.5% by 2032, while the luxury jewelry market at a rate of 8.9%, but the tattoo market is estimated to grow at 9.5%. Is the tattoo business lucrative? According to an article by Opportunity India, tattoo kits are now easily available for less than Rs 10,000, while high-end kits range from Rs 20 to 35,000. Now, in a city like Mumbai, the average cost per inch is Rs 2,000 to 2,500. In Delhi and Bangalore, the cost per inch is between Rs 1,000 to 2,000, and in Goa, it is about Rs 500. We spoke to a couple of tattoo artists in Mumbai and found that at an average, the business earns them a profit of Rs 75,000 to 1 lakh per month. In fact, as per an article by India Today, a person can earn a minimum of 20,000 rupees to Rs 2 lakhs per month depending upon one's work and creativity, with an initial investment of 1.5 to 2 lakh rupees. A beginner level tattoo artist can earn a minimum of 20,000 rupees per month, which gradually increases to a couple of lakhs or more depending upon the caliber of the artist and the uniqueness of their artwork. And I'd like to leave you with an interesting data by Advanced Dermatology that revealed that 63% of people with a tattoo smaller than the palm of their hand regret it. The reasons being impulsive decisions, 35%, significant meaning, 29%, or the idea that it would make them look cool, 18%. Thank you for watching and stay tuned to NDTV Profit for more.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies.
Welcome back to Talking Point. In the case for a chat, we told you we'll talk about PSUs, we'll talk about RBI action. Let's try and talk about both. First, let's get in my colleague Anushi, who brings in a quick perspective about a note wherein they've gone out and downgraded, or maybe speaking about India financials, have downgraded SBI as well. I think that's Bernstein. Anushi, a quick word on what Bernstein has to say.
Absolutely, Neeraj. So Bernstein has downgraded SBI to market perform rating, emphasizing the need to it's time that we switch back to private banks instead of PSUs now. So a couple of reasons over here. They are seeing a less promising trajectory over here for PSBs on account of the weaker deposit growth again over here and lower liquidity buffers. Another is the aggressive pricing that has been noticed by in the loans and deposits, which will eventually lead to a muted earnings growth going forward. Also, the third and a critical point over here is the valuation gap, which has kind of narrowed significantly if you have to look at PSB and private banks. So these are a couple of reasons they have cited on why they have downgraded SBI and overall and switched to private banks focus more.
Anushi, thanks. That was really quick but effective, because you give us a sense of what they are trying to say. Now, Nirav, I'd love to come to you on two parts here. First, today, some of your peer sets have come out. Somebody's downgraded PSU bank. Somebody said that, oh, is the PSU rally overdone, etc. I'm trying to understand from you. Are you of the same belief that the run-up is too fast, too soon? Because last week, too, a lot of PSU stock came under pressure.
So I am very, very constructive on PSU in general. And now let's look at it, right? So, have they rallied? Of course, they have rallied. The question is that why they have rallied. So now let's look at SBI, for example. SBI, if you look at consensus estimates, right, it is likely to grow at about 15% CAGR over the next 2 years. I'm talking about earnings. Their average ROE over the next 2 years will be 17%. Now, this earnings growth rate is higher than ICICI, it is higher than SDFC, and I think it's higher than Kotak, right? And ROEs are similar. So the fact of the matter is that when I look at the next 2 years, and if I just forget that it's a PSU balance sheet, and if I just look at the color of the dollar, which is always green, then SBI seems to be outperforming. I think Axis is slightly ahead of SBI Bank. So the markets have rewarded a big evolution in ROE, and the fact that your earnings CAGR is similar to other larger peers, and you are getting it at a discount. Number one. So I mean, nothing of this has happened in isolation. You can make a case that PSUs will grow slower than private sector banks, and therefore I can downgrade. And it's a call that you can take. I am not of that belief, number one. Secondly, when you look at the consensus earnings right now, people are looking at credit growth rate, which is CDET, right? We're looking at about almost 14-15% growth rate in earnings. If you look at the last 10 years, India's credit growth rate has been in line with nominal GDP growth rate, and therefore your credit to GDP ratio has been essentially been flat, which is disaster for developing country like India, right? So I believe that you are going to get serious surprises, and I reiterate again, you are going to get serious surprises when the credit growth comes back, especially from capex recovery, which I just alluded to a while back, right? And the guys who are going to write a 10,000 crore check, for example, we're talking about 1.5 billion of investment happening in semiconductor. The guys who are going to write a check for 10,000 crores, 20,000 crores will largely be PSU banks, right? And I would expect private sector banks to be slightly more cautious about getting into project lending. We have not even seen that. Infrastructure lending, we are not even seeing the real participation that is going to happen. So if my assumption is right, then you are likely to see earnings upgrade happening in PSU banks. Now let's look at energy sector, not only PSU banks, right? What had happened in OMC companies? You got earnings upgrade by 100% in fiscal 24. And in the first half, the stock price was going down because analysts were refusing to believe that OMCs will not cut their prices pre-election. Suddenly there was a big realization and the stocks rallied, and they rallied furiously. But there was a catch-up that had to happen. You cannot expect this company to trade at 2 or 3 P, at the end of the day. Likewise, just for reflection, even today, ONG trades at 10% free cash flow yield. Why would you not buy that, even if you think it's as growth? So I would keep my eye and focus on earnings, ROE, and the valuation context. I see no reason to be outside the PSU. And I think they are governed far, far better than what they were a decade back. So you have to make some adjustment for this as well.
Got it. The other thing is this whole regulatory action that is turning up the heat on select pockets of the market. Recently, I mean, one financial services institution, the other an NBFC, before that Paytm. There's lots happening, right? And I mean, is this something that might make people a bit cautious on the valuations in that bucket, or are these isolated cases, you think?
I would like to believe that it will be isolated cases. As a matter of fact, I believe that and this is what you just got in public domain, right? So there were some lapses on operational side, and we're seeing some interviews happening today that, those are being corrected. In all the cases, RBI has been extremely clear that, we'll come back, we'll do a re-audit, and if things are in order, it will be business as usual. So in a way, you are trying to send across a message that rules are rules which need to be adhered to, and in a way, I think it's good. So, it could lead to people may overanalyze the situation and stuff like that. I just think that, my sense is that our regulators in India have become far, far more agile. And I also believe that a part of this could also be driven by the fact that you are into pre-election, mood right now, and you want to be very, very clear and agile about the fact that you don't want to get any risks emanating for anyone that can create some sort of political chaos. And therefore, you'll probably try and err on the side of the caution. I have not seen anything that would force me to have a look at structural impediments to growth. Nothing on those lines so far.
Okay. Nirav, my final question. Where is it? I mean, you on PSU banks, on PSUs, on select other pockets, you were way ahead of street when the street did not factor in. Where is it that you are completely anti-consensus with the street?
So I would like to believe the first thing, and I mean this is more of a macro call, I'm not a bottom expert, so I would stay away from metals. That is something that I don't like. China is deflating, 9-10 months of deflation. They just had a positive print, marginal positive print. Excess capital is being set up over there for the world, and world is not ready to receive that. So a lot of chaos. So I don't want to look at commodities, and that actually makes me very bullish on India, right? Because we are generally a net importer of commodities and therefore inflation. Second thing is consumers. So a lot of these companies started trading at 60, 70, 80 times without any great improvement in growth in free cash flows, right? So while their net margins have doubled in the last 10 years, it has not led to a corresponding increase in the growth in free cash flows. And I think the competition is hotting up. So, given to me, let's say if I'm running an extreme portfolio without any respect for benchmarks, I'll be zero weight on all the consumer companies. I'll be zero weight on, the commodities. I want to play the India story over the next several years.
Got it. Okay. Point well noted. Nirav Sheth, thanks as always for taking the time out and giving us your thoughts. Really appreciate your time.
Thank you. Thank you for having me, Nirav.
The pleasure is always ours. And viewers, thanks for tuning into this edition of The Talking Point.
Amul has completed 50 years in India. PM Modi will attend the Silver Jubilee celebrations of the Gujarat Cooperative Milk Marketing Federation, the owner of Amul. At one point of time or the other, we've all grown up with Amul butter or milk for sure. The famous Amul girl created in 1967 is family. We all recognize her. But as the brand grows 50 years old today, do you remember the full form of Amul? It is Anand Milk Union Limited. From producing 250 litres of milk per day since the time Amul was formed back in the mid-90s to today, where Amul has over 36 lakh dairy farmers and produces nearly 300 lakh litres of milk per day, the brand has had a long journey. The story goes way back in time. In the 1940s, dairy farmers were worried. The middlemen exploited their ways of profitable income, and a poor milk production system made their living difficult. Tribhuvan Das Patel and Verghese Kurian identified these issues and helped in the formation of the first milk union called Kaira District Cooperative Milk Producers Union in 1946. The cooperative model gave farmers direct ownership of the dairy industry. The union helped them process, market and sell milk and milk products without the interruption of intermediaries. And it was in 1955 that this union chose a brand name for itself called Amul, which means priceless in Sanskrit. And then, in 1973, Amul Dairy, along with 16 other district cooperatives, formed the Gujarat Cooperative Milk Marketing Federation, which has now completed 50 years in India. Amul also started India's white revolution that made our country the world's biggest maker of milk and milk products. The brand follows an umbrella marketing technique which has helped GCMMF prevent association clashes and keep an open door for the patrons to coordinate in creating items. As per a report by Statista, the annual sales turnover of Amul from 2011 to 2023 has consistently risen, recording about 55,000 crore rupees of turnover in 2022-2023 alone. And did you know, Amul has also held a Guinness World Record for having the longest continuous run of any advertising campaign that has ever taken place anywhere in the universe. Amul Doodh Pita Hai India and Utterly Butterly Delicious will always strike a chord. Let us know which famous advertising phrases of Amul do you remember.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Markets trade in the red after the Nifty opened at fresh record highs. Sensex falls below 74,000 while the Nifty trades below 22,500. Sectoral indices trade mixed with pharma, healthcare and PSU banks leading the gains this morning. On the other hand, media, auto and metals drag. Media reports suggest Tata Sons may be looking for ways to avoid a forced listing. Tata Group stocks witnessed sell-off on the reversal of IPO outlook. And India's life insurers saw a strong rise in revenue growth of 48% year-on-year in Feb, with LIC reporting the strongest growth in new business premiums, while SBI, on the other hand, reported the highest revenue. And public sector banks may see slower earnings growth as compared to private lenders due to muted deposit growth. According to Bernstein, says it's time to switch back to private sector banks. and welcome to the F&O show. Agam and me will take you through all the technical and F&O action this morning. But just before that, a quick check on the street. The Nifty is trading subdued. It's a morning of consolidation. No surprises there after we've seen 4 straight weeks of gains coming on the street. Remember, it still remains a buy on dips market, so that's a good news, or that is some good news for the street. 22,500 becomes an important level of resistance that the Nifty is currently facing. In terms of the bank Nifty, it's not managed to reclaim its highs that were made in December. The space still trading with a cut of 0.5%. But the morning belongs to Tata Group stocks, all of those under tremendous selling pressure. While they were the stars of Friday, they are the biggest losers in today's trade. Tata Chemicals down 10%, Tata Motors, Tata Investments, all the Tata, bunch of Tata Power, all trading with big cuts this morning. That's pretty much the sentiment, Agam. No real trend emerging. The breadth is also not doing too badly, but I think the benchmark is struggling around 22,500.
Yes, I mean, I agree with you. What's really happening in the markets at the moment is while it's been relatively quiet start to this trading week, but we have to remember that we're coming off a very, very rocky and a volatile week coming through. And even though it may seem like some of these indices are consolidating, there's plenty of action underneath. At least as far as today, you know, we have seen a little bit of weakness coming in as far as the Nifty is concerned. It's marginal, but well, in the red all the same. And we started off with a little bit of strength, and we've seen a gradual come off. It's not at days lows at the Nifty, but well, in the red all the same. Talking about the bank Nifty, and perhaps that's where, you know, we had seen a little bit more of an improvement. Now that's where we are looking at a 0.4% cut as well. Remember that we had that CLSA note come on HDFC Bank, and that of course has had some amount of bearing when it comes to the indices at the moment. And we are looking at a decline of around 1% for HDFC Bank as well. Of course, because of that substantial weightage that it has on all indices, it's naturally going to have a little bit of an impact on all the key markets. But, you know, overall, let's take a look at how things are panning out as far as the future space is concerned. And that's where, in fact, we can perhaps decipher whether or not there is position building. And there isn't. You know, say for in the last 5 to 6 odd sessions, say for maybe 1 or 2, we really haven't seen too much change in open interest, not towards a decline or, for that matter, towards an increase as far as the March futures go. And it's the same potentially for the bank Nifty too. Let's pull up the bank Nifty as well and see where the futures are trading. So in fact, unwinding coming through. Remember, the bank Nifty did see advances last week, and at the moment, considering we are seeing a little bit of weakness, well, the unwinding of nearly 6% comes through for your overall open interest in the futures as well. What about the options market? Let's take a look at that as well. And I reckon at this point in time, we just might see a little bit more writing starting to come through around the mark of 22,500. Of course, we're about 3 to 4 days away from your crucial expiries. By that, I mean the bank Nifty and the Nifty. And you know, we're going to continue to see that amount of resistance being built up around 22,500, even though we have moved above that mark momentarily and then come off to a certain extent. And you know, in terms of your overall distribution, that's likely where we are seeing a lot of traction in terms of calls and puts too. So overall, as far as the picture on the benchmarks is concerned, Samina, consolidation continues with just a little bit more, well, whipsaws on an intraday basis coming on.
Indeed. So it is a morning of consolidation, like we said, and there's no surprise and there's no disappointment either, right? Because the markets have been making record highs for the last few weeks, and the momentum still remains. This time around, you've got a whole bunch of losers coming in from the Tata pack. So your Tata Chemicals is down 7.5%. Tata Power is down 3%. Indian Hotels is also seeing a cut of about 1% odd in trade this morning. Along with that, stocks like JM Financial, not liking the news that we saw on JM Financial. The SEBI has barred JM from being the lead manager on any of those NCD issuances going ahead. The stock is down about 9% in trade right now and not relenting, at least so far. Apart from that, with the promoter looking to do a stake sale in Interglobe Aviation, the counter trades the cut of 2.5%. You've also got OMCs that are under pressure. Lemon Tree Hotels is also looking quite weak. On the gaining side, NLC on back of the order win is up 11% on big volumes. Rail Vikas Nigam on back of signing an order, signing an MOU with closing a deal with the Himachal Pradesh and Madhya Pradesh government is trading with a gain of 6%. 6%. Insurance companies are looking good on back of those numbers that we saw in terms of business update. The whole host of insurance companies are having a good morning. I just quickly want to check Tata Investments as well. The stock, remember, has been hitting upper circuit every single day for the last few weeks now. This is the first morning after a very long time the stock is seeing a lower circuit of 5%. Now, what drove this counter higher is anybody's guess, but for now, the fact that the Tata Sons may not necessarily go in with an IPO is what's seeming to be disappointing news for Tata Investments as well. But we have with us Vinay Rajani and Bhavin Mehta joining in with their top trades and recommendations this morning. Bhavin, I'll start with you. It's a morning of consolidation. The range really seems to be between 22,400 and 22,800. So it's a pretty wide trading range for the Nifty. How would you approach the index at this stage? Would you consider initiating any sort of a strategy on the Nifty itself?
Yeah, good morning. We have over last couple of trading sessions, we have maintained our view that as long as Nifty continues to hold 50-day exponential moving average, we will continue to see buy on dips. So we were not looking at any major drawdown below 21,600 for this particular series. And we continue to remain with that stance that downside, anything specifically below 20 EMA, which is currently quoting somewhere around 22,200 kind of a level, will be a very decent buy opportunity. Now, having said that, if we look at this particular month, we have a long holiday season, almost 3 holidays in this particular month, of which 2 will be in this particular expiry, and that will imply that your option writers will continue to remain aggressive. And add to that, we are also looking at implied walls coming lower, so adding to benefits for the writers in that sense. So what our view is that 22,500 being a key level for markets, we will continue to see option writers aggressive at that particular price point. If we cross that particular level on upside, there is a potential for Nifty to give you a positive return of another 200 to 300 points. At the same time, on downside, we have a very good base at 22,200. So my sense is that anyone who is willing to ride 22,200 to 22,300 kind of a strike, ideally should be in the money. So this is what we are looking at this point of time. No major negativity. It's a buy on dip kind of a market. Pressure will continue on the broader market indices, however.
All right, Bhavin, that's the view on the Nifty 50 from Bhavin's end. Vinay, good morning to you as well. How are you reading things on the benchmark?
Yeah, so basically in the March month, we have seen that broader markets are not performing and large cap space has been performing well, and top 100 stocks of the National Stock Exchange has been doing very good. So it is not like everything is falling. Mid cap and small cap stocks are actually facing some selling pressure. We can say it is a profit booking after 11th month stellar rally and performance. We cannot rule out the possibility of profit booking, especially in the month of March, where tax settings and tax related selling can come or may come. So it is just a consolidation, we can say, or profit booking in mid cap, small cap, but there are many sectors and stocks which are doing good, especially in the large cap segment. So talking about the Bank Nifty, last week we saw that in open interest went up by massive 29% and Bank Nifty rose more than 1%. So massive long buildup was registered in the Bank Nifty, and Nifty also registered a long buildup. So as far as benchmark indices are concerned, they are looking strong, and especially the Bank Nifty. And if I were to see the open interest distribution chart, then in the last week we saw that in the 14th March expiry, there is a high open interest building up in the 22,400 strike price. So currently the level of Nifty is at 22,450. So there has been a good amount of put writing happening at 22,400, and now Nifty has reached that level. So I think it is near the support. So once Nifty comes around 22,400 to around near that level, one can initiate a long position. So overall view is that in benchmark indices, one should adopt a strategy of buy on dips, and according to me, 22,400 is a very strong support support in the spot. So once we see that level coming, one can initiate fresh longs with a stop loss of 22,300. And on the upside, I'm again expecting Nifty reaching a target of 22,600 to 700. In Bank Nifty also, setup is quite good. And Bank Nifty is reaching a strong support zone, which is around, let's say, 47,500. So around that level, one can initiate long with a stop loss of 47,000. And on the upside, I'm expecting Bank Nifty to register a new all-time high beyond 48,600. So overall, in Nifty and Bank Nifty, I'm bullish. If we cannot rule out the possibility of further correction slightly towards the support levels. So Bank Nifty support is at 47,500 and Nifty support is at 22,400. These levels can be utilized to go long for the trading.
Right. Bhavin, Bank Nifty has risen for 4 consecutive weeks, outperforming the Nifty, while there's also been an increase in outstanding positions in the derivative contracts. And I believe there have only been 5 occasions in the past where Bank Nifty has outperformed the Nifty, for 4 consecutive weeks. Are you constructive on Bank Nifty and banking stocks?
Yeah, so we have a different opinion with respect to the private sector bank and PSU bank. So what we are looking at is that private sector banking names may continue to remain under pressure. PSU, we have seen a very aggressive long built up across the board. So that should impart your strength for the Bank Nifty. Now, having said this, we are looking at a downside getting restricted around level of 47,000 kind of range. Outperformance from current levels versus Nifty, which was your question, from current level seems difficult. My sense is that going forward, we may continue to see underperformance coming up for Bank Nifty versus Nifty, with a potential of Nifty names, particularly a couple of large cap Nifty names outperforming going forward. And also something that has lost interest recently was basically your IT and FMCG counters. So my sense is with Bank Nifty over last 2 trading session kind of reversing from 48,000, we may see that interest getting back into FMCG space or in IT space.
All right, so that's a view on the Bank Nifty. And on that note, we slip into a short break. But on the other side, we get you a lot more in terms of stocks. Stay tuned in. Back in just a bit.
Hello. Good morning, ma'am. I'm speaking from XYZ company. Are you looking for a job or a job change? Have you been receiving unwanted calls from spam numbers? Are you tired of being offered new jobs, insurance schemes, or free health checkups? Well, today we will look at an interesting survey report by local circles on pesky calls that received 60,000 responses. Most unwanted calls are related to financial services, 54%, and real estate, 22%. In fact, the report has taken names. 40% mobile subscribers have identified Bajaj Finance as a top offender, HDFC Group as the second biggest pesky caller. The report reveals that 60% of people received 3 or more spam calls on an average day every day, and 92% of people registered on the Do Not Disturb list still get pesky calls. So is being listed on DND working? Clearly not. But the report also recorded a minute relief, as per which 6% people don't get any such phone calls. This relief comes after the TRAI directive to banks, insurance companies, and other commercial entities. TRAI is the Telecom Regulatory Authority of India. In fact, the Department of Consumer Affairs has constituted a committee comprising members of different regulatory authorities, telemarketing companies, and cellular industry to draft the guidelines to address the issue of pesky calls. So yes, pesky calls are still a worry, but there is a little relief too. Can you ignore them though? Toll-free numbers are identifiable, so institutions have found a new way. According to the report, calls from different mobile phone numbers that seem to belong to companies or brands have risen from 29% in February 2023 to 36% now. And look at the change in trend. Real estate selling has risen from 18% last year to 22% now. However, job offerings have decreased from 10% to 4%, and in the case of those selling financial services, the calls have slipped from 60% to 54%. So the bigger question is, will the nuisance of pesky calls end anytime soon? There should be a system where pesky callers are blacklisted at the Aadhaar level, so they have the risk of not getting a new SIM. Also, brands on whose behalf the contracted callers are calling also need to be held accountable by the Department of Consumer Affairs, so brands institute the right consumer outreach practices both with employees as well as third-party contractors. For more such updates, stay tuned to NDTV Profit.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
there are different types of stocks. Large cap stocks, mid cap stocks, and small cap stocks.
How to decide which is the one for you? First, decide on the strategy.
Welcome back to the FNO show. We take a look at all the stocks which are buzzing in trade. We start off with all the futures, stock futures specifically, which are looking at an increase in open interest. And that list is there for you on your screen. We are looking in advance for Interglobe Aviation. Of course, we've had a stake sale coming in there as well. Siemens is up around 5.5%, with 17-18% added in open interest towards longs. And Trent is the other one, perhaps one of the few Tata companies advancing today, up around 5.5%. And on the losing end, we have ICICI Prudential and Tata Steel looking at fresh shorts. What about stocks which are seeing unwinding in open interest? Let's pull that up as well. And we see about a short covering for Pidilite and Chola Finance. On the other hand, longs and winding for Tata Chemicals. And that, of course, is on expected lines, taking a knock of around 9.5%. And SAIL and MGL, on the other hand, also looking at further unwinding coming through. Let's take our experts' opinion on the kind of ideas that they have for us today. Vinay, coming over to you, what are you recommending?
So I am bullish on FMCG space. So there are a few stocks which are looking extremely strong and fresh breakouts can be seen on the chart. So one of the FMCG stock which I like and which has been the leader in the FMCG sector is the Colgate Palmolive. So it is on the verge of breaking out above its previous all-time high, which was at 2621, and now it is trading at 2612. So the overall primary trend has been bullish, and FMCG space is performing well for last couple of sessions, and I think this going like this only in the coming days. So Colgate Palmolive March futures we can go long for the trading. So it is I'm recommending going long in the March future at 2615. Stop loss can be kept at 2565, and on the upside I'm expecting a target of 2690. These are the March future levels. The second pick I would choose from the PSU bank segment. So PSU banks actually looking very strong on the charts, and they have been outperforming and into continuation of an uptrend. So Bank of Baroda looks very convincing on the chart. So Bank of Baroda March futures one can go long as it in trading and the recommended level for March future is 284. One can keep a stop loss at 280 for the trading, and on the upside I'm expecting a target of 291. So both of these calls are for the next 2 to 3 sessions, and with a strict stop loss one can initiate a fresh long positions.
All right, and Bhavin, what about you? What are you recommending today?
Yeah, so one of the stock that we have been recommending over a long period of time is Indigo. The relative strength of the counter remains extremely high. Today we have seen a couple of blocks going through, and the stock post initial jitters have witnessed a very strong rebound from a very crucial levels with good amount of open interest addition. My sense is that eventually we are looking at a fresh highs coming up for this name. On the downside, 3040 will be the kind of level that stock needs to maintain on a closing basis. At the same time, on upside, 3350 to 3400 will be the level. So we have seen a very good consolidation zone, good amount of reversal from 50 EMA, good amount of OI addition. Stock could witness some amount of consolidation once again around 3200, but my sense is that eventually it will move closer to 3300 to 3400 on the upside. Second stock, we have been quite negative on most of the chemical names over last couple of months. We had a negative call on majority of these names. My sense is that going forward, the weakness or the relative weakness versus majority of your F&O name continues to remain very high for the chemical space, and that is why we are recommending a short on United Phosphorus. My sense is that eventually the stock will move closer to 450 kind of a range. On the downside, one can look to sell this particular counter with a strict stop loss of 492 on the upside.
Right. Thank you, gentlemen, for joining us today on the show. Vinay and Bhavin, thanks for your trade ideas and your view on the Nifty and Bank Nifty. We'll move on from the F&O activity to the newly integrated Terminal 3 at Lucknow's Chaudhry Charan Singh International Airport, which is expected to generate 13,000 jobs, says Adani Sports SEZ Karan Adani. Here's what he had to say on the terminal's salient features and project pipeline in Uttar Pradesh. Listen in.
Phase 1, which is the current terminal, both direct and indirect employment is roughly 13,000 people who will be employed for this terminal. Eventually, I think with the whole master plan, which will triple in terms of the capacity, I think you will have roughly 40 to 50,000 people employment once the whole master plan is up and running.
Employed directly and indirectly. Arunji, if I would like to ask about some salient features of this terminal, because we see this is built, at one of the most, different. It is very differently styled. If you could just tell us the salient features of it.
So it's an integrated terminal. As you know, today Lucknow has two separate, domestic and integrated. This will be an integrated terminal with domestic and integrated. But really, what we have tried to focus on is the green part. So the entire airport will run on green energy. We will have then the passenger capacity of, as Karan Bhai says, eventually of 38 million. But digitization, we have focused on Digi Yatra. So day one, every consumer can use Digi Yatra. We have put self-baggage drop so people can use technology to minimize the dwell time. Okay. Our ambition is in India, if you really look at any airport today, there's a lot of anxiety of passengers going through Indian airports. We want to translate or convert that into excitement. So Lucknow Airport is the first terminal where we have kept into mind how do we delight the customer coming into airport instead of having any anxiety, will they miss the plane, and also then provide world-class facilities when it comes to food and beverage retail experience in Lucknow.
Okay, so of course, customer experience being the priority. Karanji, if I would like to ask you, what are the other projects we are looking at in the coming future in Uttar Pradesh?
So as you know, in Uttar Pradesh, we are already developing the Ganga Expressway. We have the Lucknow Airport. From cement, we have a grinding unit which is there in Tikaria, which is run by ACC. I think apart from that, we are very keenly working on power project, renewable project. We are looking to expand our cement capacity. We are looking to set up a grinding unit in Gorakhpur. And we would obviously look at expanding the existing Lucknow airport. So these are some of the quick opportunities that we are looking at. Apart from this, we are also looking at logistics parks. So as part of increasing, how do we bring in more MMLPs along the expressways, along the dedicated freight corridors. So that's some of the places that we are looking to expand.
And how does the Adani Group plan on maintaining the sustainability with such large expansion plans?
So as part of as part of our strategy, all our businesses are going to be using renewable power by 2028. So as Arun said, this project from day one is running on renewable power. Same is with all our projects that we will be looking at. We are looking at a lot on how do we minimize carbon footprint. We are looking at how we can increase our green area, green cover area, and how do we integrate that as part of our implementation as well.
There you have it. That's Karan Adani telling us about all that is in store for the future. But on that note, it's a wrap on the F&O show. Lots more lined up on the other side. Stay tuned in.
The farmers' protests have been making headlines. Indian farmers have demands such as legal guarantee on MSP, pension and debt waiver, no hike in electricity tariff, reinstatement of Land Acquisition Act 2013 and more. But while the protest becomes important from the point of view of elections and politics, it's not just India that has its farmers agitated. The streets of Spain, Belgium, Hungary and Poland have been roaring with protests by farmers too. Around 1,400 tractors took part in a protest in Poland and roads were blocked across the country. What do they have a problem with? Rising production costs, falling sale price, stringent regulations. They say that the European Union is not doing enough to stop cheap imports from Ukraine, which is affecting the demand for local produce. They are also not happy with the European Union's Green Deal that's designed to zero out pollution by 2050 because it limits the use of pesticides, which in turn affects yield. In Greece, farmers have demanded lower electricity prices, tax-free diesel and subsidized animal feed. In France, farmers have been fighting for improved pay and protection from foreign competition. The French government offered 400 million euros, that's $436 million, in various measures in reciprocation to their problems over low earnings, heavy regulation, and unfair competition from abroad. In Germany, farmers are against the government's decision to phase out tax concessions on agricultural diesel. Their argument is that this will lead them to bankruptcy. In Romania, the protests stem from anger about low prices for produce, rising costs, imports of cheap foodstuffs, and constraints imposed by the European Union's drive to fight climate change. In the United Kingdom, farmers are struggling to keep up with weather changes and war-related supply chain disruptions. The whole of Europe seems to have the agricultural sector in pain as climate change becomes a central focus and production prices increase. And no, it doesn't end there. As per Down to Earth, since 2023, farmers have protested in 67% of countries in South America region for a variety of reasons, such as wanting better export exchange rates and reduced taxes amid an extended economic downturn and Argentina's devastating drought, which have severely damaged crops and agricultural output. And look at this data. Farmers' protests have happened in 12 countries in Africa, 11 countries in Asia, 24 countries in Europe, 8 countries in North and Central America, and 2 countries in Oceania in just a year's time. So let's boil down all this worry to 5 main reasons, India included. Pricing of produce, delayed compensation or subsidy, unfair effects.
Welcome. You're watching the Small and Mid-Cap Show. This is Mahima Vachrajani. Well, before we move on to the guests for today, let's take a quick check of how the markets are looking like. Well, if we talk about the benchmark indices, Nifty is around 0.25% down. It did start with a record high, however, it's down 0.25% now. Talking about Nifty Midcap 100, Nifty Midcap 100 is around 0.08% lower. Well, the laggards that is drawing down Nifty Midcap 100 are Tata Chemicals, Tata Tele, Apollo Tyres, Gujarat Gas. Well, about Nifty Midcap 50 is down around 0.23%. Well, Nifty Realty did start today on a higher note. However, it is around 0.7% lower right now. Macrotech was leading today. However, let's see how Macrotech is still up 1.34%. However, Brigade is pulling it down around 2.4% lower. Sobha is down 2.25%. Talking about Nifty FMCG, Nifty FMCG is up 0.1%. Nifty Pharma is up 0.95%. Well, contributors to the Nifty Pharma include Zydus Life, Torrent Pharma, Lupin. Torrent Pharma is up 2.4%. Zydus is up around 3.5%. Moving on, talking about the Nifty IT. Nifty IT is down around 0.5% today. Nifty IT is being dragged by Emphasis, around 0.17% down. L&T is down around 1.25%. Infosys is down around 1.14%. If we talk about the Nifty Midcap 100, well, the laggards again, if we talk about Tata Chem around 9.3% down, Tata Tele down around 3.34%. Also, NLC is up and about around 7% in trade today, and this is back on the back of multiple order wins. Kalyani Steels is down around 2.3%. Talking about insurance companies, the insurance company data was out this weekend. LIC is up around 0.31%. ICICI Prudential down around 0.8%. SBI down around SBI Life is up around 0.9%, 1% now. Then we have around Nifty Bank. Nifty Bank is down around 0.4%. Bandhan Bank is pulling it down 0.2% down. Bandhan Bank, IndusInd Bank down 0.17%. But moving on, Kalyani Steels is in focus. The stock is down around 2.37%. Well, the stock is trading with cuts today. The company signed an MOU with Odisha government for over 6,626 crore along with order of manufacturing of defense components. Additionally, and iron ore futures have been lower by 11.66% in the past 1 month. So what will be the impact on raw material prices, and the China's demand has been disappointing. To discuss all of this and more, we have R.K. Goyal, Managing Director of the company with us. Welcome to the show, sir.
Good morning.
Good morning. My first question to you is that the MOU that you've signed with the Odisha government, well, it's approximately 6,000 crores MOU. My first question to you would be that what is the stake, what is the share of Kalyani Steel in this? And to add to that, what kind of top line addition are you expecting from this particular MOU?
You see, as far as this MOU is concerned, it is 100% Kalyani Steel. As of now, we are not envisaging any contribution from any of the other companies. It is basically Kalyani Steel. And once this project is commissioned, we are still working out on a product mix and all. It will be much better, much better than what we are doing currently. Basically, because the type of products we are going to produce will be largely very different than what we are doing now. It will be all high alloy and are of very different specs in terms of size, dimensions, clean steel, cleanliness and all. And it will be for different segments than what we are doing currently.
Right. So since it's different segments, I believe this will be margin accretive. At present, your EBITDA margins are around 20%. So do you expect your margins, like higher margins from this particular MOU, one thing, and what kind of top line addition are you expecting from this MOU?
You see, currently our top line is close to 2,000 crore. And even if we produce at 90% capacity, it will be definitely more than 2.5 to 3 times of the current top line. At the same time, the average margin per ton, we definitely expect it to be much more than what it is today.
Right. So, sir, the iron ore prices have gone down around 11% in the past 1 month, and this signifies that the futures will also go down. And this means that lower cost of raw material for you in the coming future. So what kind of impact will this have on your P&L, both profit and margins?
You know, when you are talking of iron ore price, I believe you are talking of international price of iron ore. They are not in tandem with the local iron ore prices. In fact, local iron ore prices have gone up in e-auctions, particularly in Karnataka. So definitely there is an increase in cost rather than any decrease in cost.
Okay. And what does your inventory cycle look like especially for your raw materials?
So we do not carry a very huge inventory. Everything is close to 1.5 month maximum, all put together. Everything, whether it is raw material, whether it is WIP, whether it is FG put together.
Right. And do you also export? If yes, what is your export-import mix?
So we export very little quantity, negligible quantity. It's insignificant as we like to cater to our local domestic customers. And our capacity is just adequate to take care of them. In fact, we are short of material, and that's why we are going for expansion.
Right. And at present, for all your plants, what is the capacity utilization at present, and where does this go by, let's say, FY25?
You know, currently, since last several years, we are utilizing our capacity by and large at 100%, except for certain period during COVID and all. Otherwise, it is all 100% capacity utilization.
Okay. And in terms of capex, what was the capex for your 9 months FY24? One thing, and where will it stand by the end of FY24? And coming FY25, what is the capex that you're aiming at?
You know, as far as the capex part is concerned, in the existing plant, we had to spend only some money in Coke Oven. Rest all we did not do anything. Now, whatever additional investment we will do it in Odisha. We are still working out the detailed modalities.
Right. Also, in terms of your revenue guidance, if you can tell us what kind of revenue are you looking at in terms of CAGR growth by FY25?
You know, as far as the current operations are concerned, they will continue maybe marginally better than what it is. The new expansion project will definitely take some time. You know how much time it takes typically to set up a steel plant, starting from 0 day to get EC, and then most of the equipments are long delivery. So it will definitely take almost 4 years of time.
Right, but overall, if we see revenue growth of what CAGR are we looking at, let's say by FY25?
So you see, it depends on we are already utilizing 100% capacity. So if there is an increase in price, only to that extent the revenue will grow, otherwise not.
Right. And in terms, so let's say if your EBITDA margins at present are at 20%, where does this EBITDA margin go by FY25, by the end of FY25?
This itself is a challenge to maintain this level of EBITDA. So we do not expect it to go up substantially further. Yes, there may be something here and there, but we may be operating at the current level, maybe marginally here and there, based on some further improvements which we bring in the manufacturing operations.
Right. Okay. So thank you so much for speaking with us at NDTV Profit, sir. It was a pleasure speaking to you. It's time for a short break, but don't go anywhere. We have NLC India's Prasanna Kumar Motupalli joining to talk about company's recent projects in Rajasthan and Gujarat. Stay tuned.
Hello and welcome to NDTV Profit. Today, we will talk about tattoos and the worth of this market. The history of tattoos in India can be traced back to prehistoric times when tribal people were captivated by drawings on stone or wood walls. Their attempt to replicate these figures through needles gave birth to the practice of inking skin. Over the course of time, tattoos were embraced by tribals as a mark of bravery, war, religious beliefs, customs, marital status, protection from the male gaze, and so on and so forth. Today, in 2024, tattoos have become a means to express thoughts, individuality, personal experiences, and sentimental designs. The industry is estimated to generate over 20,000 crore rupees per year. What is driving this growth? One of the key drivers behind the growth of the tattoo market is the rising demand for customized and unique designs. Improved technological equipment for making advanced, safer, and painless tattoos have boosted the market. The laser technology for removal or modification of tattoos have also added to the surge. Increased exposure and promotion of tattoo designs on social media have led to widespread influence of tattoo culture on the youth. Take a look at these figures now. As per Fortune Business Insights, the global tattoo market is projected to grow from $2.04 billion in 2023 to $3.93 billion by 2030 at a compound annual growth rate of 9.87%. This is a sharp rise from 3.8% year-on-year growth between 2017 and 2022. As per Custom Market Insights, the diamond jewelry market is expected to grow at a compound annual growth rate of 5.5% by 2032, while the luxury jewelry market at a rate of 8.9%, but the tattoo market is estimated to grow at 9.5%. Is the tattoo business lucrative? According to an article by Opportunity India, tattoo kits are now easily available for less than Rs 10,000, while high-end kits range from Rs 20 to 35,000. Now, in a city like Mumbai, the average cost per inch is Rs 2,000 to 2,500. In Delhi and Bangalore, the cost per inch is between Rs 1,000 to 2,000, and in Goa, it is about Rs 500. We spoke to a couple of tattoo artists in Mumbai and found that at an average, the business earns them a profit of Rs 75,000 to 1 lakh per month. In fact, as per an article by India Today, a person can earn a minimum of 20,000 rupees to Rs 2 lakhs per month depending upon one's work and creativity with an initial investment of 1.5 to 2 lakh rupees. A beginner level tattoo artist can earn a minimum of 20,000 rupees per month, which gradually increases to a couple of lakhs or more depending upon the caliber of the artist and the uniqueness of their artwork. And I'd like to leave you with an interesting data by Advanced Dermatology that revealed that 63% of people with a tattoo smaller than the palm of their hand regret it. The reasons being impulsive decisions, 35%, significant meaning, 29%, or the idea that it would make them look cool, 18%. Thank you for watching and stay tuned to NDTV Profit for more.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today.
Welcome back. You're watching the Small and Mid-Cap show. This is Mahima Vachrajani. Well, the other company on our radar on Small and Mid-Cap show today is NLC India. The company recently won an MOU with Rajasthan government of around 7,000 crores to set up a joint venture for adding thermal renewable capacity. Additionally, the government has opened an offer sale on March of 6 to raise capital worth 2,100 crores. Furthermore, the company is targeting to double the mining and renewable power capacity by 2030. Prasanna Kumar, CMD NLC India, joins us now. Welcome to the show, sir.
Thank you, madam.
Right.
Good morning.
Good morning. So my first question to you is that this JV with Rajasthan government, it's around an investment of 7,000 crores. Now, first question is that what is your stake in this JV and when will this be operative and what kind of revenues are we expecting out of this?
Yes. Madam, as you know, Rajasthan is blessed with lignite resources and NLC is having expertise in utilization of lignite. That's why this JV is formed to utilize the lignite in the Rajasthan and setting up of thermal power generation there. And we are also setting up of 1,000 megawatt solar power plant also in the Rajasthan. So the total investment will be 7,000 crores and the majority of stake will be with NLC and it will be operated by NLC. And we are expecting after making it operational, we are expecting a return of around 15 to 16% from these investments.
Right. And also recently you signed a power purchase agreement with the Gujarat government with GUVNL for 600 megawatt solar power in Gujarat. What are the kind of synergies that you're expecting out of this? What kind of revenues will flow to your PNL through this MOU?
Madam, this 600 megawatt solar project is the largest at one place for NLC India, and it is being constructed in Khavda solar park, where the radiation levels are highest in the country. So we are expecting very good efficiencies out of it, and we will be investing around 4,000 crores for this project. And here also we expect a return of around 15% from this business.
Right. So considering both of these projects, where does this take your margins at once when you start realizing gains from these projects?
But we will be completing these projects in the next one and a half year, and we expect that our it will add to our revenue as well as profit substantially, and that will improve our bottom line.
Right. Can you just give us a number as to how much your margins will improve by?
It is very preliminary to talk about the margins, madam, but the margins will be substantial.
Right. Okay. And so considering these two plus the entire order pipeline that is there with NLC right now, what is the pipeline at present and what does the execution timelines look like for the entire pipeline?
Madam, as on date, we are 1.4 gigawatt renewable capacity company, and we are targeting to become a 6 gigawatt company by 2030 with an investment of more than 24,000 crores. So as on date, 2 gigawatt projects are in pipeline. 600 megawatt in Gujarat, 810 megawatt in the state of Rajasthan, and in the Pugal Park, and 300 megawatt in the Bikaner district. Total 2 gigawatt projects are in pipeline, and these 2 gigawatt projects will be completed in next 1.5 years. And subsequently also we are having projects in pipeline. We are installing solar power plant in the mine reclaimed land also, which is first time in the country, of 50 megawatt capacity. With all these things, we will become a 6 gigawatt company by 2030, madam. That is our plan and target.
Right. And what is the capacity utilization of all your plants at present?
The capacity, when you are talking about the solar plants, these plants are in operation for last 4 or 5 years. It is capacity utilization is in line with the design. It is different from different projects. For some projects is 19, for some project it's 20. They are in line with the design. They are operating in line with the design. Apart from the focus on the installation of the solar plants, we are focusing on the O&M of the solar plants also, so that we can get maximum benefit out of the solar plants.
Right. And in terms of lignite versus power, what is the revenue mix at present?
Madam, actually, our lignite production and power production both are interrelated because we feed our own lignite to our thermal power stations. So most of our revenue comes from the power generation portfolio. More than 70% our revenue comes from power generation portfolio, but it is a combined revenue of both for mines as well as thermal power generation. Whereas in our coal sale, we are also going for the sale of the coal substantially, and it is more than the whatever we did in the last financial year.
Right. And in terms of your under recovery, what was the under recovery total for the 9 months that have gone by, and where will this stand at by the end of FY24, and how has this impacted your top line and bottom line?
Actually, madam, last financial year there was a problem in land acquisition in the Neyveli area, and also there were a number of problems because of the heavy rains, and that happened. Because of that, one of our unit was under shutdown. So the approximate under recovery is around 400 crores, and we will end up with around 400 crores of under recovery, which will be less than the last financial year.
Right. And how has this impacted your top line and bottom line?
This under recovery 400 crores is direct impact from the top line and bottom line. But this we are compensating by increased production in the last quarter of this financial year. Already our lignite production reached 1 lakh metric ton per day. And also we are compensating through the sale of the coal that is happening at Talabira. With all these things, we are trying to reduce the impact.
Right. And with reference to your OFS sale, you must have met your investors. Are there any concerns that the investors have been raised, and have you addressed those concerns? What are these concerns, if you can tell our viewers about it?
Madam, the overall in whatever interaction we had, the investors are very happy about the performance and the strategy we are following in balancing the conventional power generation and renewable power generation. And there is a positive feedback from all the investors. And whatever doubts are there, those doubts we already cleared. And the investors are overall, they are happy with the performance and strategy being followed by NLC.
Right. Thank you so much for speaking with us at NDTV Profit, sir. It was a pleasure talking to you. Well, let's go on to Supreme Court. They're talking about electoral bonds. Listen in.
The Finance Act 2017, which amended the provisions of the Representation of the People Act 1951 and the Income Tax Act 1961 unconstitutional on the ground that the non-disclosure of information regarding the funding of political parties is violative of the right to information of citizens under Article 19, bracket 1, bracket A of the Constitution. Full stop. The amendments which were introduced by the Finance Act 2017 to the provisions of the Companies Act 2013, permitting unlimited funding of political parties by corporate entities were held to be arbitrary and violative of Article 14 of the Constitution. Full stop. Next para. In order to give full effect to the judgment which was rendered by the Constitution Bench, This court directed the State Bank of India, footnote SBI, which was the authorized bank to deal with electoral bonds under the electoral bond scheme, to submit details of the electoral bonds purchased by the contributors and redeemed by political parties between 12 April 2019, into brackets, the date on which an interim order was passed by this court directing the Election Commission of India, footnote ECI, to collect details of the contributions, bracket, till 15 February 2024, bracket, the date of the judgment, full stop. This court directed SBI to submit the following details by 6 March 2024 to the ECI. A, details of each electoral bond purchased, including the date of purchase, the name of the purchaser, and the denomination of the electoral bond, semicolon, and B, details of each electoral bond redeemed by political parties, including the date of encashment and the denomination of the electoral bond. Stop. The ECI was directed to collate the information which was to be submitted by the SBI and publish it on its website by 13 March 2024. Stop. The directions of this court are extracted below, colon, आप copy कर लीजिए, para 219 at page 76. Right. The 2 page. Para.
Lord, it's 221, page 76 of the application.
The SCC has a, all right, आप ऐसा कर लीजिए, ये para ऐसा है 219, 221 जो भी आप ले लीजिए. It may be on SCC online, it's 221. The para begins with the words, in view of our discussion above.
Yes.
Okay, the following directions are issued, and the last word which you will copy down is the purchaser's account. Okay. SBI filed a miscellaneous application before this court 2 days before the expiry of the deadline, seeking an extension of time until 30 June 2024 for complying with the directions. Full stop. The petitioners before this court, Association for Democratic Reforms, and the Communist Party of India, bracket Marxist, bracket, instituted contempt proceedings, instituted a petition invoking the contempt jurisdiction of this court against SBI for an alleged willful disobedience of the order of this court. Full stop. in support of the application by SBI, I've heard Mr. Harish Salve, Learned Senior Counsel. Full stop. Mr. Salve submitted that the information which was which was received by the SBI was maintained in two separate silos and were maintained with the utmost secrecy so as to fulfill the core purpose of the electoral bond scheme. Full stop. Learned Counsel submitted that if the disclosure is to be made of the information required to be submitted by SBI to ECI in the separate silos which are referred to in B and C of the operative directions, there would be no difficulty in SBI doing so, which, it has been indicated, would be completed within 3 weeks. However, it has been submitted that the difficulty of SBI arose since it construed the directions of this court in requiring it to carry out a matching exercise to match the donor details, the donor and bond details with the corresponding details pertaining to encashment by political parties. Full stop. While evaluating the submission which has been made on behalf of SBI, a reference to some of the key aspects of the scheme would be in order at this stage. Full stop. Clause 7(4) of the electoral bond scheme stipulates that the information furnished by the buyer of an electoral bond shall be treated as confidential by the authorized bank and shall be disclosed only when called upon to do so by a competent court or upon the registration of an offense by a law enforcement agency. Full stop. Thus, in terms of the provisions of the electoral bond scheme itself, SBI is mandated to disclose information when demanded by a court. Full stop. What remains to be seen, what has to be analyzed is whether SBI is justified in seeking an extension of time. Next. SBI seeks an extension of time on the ground that the process of open inverted commas decoding the electoral bonds and matching the donor to the donations into inverted commas complete is a complex and time-consuming exercise. Full stop. To substantiate this argument, SBI has averred that, next line, A, information is not available in a digital format. Yeah, the line kar dijiye. colon, clause 7.1.2 of the standard operating procedure regarding the sale and redemption of electoral bonds stipulates that, into invert commas, no details of bond purchaser, including KYC and other details, will be entered in the core banking system, into invert commas, complete. Thus, comma, the details of the purchases of bonds are not available centrally, semicolon. B, the donor details and recipient details are available in two separate silos, ये underline कर लीजिए, colon. The details of the purchasers of the electoral bonds were kept in a sealed cover at the designated branch. These sealed covers were deposited in the main branch of SBI in Mumbai at the end of each phase of the issuance of the electoral bonds. Full stop. The information on the redemption of electoral bonds, into brackets, that is the original bond and the pay-in slip, bracket, were stored in a sealed cover and sent to the SBI, Mumbai branch. Semicolon. C, matching of information in the two silos is a time-consuming process. So underline कर लीजिए, colon. The matching of the information on the purchase and redemption of electoral bonds would be time-consuming since donor information and redemption information is maintained in two distinct silos independent of each other, semicolon. D, there is a large there is a large number of data sets to decipher, underline, colon. A total of 22,000 odd, एक second, I'll give you the figure.
22,217.
A total of 22,217 bonds were purchased between 12 April 2019 and 15 February 2024. Full stop. This would cumulatively add up to 44,434 data sets, since there are two silos of information. In other words, comma, the compilation of this information would be a time-consuming process. Full stop. Next main para. The crux of the submission of the SBI is that the matching of information to ascertain who contributed to which political party is a time-consuming process, since the information is maintained in two separate silos. Full stop. Now, the operative directions which have been issued by this court, as reproduced earlier, the operative directions of this court directed the SBI to disclose the transactions as set out in Direction B and direction C extracted above. Full stop. SBI submits in its application itself that the donor details and redemption details are available, comma, albeit in separate silos. Full stop. In other words, the directions which have been issued by this court require SBI to disclose information which is already available to it. Next para. At this stage, it would be material to refer to the FAQs on electoral bonds published by the SBI, which states that the Know Your Customer documents must be submitted by the purchaser each time that the bond is purchased, irrespective of whether the purchaser has a KYC verified SBI account. Full stop. That is, वहाँ फुटनोट दे दीजिए और उसको FAQ क्वेश्चन नंबर 16 जजमेंट से मैं आपको बाद में बताता हूँ कहाँ से लेना है आपको. That is one set of documents, into brackets, the electoral bond application form, comma, KYC documents, and pay in slip, can, bracket complete, can only be used to purchase one electoral bond. Full stop. Contributors who have an SBI account, as well as those who do not, have to submit the electoral bond application, Know Your Customer documentation, and proof of payment through NEFT, check, or demand draft. Full stop. Thus, the details of the electoral bonds which have been purchased and which have been directed to be disclosed by this court are readily available. Next. The FAQ, similarly, the FAQs on electoral bonds published by the SBI with respect to the redemption of bonds states that each political party can only open one current account for electoral bond redemption. Full stop. The current account could be opened by the political party only in 4 authorized branches in Chennai, Kolkata, Mumbai, and New Delhi. Full stop.
There are 29, factually, nothing turns on that.
All right, 29
designated branches.
29 designated branches.
Yes.
Amul has completed 50 years in India. PM Modi will attend the Silver Jubilee celebrations of the Gujarat Cooperative Milk Marketing Federation, the owner of Amul. At one point of time or the other, we've all grown up with Amul butter or milk for sure. The famous Amul girl created in 1967 is family. We all recognize her. But as the brand grows 50 years old today, do you remember the full form of Amul? It is Anand Milk Union Limited. From producing 250 litres of milk per day since the time Amul was formed back in the mid-90s to today, where Amul has over 36 lakh dairy farmers and produces nearly 300 lakh litres of milk per day, the brand has had a long journey. The story goes way back in time. In the 1940s, dairy farmers were worried. The middlemen exploited their ways of profitable income, and a poor milk production system made their living difficult. Tribhuvan Das Patel and Verghese Kurian identified these issues and helped in the formation of the first milk union called Kaira District Cooperative Milk Producers Union in 1946. The cooperative model gave farmers direct ownership of the dairy industry. The union helped them process, market and sell milk and milk products without the interruption of intermediaries. And it was in 1955 that this union chose a brand name for itself called Amul, which means priceless in Sanskrit. And then, in 1973, Amul Dairy, along with 16 other district cooperatives, formed the Gujarat Cooperative Milk Marketing Federation, which has now completed 50 years in India. Amul also started India's white revolution that made our country the world's biggest maker of milk and milk products. The brand follows an umbrella marketing technique which has helped GCMMF prevent association clashes and keep an open door for the patrons to coordinate in creating items. As per a report by Statista, the annual sales turnover of Amul from 2011 to 2023 has consistently risen, recording about 55,000 crore rupees of turnover in 2022-2023 alone. And did you know, Amul has also held a Guinness World Record for having the longest continuous run of any advertising campaign that has ever taken place anywhere in the universe. Amul Doodh Pita Hai India and Utterly Butterly Delicious will always strike a chord. Let us know which famous advertising phrases of Amul do you remember.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Welcome back. You're watching NDTV Profit. Live news at the bottom of your screen. Breaking news coming straight from this Supreme Court of India. And they're talking about the electoral bonds case in the Supreme Court, and the Chief Justice of India ruling just now that there will be no extension of time for the State Bank of India to provide the details of the donors as well as the redeemers of the electoral bonds. Remember, the deadline that was previously set in the judgment that was passed a few weeks back was the 6th of March. This has, of course, been passed, and it was pointed out by the CGI that an application was sent in by the State Bank of India 2 days before that deadline. It has now said that the SBI is directed to disclose details at the close of business of the 12th of March. So the application to extend the deadline to June has been dismissed. it has also said, the Supreme Court has also said that the Election Commission of India shall compile information and disclose details on the website not later than the 15th of March as of 5 p.m. To give you a little bit of context of what has happened and what was discussed in the court today, the application that was made by the State Bank of India, they were saying that there are procedural difficulties in compiling the information sought by the Supreme Court of India, in that they were saying that a lot of the information on the electoral bonds is collected at branch levels, and there were over 22,000 such electoral bonds that were sold or that were issued within a period of time, within certain number of years, up to 2024. And they've said that there are sealed envelopes that go to a branch in Mumbai, and to cumulatively get all of that information and to match the donors as well as the redeemers is a time-consuming exercise. However, the CJI pointed out that all of the information that has been sought by the Supreme Court of India is available with the State Bank of India, albeit that is despite the fact that the SBI is saying that it does not have this information readily available. It is available in two separate formats. So the crux of the situation is that no extension of time has been provided. 12th of March is when State Bank of India is going to have to submit these details. Now, let's move to regular programming as things stand very, very quickly. Unfortunately, we don't have a lot of time. However, we're joined by Gaurang Shah of Geojit Financial Services and Rajesh Palvia of Axis Securities. This is, of course, Ask Profit, and a few of you have asked questions. Priti Chaudhary is joining me in studio. We have a few minutes to take questions. So the first one I will take is from Martin, and he's writing in from Mussoorie. He's got a question on NHPC. He says that he's wondering whether to buy more of this counter. The stock is currently trading at 90 or thereabouts, and what the outlook is. Gaurang, I'll come to you on this one. What's the view on NHPC?
Thank you, Alex, and morning to all of you also. Power generating company post IPO, both NHPC and SJVN languished for a better part and below the IPO price. And then because of the policy changes, most of the power generating companies have performed well. No specific coverage on NHPC, but we remain positive on the sector power generation. And what we like in that sector is Tata Power, NTPC, and CESC Limited. But the entire sector looks quite good in terms of performance.
All right. Very quickly, then let's go to the next one, Smriti.
Yeah. Good morning. So insurance stocks are in focus today, and the next stock that we're talking about is GICRE. We have a question from Prashant Singh from Jalgaon, and he says he's bought the stock 4,500 shares at 461 a piece. Now, Rajesh, what's the outlook on this one from a shorter term perspective?
So, morning. Stock is in corrective move. If we analyze the near-term structure, stock is moving in down-sloping channel on daily chart. Stock slipped below to its 20-day, 50-day moving average. So, some pressure we can see in GICRE in coming trading session. And we can see stock to correct further towards 335, 330 kind of zone. That's the major level on the downside. So I think this corrective move can extend until the stock not crosses above 375, 380 zone. Some pressure is likely to be there. Again, he should review around 335 kind of zone. If it's take support around those levels, then he can average out around those levels.
Okay. Since we're running out of time, a very quick view on the benchmark. Rajesh, what are the key levels to watch out for? Nifty 50?
So Nifty is trading very near to critical support area of 22,400 on spot. If it breaks those levels, then we may see further more down tick, and then possibly Nifty can slide further towards 22,350 to 22,300. That's the important level. Bank Nifty is showing underperformance, and Bank Nifty is now slipped below to 47,700. That was the put-based concentration, and looking at the current structure, we believe that if it's remain below to 47,500 on spot, then furthermore unwinding pressure we can see, and possibly 47,200, 47,100 kind of level we can see on the downside. So until the 47,800 not again able to regain by Bank Nifty, some more pressure is likely to be there in one or two trading session.
Right. Rajesh as well as Gaurang, thank you so much for taking the time. Apologies for this curtailed session, but pleasure as always having you on the platform. Viewers, we had to cut short this particular edition of Ask Profit for obvious reasons. There is breaking news and we'll bring you more details on that in just a short while. Do stay tuned. This is NDTV Profit.
Hello. Good morning, ma'am. I'm speaking from XYZ company. Are you looking for a job or a job change? Have you been receiving unwanted calls from spam numbers? Are you tired of being offered new jobs, insurance schemes, or free health checkups? Well, today we will look at an interesting survey report by local circles on pesky calls that received 60,000 responses. Most unwanted calls are related to financial services, 54%, and real estate, 22%. In fact, the report has taken names. 40% mobile subscribers have identified Bajaj Finance as a top offender, HDFC Group as the second biggest pesky caller. The report reveals that 60% of people received 3 or more spam calls on an average day every day, and 92% of people registered on the Do Not Disturb list still get pesky calls. So is being listed on D&D working? Clearly not. But the report also recorded a minute relief as per which 6% people don't get any such phone calls. This relief comes after the TRAI directive to banks, insurance companies and other commercial entities. TRAI is the Telecom Regulatory Authority of India. In fact, the Department of Consumer Affairs has constituted a committee comprising members of different regulatory authorities, telemarketing companies, and cellular industry to draft the guidelines to address the issue of pesky calls. So yes, pesky calls are still a worry, but there is a little relief too. Can you ignore them though? Toll-free numbers are identifiable, so institutions have found a new way. According to the report, calls from different mobile phone numbers that seem to belong to companies or brands have risen from 29% in February 2023 to 36% now. And look at the change in trend. Real estate selling has risen from 18% last year to 22% now. However, job offerings have decreased from 10% to 4%, and in the case of those selling financial services, the calls have slipped from 60% to 54%. So the bigger question is, will the nuisance of pesky calls end anytime soon? There should be a system where pesky callers are blacklisted at the Aadhaar level, so they have the risk of not getting a new SIM. Also, brands on whose behalf the contracted callers are calling also need to be held accountable by the Department of Consumer Affairs, so brands institute the right consumer outreach practices both with employees as well as third-party contractors. For more such updates, stay tuned to NDTV Profit.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
there are different types of stocks. Large cap stocks, mid cap stocks, and small cap stocks.
How to decide which is the one for you? First, decide on the
Don't listen to anyone and everyone.
When it comes to your hard-earned money,
Join us as we put the spotlight on 6 stocks.
on your show, Hot Money.
Stock selection isn't an easy task.
And neither is choosing the right moment to sell
Whether it's a doubt about a short-term trade
or a long-term investment
all you have to do
is ask Profit.
Welcome this to Hot Money. This is Samina Nalwala, and joining us today is a very special guest, Vidit Shah of Spark. The reason Vidit is joining us today is because it's been an interesting story for the last couple of days, where his report by Spark actually sparked a very sharp rally amongst Tata Group stocks over the last few days. Of course, then the weekend came and there were reports that Tata Sons may not be looking at an IPO. All that has led to some of these Tata stocks declining anywhere in the range of 8 to 10%. But Vidit Shah of Spark joins us to help us understand what that report was, whether or not an IPO from Tata Sons is likely, and what can it mean for companies like Tata Chemicals. Vidit, morning. Thanks for joining us. Vidit, I think you single-handedly led to enough and more excitement around those Tata stocks, where everyone picked up on the report. The stocks have rallied. Tata Chemicals is up 40% all of last week. Some of the other Tata Group companies as well have done well on hopes of a Tata Sun IPO over the next 18 months. I want us to take a step back, and I want you to tell us what made you, put out the report? What led you to believe that an IPO from Tata Sons is likely at this stage? And also, do you still believe that, or do you think that is one of the scenarios that could play out for Tata Sons?
Hi. Firstly, thanks for having me, Samina. What led me to, so there were a few reports that were published the week prior about the potential listing of Tata Sons in a year and a half's time. And deep diving digger, we noticed that there is a lot of value that one could ascribe to the Tata Sons group. So we ascribed about 8 lakh crore value to the group. And to answer your question whether the IPO is the only way out, no, it isn't. The RBI has classified it as one of several upper layer NBFCs, and it's classified as a coal investment company. So the mandate is to list within 3 years of this identification, which was back in September 22. So that's one way out. The other way out would be to restructure its group holdings and debt for it to not be classified as an upper layer NBFC. So those are the two primary options available to the group as of now.
Vidit, then what do you think is the more likely scenario to play out at this stage?
Well, that's difficult to tell. The advantage of listing could be to give exits to the non-core shareholders or the non-trust related shareholders. But also, given that it's a conglomerate which makes several investments, and given its capital allocation that it keeps on doing, it could also potentially not want to list and have the freedom to allocate capital in a way that they can think is prudent.
Agree, and investors in the IPO are likely to give holding company discount of 30 to 60% while calculating the equity value, which is probably not what Tata Sons may want at this stage. But one of the big reasons that this Tata Sons IPO got so much of attention is because it led to a very sharp rally among some of its group companies, like Tata Chemicals that owns about 3% of Tata Sons. The simple math on that is 33,000 crores of market cap. They own about 20-odd thousand crores of Tata Sons. Intrinsic value goes up much higher. Do you think the only way to unlock value on Tata Chemicals is by the list that the holding it has of Tata Sons is through listing of Tata Sons?
Yeah, so, as the report says that, the 8 lakh crore value that we ascribe to Tata Sons, 2.5% of that ascribes a 20,000 crore value to the investments that Tata Chemicals holds in Tata Sons. And that sort of comes to about 65% of today's market cap. Now, that itself, lowers the intrinsic PE to a likely 11 to 12x of, consensus street estimates. But the other companies that hold a stake in Tata Sons or Tata Motors, Tata Power, and Indian Hotels, and the value of their investments to their overall market cap is about 6 to 10%. So yeah, Tata Chemicals is likely to be the biggest beneficiary of a potential listing if Tata Sons were to list.
Vidit, you put out a very valid point on your report saying that cross-holding has usually been a concern for investors for a while now, and a simplified structure will enable Tata Sons to have better control over the promoter votes on shareholder resolutions as well. Now, we've seen what Chandra is doing. In the last couple of years, we've seen them simplify other group companies as well. So while there are enough reasons why Tata Sons may not consider an IPO, there is enough and more reason that this IPO, if not today, will become a reality eventually.
Well, eventually, it's difficult to say, because as long as the group continues to make forays into new age technologies, there could be more and more capital that has to be allocated to this. So it's difficult to say when that eventuality will come, and the street may, given the uncertainty, may increase the holdco discount further if they don't see the IPO happening in the near term. So the near term creates a buzz. The near term IPO potential creates a buzz, but you could see the street increasing the holdco discount should the IPO be elongated.
Right. Vidit, I know you don't track Tata Chemicals specifically, but if this IPO doesn't go through, in fact, as that buzz has fizzled out this morning, we've seen some of these counters take it to the chin. Do you still feel like, it's a what-if case, I do understand that. What does an investor do with Tata Chemicals at this stage? Would you be able to have an opinion on that, or that looks unlikely? Because you are largely looking at it from a Tata Sons angle.
Yeah, so I'm sorry, I don't have an opinion on Tata Chemicals because we don't cover it. But, I can tell you that the value of Tata Sons is a significant portion of its current market cap. However, the sector itself is also facing headwinds, as you would be aware as well. And the chemical industry has been under some pressure over the last year or so. And there is demand and realization pressures for Tata Chemicals based business.
So very lastly, there are some reports that are indicating that the Tata Sons, in order to avoid a skirt the IPO, may look at hiving off some of its businesses. They may move out the financials into Tata Capital, because that, I believe, also needs to be listed for the upper limit NBFC. Do you think those are the probable scenarios or outcomes that could be expected from Tata Sons?
That's true. So, like I said at the start, right, that it has a couple of options. One is to IPO, one is to restructure its group holdings and debt, and that is one way that they could do it, is via transferring some of its debt and holdings to Tata Capital. Only time will tell which route they choose to take, because we've been hearing contradictory reports as well. So time will tell, but should the company list, there is a lot of liquidity that is created for its group company investments.
But for now, very lastly with it, you're still holding tall the report, right? That still stands, because everything that we are playing out is assumptions either made by newspaper agencies, television channels. Of course, what you have is data-backed reports that you're giving out.
Exactly. So the report is on the assumption that it lists who the biggest beneficiaries could be. So that is likely to play out on the listing if at all that was to happen. Yeah.
Right. Thank you, Vidit. We'll of course try and connect back with you once we have some clarity over the next couple of months from Tata Sons, whether or not there is a listing that we could be expecting, and if not, what if that scenario then plays out. But thank you for taking the time out and talking to us. It was great getting some perspective on that report. That was Vidit Shah highlighting if there is an IPO from the Tata Sons stable, Tata Chemicals could be a big beneficiary as they hold 3% stake, and so would some of the other Tata Group companies. But more importantly, there are also reports indicating that Tata Sons may skirt the IPO for now and may look at rejigging to, of course, avoid that IPO for as long as they can. But let's not forget, N. Chandra has been trying to simplify the structure, and that's what we've seen across other Tata Group companies. So for now, nothing can be ruled out. All we can see today is some of those Tata stocks seeing some profit taking after a very sharp rally last week. With that, we'll wrap up this edition. Thanks for watching.
The farmers' protests have been making headlines. Indian farmers have demands such as legal guarantee on MSP, pension and debt waiver, no hike in electricity tariff, reinstatement of Land Acquisition Act 2013 and more. But while the protest becomes important from the point of view of elections and politics, it's not just India that has its farmers agitated. The streets of Spain, Belgium, Hungary and Poland have been roaring with protests by farmers too. Around 1,400 tractors took part in a protest in Poland and roads were blocked across the country. What do they have a problem with? Rising production costs, falling sale price, stringent regulations. They say that the European Union is not doing enough to stop cheap imports from Ukraine, which is affecting the demand for local produce. They are also not happy with the European Union's Green Deal that's designed to zero out pollution by 2050 because it limits the use of pesticides, which in turn affects yield. In Greece, farmers have demanded lower electricity prices, tax-free diesel and subsidized animal feed. In France, farmers have been fighting for improved pay and protection from foreign competition. The French government offered 400 million euros, that's $436 million, in various measures in reciprocation to their problems over low earnings, heavy regulation, and unfair competition from abroad. In Germany, farmers are against the government's decision to phase out tax concessions on agricultural diesel. Their argument is that this will lead them to bankruptcy. In Romania, the protests stem from anger about low prices for produce, rising costs, imports of cheap foodstuffs, and constraints imposed by the European Union's drive to fight climate change. In the United Kingdom, farmers are struggling to keep up with weather changes and war-related supply chain disruptions. The whole of Europe seems to have the agricultural sector in pain as climate change becomes a central focus and production prices increase. And no, it doesn't end there. As per Down to Earth, since 2023, farmers have protested in 67% of countries in South America region for a variety of reasons, such as wanting better export exchange rates and reduced taxes amid an extended economic downturn and Argentina's devastating drought, which has severely damaged crops and agricultural output. And look at this data. Farmers' protests have happened in 12 countries in Africa, 11 countries in Asia, 24 countries in Europe, 8 countries in North and Central America, and 2 countries in Oceania in just a year's time. So let's boil down all this worry to 5 main reasons, India included. Pricing of produce, delayed compensation or subsidy, unfair effects of climate change, policies and regulations, import and export duties, and supply chain discrepancies. What does it say about the world of agriculture? Does it just question politics and governance, or does it hint at a bigger problem, a potential global food crisis?
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles.
Welcome back to Hot Money, and now we take a look at all the stocks we want to address today. Well, we are going to have Torrent Power on our radar, and of course, if time permits, we're also going to figure out how things are panning out for GAIL, ONGC, and of course, Interglobe Aviation. And for that, we are in conversation with Avinash Gorakshakar, Director of Research at Profit Mart Securities. Avinash, good afternoon. Thank you so much for joining in. Let's start off with Torrent Power, because I believe that it's won yet another very large order. And this time around, what we're seeing is this particular award is for an order worth about 1,540 crores. This is for setting up a 306 megawatt grid connection solar PV projects. And of course, solar PV projects has something which has taken a lot of momentum off late. And the project is expected to be commissioned within 18 months. So it's not a very large time span either, which is potentially why we are expecting Torrent Power to garner these funds sooner than later. Avinash, how are you looking at Torrent Power? It's gone from strength to strength. In fact, even at the moment, it trades near its life highs. What do we do with this one?
Yeah, I think good afternoon, Agam. My sense is that Torrent Power would see significant kind of earnings and revenue traction now for the coming 12 to 15 months, because this order execution time is not very long. They have to complete this order in the next 18 months. And I think this is a large order. So I think my sense is that, they could definitely make decent EBITDA margins in this, product category. And I think once the execution starts quarter on quarter, you could see the impact of that coming in FY25. So I think what you're seeing today is that despite a sluggish and a volatile market, when the broader indices are down, Torrent Power is up largely because of this news flow. And I think the markets are factoring in a strong earnings growth for the next year, that is FY25. So I would not be surprised that, we could be seeing levels of even 1,300 or, 1,350 here, because I think earnings growth trajectory, both from the existing business and from the new order book, will actually start trickling down in FY25. So I think net, my sense is, of course, at these levels, the stock has risen fast, but any correction could be used as an opportunity to, include it in one's portfolio.
Okay. All right. So that's the view on Torrent Power. The other stock that you want to talk about is GAIL. GAIL has, of course, been buzzing on several reasons, but they're all positive, even as the stock is down by around 2.7% today. But don't forget that it's coming off from life highs that it's made very recently. Now, we have a Citi report, and it actually talks about India refiners, but it also mentions GAIL in there. And they say that domestic LPG price cuts is something which is manageable for a lot of these companies, and they retain a positive stance on companies like ONGC and GAIL. And based on that, we have seen them maintain, largely upward expectations for GAIL and ONGC. Moreover, ONGC and GAIL have also signed another agreement with Shell, And that, of course, is another positive development. But for some reason or the other, we have seen weakness in both GAIL and ONGC at the moment. Avinash, what is your stance on, well, GAIL specifically? I'll talk about that one. And where do you see it going from here on?
No, I think, Agam, my sense is that cut in LPG prices is something the markets are a little worried about. More importantly, I think market would be looking at concrete data points, how the next couple of quarters are going to pan out, because any kind of pricing cuts would obviously immediately lead to some sort of little bit of margin erosion. Of course, they would be making up via volumes. But my sense is that of late, most of the natural gas players like Mahanagar Gas, Gujarat Gas, Indraprastha Gas also saw a lot of pressure, because there were some reports stating that price cuts could come in and the government is not going to interfere here. So my sense is GAIL definitely has the benefit of a well laid down infrastructure. Obviously, it's one of the largest pipeline gas companies. So I think to a larger extent, one could get some concrete evidence of this only post the September numbers. So I think till that time, it could at best be a market performer, but I don't think you're going to see a very large price correction. So I think investors who have the stock should hold on. Fresh buying should be done by only those investors who've got a slightly longer term view. I don't think in the short term the stock can get re-rated, but yes, post September there won't be much more clarity on the numbers, and that would be a time where possibly you could see a better growth trajectory for the company once more data points are available.
Okay. And the final stock that we want to address today is Interglobe Aviation. Now, what we understand is that promoter Rakesh Gangwal has sold up to 5.8% stake in this particular company with a floor price of around 2,925. Of course, currently Interglobe is trading at around 3,151 rupees per share. So after making that low in today's day of trade, it has continued to advance. And after the stake sale, Gangwal's stake will decrease to around 5.9%, but that perhaps is inconsequential. I reckon that to a certain extent, that overhang of this gradual reduction of Gangwal's stake in the company is moving out of the way, which is why that is perhaps giving investors a little bit more confidence going in. Remember, as I said and mentioned earlier, that Gangwal's stake now stands at around 5.9%. Would that be the case, Avinash, the fact that this overhang is gradually reducing?
So I think one reason could be that, Agam, but I think clearly the markets are quite excited considering the kind of growth in the airline traffic and the cooling off of the crude prices. Because I think in the current year, my sense is that not only the third quarter was good, but I think the coming financial year will be quite significant for Indigo, considering the fact that some fleet expansion could happen, and I think rates have stabilized. So I think more importantly, the airline traffic is now going to be a key trigger point. I would not be surprised that this stock now almost controls 50% of the market. So a great degree of pricing power has already got built in the company. So typically, I think this is one stock where I think I would suggest one could look at buying the stock on a slightly correction mode. Although at least for the next 12 to 15 months, the outlook remains positive. So I think this stake sale is not going to be significantly going to impact the stock. In fact, after the sale, the stock has moved up, as you rightly mentioned. So I think longer term data points are going to get better and better as yields get better. And hopefully crude remains at these levels. I think, Agam, you could see better profitability from Indigo. So we are positive on the stock, but yes, I think you buy at slightly lower levels to get a better risk reward, in the portfolio.
Okay. Expect to better profitability, but perhaps the entry would be preferable at lower levels. That's the word coming in from Avinash. Avinash, on that note, taking a moment to thank you for joining us and taking us through your views on the several stocks that we've spoken about. And with that, we are completely out of time on this edition of Hot Money, but don't go anywhere. Lots more lined up on the other side. Stay tuned to NDTV Profit.
Hello and welcome to NDTV Profit. Today we will talk about tattoos and the worth of this market. The history of tattoos in India can be traced back to prehistoric times when tribal people were captivated by drawings on stone or wood walls. Their attempt to replicate these figures through needles gave birth to the practice of inking skin. Over the course of time, tattoos were embraced by tribals as a mark of bravery, war, religious beliefs, customs, marital status, protection from the male gaze, and so on and so forth. Today, in 2024, tattoos have become a means to express thoughts, individuality, personal experiences, and sentimental designs. The industry is estimated to generate over 20,000 crore rupees per year. What is driving this growth? One of the key drivers behind the growth of the tattoo market is the rising demand for customized and unique designs. Improved technological equipment for making advanced, safer, and painless tattoos have boosted the market. The laser technology for removal or modification of tattoos have also added to the surge. Increased exposure and promotion of tattoo designs on social media have led to widespread influence of tattoo culture on the youth. Take a look at these figures now. As per Fortune Business Insights, the global tattoo market is projected to grow from $2.04 billion in 2023 to $3.93 billion by 2030 at a compound annual growth rate of 9.87%. This is a sharp rise from 3.8% year-on-year growth between 2017 and 2022. As per Custom Market Insights, the diamond jewelry market is expected to grow at a compound annual growth rate of 5.5% by 2032, while the luxury jewelry market at a rate of 8.9%, but the tattoo market is estimated to grow at 9.5%. Is the tattoo business lucrative? According to an article by Opportunity India, tattoo kits are now easily available for less than Rs 10,000, while high-end kits range from Rs 20 to 35,000. Now, in a city like Mumbai, the average cost per inch is Rs 2,000 to 2,500. In Delhi and Bangalore, the cost per inch is between Rs 1,000 to 2,000, and in Goa, it is about Rs 500. We spoke to a couple of tattoo artists in Mumbai and found that at an average, the business earns them a profit of Rs 75,000 to 1 lakh per month. In fact, as per an article by India Today, a person can earn a minimum of 20,000 rupees to Rs 2 lakhs per month depending upon one's work and creativity with an initial investment of 1.5 to 2 lakh rupees. A beginner level tattoo artist can earn a minimum of 20,000 rupees per month, which gradually increases to a couple of lakhs or more depending upon the caliber of the artist and the uniqueness of their artwork. And I'd like to leave you with an interesting data by Advanced Dermatology that revealed that 63% of people with a tattoo smaller than the palm of their hand regret it. The reasons being impulsive decisions, 35%, significant meaning, 29%, or the idea that it would make them look cool, 18%. Thank you for watching and stay tuned to NDTV Profit for more.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable show.
If you want to be in the money.
there are different types of stocks. Large cap stocks, mid cap stocks, and small cap stocks.
How to decide which is the one for you? First, decide on the stock.
Don't listen to anyone and everyone.
When it comes to your hard-earned money,
Join us as we put the spotlight on 6 stocks.
on your show, Hot Money.
stock selection isn't an easy task.
Hello and welcome to NDTV Profit. You're watching The Portfolio Manager, and my guest today is Ashish Chaturmota, who is the Executive Director and PMS Fund Manager at JMFL. Ashish, thank you very much for joining us on The Portfolio Manager. The indices are at an all-time high. I wanted to check with you because your portfolio largely comprises of large cap stocks. How are you managing the stocks and the portfolio at this point in time?
Hi, good afternoon, Sajid, and thanks for calling me on this show. To give you a perspective, this strategy, what we call is our XPMS strategy, is basically we follow the concept of the FTPM approach, which is nothing but a combination of fundamentals, technicals, market dynamics, and psychology. We believe these are four important pillars, and considering this style of investing, this is a flexi cap strategy where at all point of time we have minimum 60% allocation which goes to NSE 200 names. So basically at all point of time you will see top 200 names having a weight of almost 60% bare minimum, which can increase to a higher side in case if you find some serious risk coming into the small and mid cap basket. And in a comfortable zone, when we find small mid cap in a comfortable zone, we try to be around 40% of our allocation into small and mid cap basket. So this is how the portfolio is positioned. But more importantly, where we differentiate ourselves is in the approach where we call that 60% of our allocation of the overall portfolio is buy and hold in approach, where the intent is to ride this longer term structural themes which are more aligned to the growth in GDP, which are more aligned to the sector's strength. And if we find that the sector is going to grow beyond the GDP numbers, then obviously if there are market leaders within those sectors, they are going to outperform significantly. But in the 40% allocation, what we call as a tactical or opportunistic bet, the intent is not to be really real buy and hold, but more on tactical allocation, which gives us a flexibility to identify some medium term trends which are emanating in the market and try to ride those trends at least in the medium term so that we can maximize the returns.
I guess that's the reason why you have a very good returns for the last 1 year, 37.3% for the last 1 year returns coming in, especially because of the mid cap and the small cap portfolio that you have been betting on. Ashish?
Yes, you're right. In fact, as you see the portfolio overall weight perspective, 63 to 65% at this point of time is coming from large cap space, which has actually done nothing in the last 1 year period, because if you compare Nifty 50's return versus BSE 500, Nifty 50 has significantly underperformed BSE 500. But in our portfolio at most of the times we are holding 50% allocation to Nifty 50. But despite that, we are able to outperform almost 400 basis point to BSE 500. The reason being because the bets which we took on basically on the small and mid cap has done phenomenally well, because in a short span of time, a lot of these stocks gave more than 100-200% kind of returns, and this really helped us in managing the drawdowns or underperformance which was coming typically from our large cap quality names which are not performing at this point of time. But we believe these are the names which we should be holding from a longer term perspective. So this definitely, the small and mid cap has really helped us. Also, what has helped us in large cap is because we entered on a very timely basis most of these power companies or public sector undertakings. So if you would have observed in our portfolio, we had a good chunk of public sector undertakings, including CPSC ETF or PSU Bank B ETF as a bet to ride this entire trend which is emanating in the PSU banks as well as the CPSC ETF. And apart from that, we believe that power is one space which is gaining a lot of traction. And as we can see that the renewable energy capacity, which is currently at 178 gigawatt, is going to grow to almost 500 gigawatt in next 7 years, which implies that almost 17% capacity CAGR growth we are going to witness in the space. And a company like NTPC, which is already going to create 30 gigawatt capacity addition in the renewable energy, we believe that this could be very, very positive for most of the power related companies. And as we all know that power is in demand, and with rapid industrialization, real estate, capex, manufacturing going to grow well. Even thermal you can't miss out, and that's how we bought Coal India at an appropriate time. So this has really helped us even in an outperformance which came from large cap names. So stocks like NTPC, Coal India, BPCL, CPSC ETF, and PSU Bank B's ETF were some of the large cap themes, but which really gave us good outperformance in last 6 to 9 months time frame.
Give me a sense of, you are an active fund manager, but I see that in the top 10 holdings, you have at least 3 ETFs which are there, which is Nippon ETF Nifty IT, then Bank B's, and Nifty Pharma ETF. What is the rationale of investing in a passive fund when you are an active fund manager?
Yes, so that's why we said that in 40% of our allocation we are very active. So there we don't hesitate to take an active call, even if we have to take that call within a month's time. Also, we will not hesitate to take those active calls. But when we try to identify some larger themes, and we believe that these themes can do really well over a long period of time, we try to play those themes. Even through ETFs. So for example, this PSU Bank B's ETF, I've been recommending since for last 4 years, since 2019-20, when this ETF was quoting at around 2021, both the public sector bank, PSU Bank B's ETF, as well as CPSC ETF, which used to quote at 22-23 levels. And today, if you look at these ETFs, these ETFs itself has given almost 4 times return in the last 3 to 4 years journey. The reason why we believe is that sometimes playing ETF makes a lot of sense is in the PSU banking basket. Initially, we it was very difficult to take a call beyond stocks like State Bank of India or Bank of Baroda for that matter, because there were a lot of concerns with regards to their asset quality, the kind of NP numbers they were throwing. But one thing was very clear: the way credit growth is going to emanate because of the manufacturing, because of the government capex government is trying to put in, a lot of private players will eventually come and will need a lot of credit, and that's how there is going to be a lot of credit growth momentum. And typically, most of these PSU banks, they try to be more on the corporate credit side rather than on the personal loans or what you call as a retail loan. And that's why we believe that if this loan growth momentum is going to be 17 to 18% kind of credit growth, NPA numbers is going to come down, because structurally this NPA cycle which we saw in 2011 is going to be behind us, and the stress is coming out of this public sector banks. But we were not sure whether it's going to be tier 2 or tier 3 players who are going to be a bigger leader. So rather than taking a bet on individual names, we thought that it's better to play the theme through a public sector ETF, and it really helped us in this 9 months. Also, I think this ETF must have delivered more than 40% kind of return. Same is the case with public sector CPSC ETF, where you have exposure to power, you have exposure to defense, you have exposure to oil refinery companies, which typically you want to avoid because you don't know when the government will take some stringent measures, and that will lead to margin erosion, or exactly what happened to ONGC at one point of time, where you put in windfall tax gain. But one thing was clear, that because of the governance level which is improving in the public sector space, the price to governance, which we call as, is a very standard metric to judge that if the governance levels increases, you start giving a higher PE multiple. And that's how we realized that rather than betting on individual names, it's safe to bet on a public sector ETF to ride this entire trend which is emanating in the space. Now, coming to IT, we believe that
because IT and pharma both have been very quiet in that sense. We've been seeing headwinds for both the sectors. Pharma has been pretty flat; it's not been giving much return. So, what is the rationale for investing in IT ETF and the pharma ETF?
So yes, so I think if you would have realized that a lot of these large cap pharma companies, they have started gaining some amount of price in the US markets, and there is some amount of pricing power which is coming back. So at one point of time, we were seeing double-digit, price erosion which was happening, but that has come to low single-digit in the last 1 year's time frame. And obviously, if we also try to understand from a technical perspective, you would have observed 2015 is where Nifty Pharma peaked out, and it is almost 7-8 years. After 8 years of consolidation, your pharma index is coming back to the to its previous zone, which clearly indicates that after 7-8 years of consolidation, if the index is coming out of a consolidation phase, there is a very strong possibility that we might see some relative outperformance, which we are going to witness in days to come. And as I said, the price erosion, which was almost in a double digit, is coming to a single low digit. This is also very, very positive for a lot of these pharma companies, and companies like Sun Pharma, which is doing extremely well on the specialty business in US. I think that is also going to be very positive. So what we realize that rather than betting again on an individual name, and since the sector is coming out of a consolidation phase and you don't know who is going to be the leader in the space, at that point of time, we try to bet initially first on the ETF, and then once we get a better clarity, that's the time we try to take a bet individually. You must have also observed there is one individual bet in the pharma space, that's Granules. So Granules, we were very comfortable on this API player, and that's how we decided to take an individual bet on Granules. And I think in the last 2-3 months itself, the stock has delivered almost 20-22% kind of return, again outperforming the broader pharma index. So you can compare Granules like a Midcap IT, how Midcap IT has been outperforming the broader large cap IT in the last 6 to 9 months frame. That's the same way I think a lot of mid-cap pharma companies which are more specialized in a particular segment, they are trying to show some strong relative outperformance compared to the broader pharma basket.
How do you look at ICICI Bank and HDFC Bank? We've seen some kind of headwind on HDFC Bank. The stock also had some setback after the lack of communication coming from the management. How do you look at that? Because these two seems to be the large holding for you in your fund.
So, I would like to draw your attention here as well. If you look at our top holding, it's ICICI Bank in terms of the allocation in the banking and financial basket. And in fact, we are, it might be looking on a top holding HDFC Bank as a position, but from a relative weight perspective, HDFC Bank, we have a significant underweight position. So if our current weight in HDFC Bank is close to 3%, whereas in the Nifty 200, this weight would be around 9 to 10%. So there's a significant amount of underweight which we are in HDFC Bank. Our returns which is coming basically from the banking basket is coming from ICICI Bank and the public sector PSU Bank, CTF and SBI. So I think these are the three names which are actually contributing to our banking rally. And my sense is ICICI Bank is consistently growing very well. It has managed its NIM expansion and is still quoting a discount to HDFC Bank. So our sense is this ICICI Bank could be a leader in the overall private banking basket, and that's the reason we are significantly overweight in ICICI Bank. But apart from that, it's BSU banks which are actually the significant overweight position in the banking basket.
Ashish, stay tuned with us on the Portfolio Manager. After the break, we'll discuss some of the sectors that he is bullish on. He spoke about defense a while back, so we'll discuss what he likes in the defense space as well. Stay tuned on the Portfolio Manager.
Amul has completed 50 years in India. PM Modi will attend the Silver Jubilee celebrations of the Gujarat Cooperative Milk Marketing Federation, the owner of Amul. At one point of time or the other, we've all grown up with Amul butter or milk for sure. The famous Amul girl created in 1967 is family. We all recognize her. But as the brand grows 50 years old today, do you remember the full form of Amul? It is Anand Milk Union Limited. From producing 250 litres of milk per day since the time Amul was formed back in the mid-90s to today, where Amul has over 36 lakh dairy farmers and produces nearly 300 lakh liters of milk per day, the brand has had a long journey. The story goes way back in time. In the 1940s, dairy farmers were worried. The middlemen exploited their ways of profitable income, and a poor milk production system made their living difficult. Tribhuvan Das Patel and Verghese Kurian identified these issues and helped in the formation of the first milk union called Kaira District Cooperative Milk Producers Union in 1946. The cooperative model gave farmers direct ownership of the dairy industry. The union helped them process, market, and sell milk and milk products without the interruption of intermediaries. And it was in 1955 that this union chose a brand name for itself called Amul, which means priceless in Sanskrit. And then, in 1973, Amul Dairy, along with 16 other district cooperatives, formed the Gujarat Cooperative Milk Marketing Federation, which has now completed 50 years in India. Amul also started India's white revolution that made our country the world's biggest maker of milk and milk products. The brand follows an umbrella marketing technique which has helped GCMMF prevent association clashes and keep an open door for the patrons to coordinate in creating items. As per a report by Statista, the annual sales turnover of Amul from 2011 to 2023 has consistently risen, recording about 55,000 crore rupees of turnover in 2022-2023 alone. And did you know, Amul has also held a Guinness World Record for having the longest continuous run of any advertising campaign that has ever taken place anywhere in the universe. Amul Doodh Pita Hai India and Utterly Butterly Delicious will always strike a chord. Let us know which famous advertising phrases of Amul do you remember.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome back. You're watching NDTV Profit, and this is the portfolio manager, and with me is Ashish Chaturmota, who is the executive director and PMS fund manager at JMFL. Ashish, we were talking about the defense stocks before the break. Give me your rationale for some of the defense stocks we've seen in the last one quarter, basically with respect to the earnings which has come in some of the stocks in the Q3 is not been as bullish as the order book they have been carrying.
So so I think defense is a very big opportunity. We have to understand that the capital outlay in defense is going to be at 12% CAGR, and I think that this is going to be a 10 lakh crore kind of opportunity. In that, if you look at the Navy itself is going to be almost 3,82,000 crore kind of opportunity size. Guided missiles could be almost a 1 lakh crore kind of opportunity size, and fighter jets or jet could be an opportunity of almost 4 lakh crore. So I think this is a very big opportunity. We have to look into book-to-bill ratio of most of these companies. So they are at around 5 to 10 times. I'll give you an example. A stock like Bharat Dynamics, which is doing a top line of close to 2,400 crore, are sitting on an order book of almost 24,000 crore. So it gives a book to bill ratio of almost 10 times, and the revenue visibility is very strong. We believe this can lead to a 15 to 20% top line growth for at least next coming few years. And with a lot of indigenization which is taking place in the defense companies, this is resulting into operating margins going upwards. So if you look at one point of time, Bharat Dynamics used to do a 55 to 60% used to be indigenization and rest used to be import. But today, if you look at it, is almost about 90%. It is indigenization. So that is leading to a lot of operating margins upside, and that's the reason almost 20-21% kind of operating margins we are witnessing in a public sector defense company, and this will result in a PE multiple re-rating happening for lot of these defense companies. Take an example of a company like Cochin Shipyard, where it did hydrogen fuel ferry inauguration a couple of days back. And if you look at, it is also into electric vessels. They are going to come over a period of time. So if you look at in Europe alone, almost 2,500 vessels are going to get into the EV space. And if that happens, then this is a very big opportunity size for a company like Cochin Shipyard. Globally speaking, India is having just 1% market share in the shipbuilding space. And if this number starts to improve, then that's a large opportunity size which exists for players like Cochin Shipyard or Garden Ridge or Mazgaon Dock. And that's the reason we believe defense is a big opportunity. It's not like what we have seen in railways, where we have seen a massive rally coming into these companies, but the top line is going to grow only 15 to 20%. So there was a significant amount of PE rating which happened, but earnings flow will take really long period of time to come. So this could be possibly because of low float, these stocks have done reasonably good. But in case of defense, we believe the structural opportunity is very large, and that will result into positive action coming into names like Bharat Dynamics, Hindustan Aeronautics Limited, or Cochin Shipyard, to say so.
How do you look at consumption basket? Because at one time it used to be a defensive stock. You're not as bullish at them. Many of them are trading at a very high PE as well. Do you see these stocks continue to trade at a PE despite the fact that they will continue 10-20% growth going on?
Yeah, so that's the reason why we are seeing a significant amount of relative underperformance coming from a large cap, FMCG companies, or even consumption names, except for names like Titan or Senco or Trend, which are actually showing some serious same store sales growth. Or a company like Titan or Senco, where we are seeing some significant amount of volume growth coming into play. But if you look at most of the QSR players or FMCG companies, they are not seeing very strong trend at this point of time, because either the rural consumption is at a back foot, or we are seeing some significant amount of manufacturing growth, but the multiples are still far lesser. Obviously, these are more cyclical, but at this point of time, what markets are going to reward is the earning growth, and that earning growth part is missing in most of these FMCG companies or consumption companies, whereas the multiples are at significantly higher level, and that's the reason we believe this consolidation can continue for consumption companies. But yes, exceptionally, we believe companies like Titan, Trend, or for that matter, companies like Senco, or in the QSR theme, we think a company like Vector Food, which is a proxy to the QSR theme, can be a good play. But in general, we believe that this theme is going to is into a consolidation phase, and it will take reasonable amount of time for them to show some strong earning growth momentum.
Final question to you, and quickly, because you have nearly 40% of portfolio in mid cap and small cap, and we've been seeing a lot of regulatory action coming for the mutual fund industry because of the kind of flows that are coming into this. What is your way of looking at your portfolio, where you have a significant amount in small and mid cap, in terms of stress testing of your portfolio?
So we have done our stress testing, and we have seen that most of the stocks which we are holding have a very good liquidity, strong earning growth momentum is there, and we also did one more test, that what is the percentage allocation which is there into stocks beyond BSE 500. And that's where we find it very comfortable that we don't have a significant amount of allocation into stocks beyond BSE 500. And I think stocks between 200 to 500, which are part of a small and mid cap, have a very high liquidity, strong capital base, I think, and with strong earning growth and with a lot of large, MFs holding these positions. At least we are comfortable holding those kind of names. But yes, maybe 5 to 10% of the portfolio could be aligned into stocks beyond BSE 500. So there we are always prepared. And as I said, this is the FTPM approach where we will take a call if we see some serious trend reversals coming into some of these names. So we will not hesitate to cut our positions in case if we find some dent. But at this point of time, we are very comfortable with most of the stocks we are holding in our portfolio.
All right, Ashish, it was a pleasure talking to you today. Thank you very much for joining us. That was Ashish Chaturmota, who is the PMS Fund Manager at JMFL, and you're watching the Portfolio Manager. Thank you for watching today.
Hello. Good morning, ma'am. I'm speaking from XYZ company. Are you looking for a job or a job change? Have you been receiving unwanted calls from spam numbers? Are you tired of being offered new jobs, insurance schemes, or free health checkups? Well, today we will look at an interesting survey report by Local Circles on pesky calls that received 60,000 responses. Most unwanted calls are related to financial services, 54%, and real estate, 22%. In fact, the report has taken names. 40% mobile subscribers have identified Bajaj Finance as a top offender, HDFC Group as the second biggest pesky caller. The report reveals that 60% of people received 3 or more spam calls on an average day every day, and 92% of people registered on the Do Not Disturb list still get pesky calls. So is being listed on DND working? Clearly not. But the report also recorded a minute relief, as per which 6% people don't get any such phone calls. This relief comes after the TRAI directive to banks, insurance companies, and other commercial entities. TRAI is the Telecom Regulatory Authority of India. In fact, the Department of Consumer Affairs has constituted a committee comprising members of different regulatory authorities, telemarketing companies, and cellular industry to draft the guidelines to address the issue of pesky calls. So yes, pesky calls are still a worry, but there is a little relief too. Can you ignore them though? Toll-free numbers are identifiable, so institutions have found a new way. According to the report, calls from different mobile phone numbers that seem to belong to companies or brands have risen from 29% in February 2023 to 36% now. And look at the change in trend. Real estate selling has risen from 18% last year to 22% now. However, job offerings have decreased from 10% to 4%, and in the case of those selling financial services, the calls have slipped from 60% to 54%. So the bigger question is, will the nuisance of pesky calls end anytime soon? There should be a system where pesky callers are blacklisted at the Aadhaar level, so they have the risk of not getting a new SIM. Also, brands on whose behalf the contracted callers are calling also need to be held accountable by the Department of Consumer Affairs, so brands institute the right consumer outreach practices both with employees as well as third-party contractors. For more such updates, stay tuned to NDTV Profit.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk.
Markets trade with caution in a range-bound day. Sensex falls below 74,000 while Nifty trades below 22,500. All sectors barring pharma, healthcare and FMCG in the red. Media, auto and metals drag. Media reports suggest that Tata Suns may be looking to avoid a forced listing. Tata Group stocks witness sell-off on the reversal of IPO outlook. The clock is ticking for State Bank of India as Supreme Court orders SBI to furnish electoral bond details by tomorrow. Oppenheimer creates ripples on Oscar night. The film clinches award for multiple categories, including Best Picture and Best Actor. Hello and welcome. You're watching Market IQ. I'm Smriti Chaudhary and this show is all about stocks and what the markets are doing at noon. Let's quickly take a look at the markets. We have the benchmark indices in red, down about 0.4%. Started on a positive note, actually at a record high above 22,500. However, we are now trading close to the low point of the day. If you look at the broader markets, however, the Nifty Midcap is also in the red, down about 0.1%. Nifty Small Cap has a lot more weakness than that, down over 1% as we speak. Let's also pull up the constituents of the Nifty 50 and see what's dragging the index down. We have the likes of HDFC Bank, ICICI Bank and SBI. So all private banking stocks that are taking the index down, followed by Infi. On the other hand, Bharti Airtel, ITC and HCL Tech are in the positive as we speak. Let's also pull up the breadth of the market and see how that is. If you look at the Nifty stocks, where we have 25 advances and 25 declines. However, on the broader spectrum, it's in the favor of the declines as we speak. Let's also take a look at the sectors and see what's happening there. We have media that's been a drag today. But if you look at the healthcare index and the pharma index, that's the biggest gainer among sectors. We have bank, PSU Bank, all in red as we speak. Now let's move on straight to the top story. The Supreme Court has dismissed SBI's request for an extension to disclose details of electoral bonds and ordered the bank to furnish details by tomorrow. My colleague Varun Gakkar is joining in with more details on what transpired in the courts today.
Yeah, hi Smriti, thank you. So the Supreme Court has essentially dismissed the State Bank of India's plea which sought an extension of the March 6 deadline to furnish the electoral bonds data until June 30, and the court has ordered the public sector bank to furnish all the details by tomorrow, that is March 12. Further, the court has directed that the Election Commission of India compile all this data and publish it on its official website by no later than March 15, 5 p.m. Further, the top court has noted that the contributors under this scheme were required to submit a KYC form and proof of payment which was made either through a check or a demand draft, and therefore the details of the contributors are readily available by the State Bank of India, the top court noted in its order. The Apex Court has also questioned India's biggest public sector bank after its advocate Harish Salve sought extra time regarding the furnishing of the electoral bonds data. Arguing for the bank, Salve said that the problem is that the bank will have to collate each purchaser's data and the names will have to be correlated with the redemption details of the political parties. And that all this will have to be done physically, as there is no central database available with the bank. Now, Chief Justice of India D.Y. Chandrachud observed that the SBI had been asked for a plain disclosure and added that we did not ask you to undertake a decoding exercise as has been pleaded in the State Bank's plea. The court further said that we have, for every purchase, you had to have a separate KYC and therefore you already have all the details. In essence, the court has said that the details of the contributors and the redemption details of political parties need not be bridged and that a separate disclosure will suffice. Now, the 5-judge bench was also dealing with a separate contempt application that was initiated against the State Bank for failing to furnish the details on March 6, but the court has dismissed that contempt petition as of now in view of SBI's plea regarding an extension. However, the court has said that if it fails to furnish the data by tomorrow, that is the deadline that has been fixed by the Apex Court, it may initiate a contempt action against the State Bank.
All right, thank you, Varun, for that. Let's take a look at Tata Group stocks. They are on a decline today. If you look at Tata Chemicals, that's down about 10% in trade. Now, this comes after the news reports that say that the company is trying to avoid an IPO. In fact, the reversal of IPO outlook may trigger further sell-off in Tata Group stocks. We've already seen it happening. If you look at the Nifty 50, Tata Consumer and Tata Steel are the biggest losers on the Nifty 50 as well. Now, 14 out of 19 Tata Group listed companies are on a downtick today. Spark Capital, in a note last week, stated that Tata Sons will have to list on stock exchanges by September 2025, as it was classified as NBFC upper layer in October 2021. The note claimed that Tata Sons could potentially fetch a value of 7 to 8 lakh crore at the current market cap. We spoke to Vidit Shah, the analyst at Spark PWM, a while ago. Let's listen into what he had to say.
There were a few reports that were published the week prior about the potential listing of Tata Sons in a year and a half's time. And deep diving digger, we noticed that there is a lot of value that one could ascribe to the Tata Sons group. So we ascribed about 8 lakh crore value to the group. And to answer your question whether the IPO is the only way out, no, it isn't. The RBI has classified it as one of several upper layer NBFCs, and it's classified as a core investment company. So the mandate is to list within 3 years of this identification, which was back in September 22. So that's one way out. The other way out would be to restructure its group holdings and debt for it to not be classified as an upper layer NBFC. So those are the two primary options available to the group as of now.
Well, that was Vidit of Spark Capital. But let's talk about insurance stocks. We're seeing a mixed bag there. In terms of how the stocks are reacting. ICICI Prudential and SBI are both in the positive. However, HDFC Life and LIC and GIC all in red today. Now, this comes after the insurers had their data come out. We saw a strong rise in revenue growth of 48% year on year in February, with LIC reporting the strongest growth in new business premiums. SBI, on the other hand, reported the highest revenue. ICICI Prudential reported the strongest growth in retail WRP. But what are brokerages making out of it? Mahima is joining in to tell us just that.
Right, Smriti. So, firstly, Citi came out with a note on Indian insurers where SBI Life remains their top pick. They've said that tepid growth in ticket size has taken place and single premium mix is down year on year. And Q4 FY24 AP estimates remain benign. Now, they expect medium-term re-rating underpinned by tailwinds. These tailwinds can be in terms of pension landscape, channel diversification and product innovation. And they've also mentioned that strong growth, individual regular pay policies have taken place. Now, they also talked about specific companies. For HDFC Life, they've said that HDFC Life's individual APE growth surpassed that of its private peers after 4 months now. And the performance of non-HDFC bank channels relative to the private industry will be a crucial monitorable. Then moving on, they also talked about ICICI Prudential, where individual APE market share remained flat. And they've said that trends in premium mix, channel-wise sourcing strategy and cost ratio remain monitorable for ICICI. And then moving on with Max Life, they've said that they've outperformed their peers. But if we talk about their 4-year CAGR, their 4-year CAGR for APE growth was around 12% versus that of 16% for peers. And talking about SBI Life has continued to witness market share accretion. And for LIC, they've said that LIC continued to recoup market share in group business. Now, there was also a note by Jefferies on insurance. 3 key main points from that note. Q4 growth was from a slightly lower base and led by ULIPs. All leading players posted strong growth, and dilution of surrender charges would be a positive for insurers. So this is the overall view of what the brokerages are making out of the insurance data that came out over the weekend.
All right, thank you, Mahima, for that. Now, a bit of a positive news for investors and traders. SEBI is set to start a T+0 trade settlement on option basis by March 28. Here's what Chairperson Madhvi Puri Buch had to say about the same-day settlement.
So T+0 will come by the end of this month, and we've already announced the calendar of option. So this is optional T+0 end of this month and optional instantaneous in March of next year. Right? Now, one of the things which the industry, when we were having these deliberations, the industry asked us that, look, we are already well ahead of every other jurisdiction in the world with T+1. So what is the need to move to T+0 or instantaneous? Now, our answer to them was very simple, and I can only tell you that the entire room, and there must have been at least more than a dozen stakeholders in that room, instantly said, that's why. Okay, we agree with you. So what was that, that's why, was we made a simple point. We said, look, we know from where we sit in our ISCO meetings, etc., crypto is going to come.
Well, that was SEBI Chairperson Madhvi Puri Buch. But how would this change impact different market participants is the question. My colleague Neeraj Shah is joining in to tell you about why would somebody, since this is on an optional basis, why would somebody not opt for a same-day settlement?
A valid question, Smriti. Good afternoon. So firstly, T+0, effectively, you sell the stocks today or you buy, but let's assume from a point of view of a seller, you sell the stocks today, you get the money on the same day. So you would argue, why would somebody not want to do it? So hitherto, it's been T+1. Many years ago, it was T+2 as well. But let's say hitherto, it was T+1, which means you sold the stock, you got the money the next day. Now, SEBI is saying there's an optional option that a person can choose that if he's selling in the T+0 window, so to say, is using a loose term window, then the money will come to the person on the same day. Now, this seems to be obvious, and for most online portal users, this is possibly the way it any which ways functions. If not the same day, then certainly before market hours the next day, etc. and stuff like that. Because in T+1, you used to get the money by 11 p.m. the next day or 11 a.m. the next day. So why would somebody not choose it? Well, there is still a set of investors whose demat accounts are not with the broker that they trade with, but maybe with a bank. And therefore, the transfer of the shares doesn't happen automatically, because if in the case of the demat account being with the broker itself, it's a simple process. Right. But if it's with a separate bank, then you got to give the instructions for the transfer of the shares in your demat with a particular bank to the broker. Now, some people, work, age, whatever the constraints, might not be able to do it in a hurry, might want the peace of doing it at leisure in the evening and do it. So therefore, that's a small set of people who don't do it. But the larger set of people who do BTST trades. So if I've bought into a share, I don't want to do it under the T+0 settlement window, because I know that I've bought the share today, but I'm going to sell it the next day itself in the morning. So I don't want the 0-day settlement, because I don't want to be able to pay that very day because I know I'm going to sell it the next day. So that's part one. And part two, for people who use the enhanced margin facilities of a broker. So typically, if you have a lakh rupees of capital, you can buy shares up to 3 lakh rupees, so on and so forth, or thereabouts, between 3 and 4 lakh rupees, depending on what the broker allows you. So if you are buying, let's say, a lakh of capital worth of shares, but you're buying about 3 lakh shares, you don't have the capital to cough up. So you can't do T+0 because you know that you're using this margin and selling the shares at a different day. So there's a set of very active traders who might not choose T+0 or take the option of T+1 or stay with it. Otherwise, T+0 seems to be a shoe-in, really.
A positive. Thank you so much, Neeraj, for that. So a couple of people may not opt for T+0, as Neeraj just told us. But let's slip into a quick break for now. There's lots more lined up on the other side. Stay tuned.
The farmers' protests have been making headlines. Indian farmers have demands such as legal guarantee on MSP, pension and debt waiver, no hike in electricity tariff, reinstatement of Land Acquisition Act 2013 and more. But while the protest becomes important from the point of view of elections and politics, it's not just India that has its farmers agitated. The streets of Spain, Belgium, Hungary and Poland have been roaring with protests by farmers too. Around 1,400 tractors took part in a protest in Poland and roads were blocked across the country. What do they have a problem with? Rising production costs, falling sale price, stringent regulations. They say that the European Union is not doing enough to stop cheap imports from Ukraine, which is affecting the demand for local produce. They are also not happy with the European Union's Green Deal that's designed to zero out pollution by 2050 because it limits the use of pesticides, which in turn affects yield. In Greece, farmers have demanded lower electricity prices, tax-free diesel and subsidized animal feed. In France, farmers have been fighting for improved pay and protection from foreign competition. The French government offered 400 million euros, that's $436 million, in various measures in reciprocation to their problems over low earnings, heavy regulation, and unfair competition from abroad. In Germany, farmers are against the government's decision to phase out tax concessions on agricultural diesel. Their argument is that this will lead them to bankruptcy. In Romania, the protests stem from anger about low prices for produce, rising costs, imports of cheap foodstuffs, and constraints imposed by the European Union's drive to fight climate change. In the United Kingdom, farmers are struggling to keep up with weather changes and war-related supply chain disruptions. The whole of Europe seems to have the agricultural sector in pain as climate change becomes a central focus and production prices increase. And no, it doesn't end there. As per Down to Earth, since 2023, farmers have protested in 67% of countries in South America region for a variety of reasons, such as wanting better export exchange rates and reduced taxes amid an extended economic downturn and Argentina's devastating drought, which have severely damaged crops and agricultural output. And look at this data. Farmers' protests have happened in 12 countries in Africa, 11 countries in Asia, 24 countries in Europe, 8 countries in North and Central America, and 2 countries in Oceania in just a year's time. So let's boil down all this worry to 5 main reasons, India included. Pricing of produce, delayed compensation or subsidy, unfair effects of climate change, policies and regulations, import and export duties, and supply chain discrepancies. What does this say about the world of agriculture? Does it just question politics and governance, or does it hint at a bigger problem, a potential global food crisis?
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable show.
If you want to be in the money.
Welcome back. You're watching Market IQ on NDTV Profit. Now, NDTV Profit news break has been confirmed. SEBI Chairperson Madhvi Puri Buch said that AMCs will have to disclose the results of stress test of small and mid-cap mutual fund scheme by March 15. Listen in.
We are a disclosure-based regime. The objective is disclose so that the investor is an informed investor and can take an informed decision. So in terms of the disclosures, there is a format of a disclosure which has been approved, and that is mandatory. That's not optional for any mutual fund. They will disclose. I think the date is 15th March. So you will see that. We needed to give, a couple of weeks. So the stress testing, so let me explain. So what does stress testing mean? Okay, and what is the purpose of stress testing? The purpose of stress testing is to assess that if there is an adverse environment. So first of all, there must be stress in a stress test. Otherwise, what's the point? Right? So if there is an adverse environment, and how is that adverse environment defined? We have discussed with the industry as saying that if there is a significant redemption pressure, because what is the biggest risk that a mutual fund scheme runs? The biggest risk it runs is that it is a daily redemption product and the underlying market may not be that liquid, and therefore how do you deal with redemption pressure? That's the most important risk that any mutual fund scheme runs.
That was Madhvi Puri Buch explaining why a stress test is necessary. We're also seeing Bitcoin touching life highs and is over $71,000 as we speak. But let's talk about some good news for Mumbaikars as well. Maharashtra Chief Minister Eknath Shinde has inaugurated the first phase of coastal road between Worli and Marine Drive in South Mumbai. A 10.5-kilometer long stretch is now open for traffic in the first phase. For the time being, only cars and buses will be allowed on the coastal road. All other vehicle types, including 2- and 3-wheelers, are barred. No tolls have been imposed as of now. Well, we are also going to talk about the union budget that proposed to simplify the KYC process from the current one-size-fits-all to a risk-based approach. But it's still a work in progress as regulators are yet to arrive at a point of consensus on how to improve the system. We've seen these problems with KYC floating around. And to add more perspective on this, we have my colleague Janani joining in. Janani, what are the headwinds to this?
That's right, Smriti. But before we delve into that, I want to start at the multiple ways in which a customer today can complete their KYC documentation. There is Aadhaar OTP, Aadhaar biometric, CKYC, there is even digital KYC, video KYC. There's also the old school physical verification where you can be present in person called the OSV, original seen and verified. And this can also happen digitally via the DigiLocker facility. So all of this begs the question of a standardized system of data upload and usability across regulators and regulated entities. Now, this is where the simplification of KYC agenda came up in the 2023 budget announcement. But like you said, it's been a bit of a standstill announcement, and that's primarily because regulators have not arrived at a point of consensus on how they can bring about this uniformity. Now, the Finance Ministry has said to have established a committee under Finance Secretary T.V. Somanathan to look at RBI's report on a risk-based KYC. A risk-based KYC is where, based on an individual's level of engagement, be it for opening a bank account, be it for trading in the markets, based on that, they will be giving the KYC details that they need to give. Accountability in terms of what happens if there is a data leak, responsibility for that data, and also in terms of regular updation.
Right.
These are some of the problems that have not been solved. We have multiple regulators having multiple systems at this point. And since businesses, but for businesses, this is not a profit generating venue, this is just a compliance measure. So we're not getting a lot of enthusiasm from them either. So this is where things stand as of now, but we'll keep tracking this and bringing you more updates as we know better.
All right, thank you, Janani, for that. On to Academy Awards that happened last night. Now, with the 7 Oscars, including Best Picture and Director, Oppenheimer created waves at the Academy Awards. Now, Cillian Murphy, who played the biography about the inventor of the atomic bomb, bagged the award for the Best Actor, whereas Christopher Nolan won the Best Director. Robert Downey Jr., who played the nemesis of J. Robert Oppenheimer, won the award for the Best Supporting Actor as well. And that's all that we have on this edition of Market IQ. But we have lots more lined up for you on the other side. Stay tuned.
Hello and welcome to NDTV Profit. Today we will talk about tattoos and the worth of this market. The history of tattoos in India can be traced back to prehistoric times when tribal people were captivated by drawings on stone or wood walls. Their attempt to replicate these figures through needles gave birth to the practice of inking skin. Over the course of time, tattoos were embraced by tribals as a mark of bravery, war, religious beliefs, customs, marital status, protection from the male gaze, and so on and so forth. Today, in 2024, tattoos have become a means to express thoughts, individuality, personal experiences, and sentimental designs. The industry is estimated to generate over 20,000 crore rupees per year. What is driving this growth? One of the key drivers behind the growth of the tattoo market is the rising demand for customized and unique designs. Improved technological equipment for making advanced, safer, and painless tattoos have boosted the market. The laser technology for removal or modification of tattoos have also added to the surge. Increased exposure and promotion of tattoo designs on social media have led to widespread influence of tattoo culture on the youth. Take a look at these figures now. As per Fortune Business Insights, the global tattoo market is projected to grow from $2.04 billion in 2023 to $3.93 billion by 2030 at a compound annual growth rate of 9.87%. This is a sharp rise from 3.8% year-on-year growth between 2017 and 2022. As per Custom Market Insights, the diamond jewelry market is expected to grow at a compound annual growth rate of 5.5% by 2032, while the luxury jewelry market at a rate of 8.9%, but the tattoo market is estimated to grow at 9.5%. Is the tattoo business lucrative? According to an article by Opportunity India, tattoo kits are now easily available for less than Rs 10,000, while high-end kits range from Rs 20 to 35,000. Now, in a city like Mumbai, the average cost per inch is Rs 2,000 to 2,500. In Delhi and Bangalore, the cost per inch is between Rs 1,000 to 2,000, and in Goa, it is about Rs 500. We spoke to a couple of tattoo artists in Mumbai and found that at an average, the business earns them a profit of Rs 75,000 to 1 lakh per month. In fact, as per an article by India Today, a person can earn a minimum of 20,000 rupees to Rs 2 lakhs per month depending upon one's work and creativity with an initial investment of 1.5 to 2 lakh rupees. A beginner-level tattoo artist can earn a minimum of 20,000 rupees per month, which gradually increases to a couple of lakhs or more depending upon the caliber of the artist and the uniqueness of their artwork. And I'd like to leave you with an interesting data. by advanced dermatology that revealed that 63% of people with a tattoo smaller than the palm of their hand regret it. The reasons being impulsive decisions, 35%, significant meaning, 29%, or the idea that it would make them look cool, 18%. Thank you for watching and stay tuned to NDTV Profit for more.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam.
Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit. My name is Alex Matthew. Now, we speak about a number of issues related to mutual funds, but we don't often talk about the selling of mutual fund. And this conversation, at least the first half of this conversation, relates to how the mutual fund distributor community is going to be dealing with a change in norms that relate to commissions. How that affects you is one of the aspects of this conversation. But to break things down for you, I've got Ashish Somaya, Chief Executive Officer of White Oak Capital, as well as Kirtan Shah, who's the Managing Director at Credence Family Office, joining in. Thank you so much to the both of you for taking the time and for speaking to us on NDTV Profit. Let's start with a little bit of context, because I think Ashish, Kirtan, a lot of people joining in, of course, a lot of them, because they're watching the mutual fund show, know the difference between direct and regular, but let's set the context, right? There are two types, and I'll start with you. There are two types of distribution models. Either, as an investor, I go to the website of an EMC and buy, that's direct. How does regular work?
So Alex, in regular what happens is you are typically working through an intermediary, can be a bank or a broking house or a wealth management setup, where you are invariably looking at a better advice from that intermediary to help you reach your financial goals, and for which you are probably willing to let go of or pay a slightly higher expense ratio to the mutual fund, right? So when you go direct, you probably might end up paying 70 paisa for a particular fund, but if you go through the regular mode, that might be higher to 1.2. Ideally, the difference between the direct and the regular is the expense that you're willing to bear to get an intermediary on board, assuming that intermediary will be able to add a lot of value versus you wanting to do it direct.
Okay, Ashish, from the perspective of the industry, it's a given that most of the schemes that are sold through the regular route. Why do you think that is?
So I think first thing, important point to clarify is that as far as asset management industry is concerned, like mutual fund companies are concerned, commercially we are indifferent, right? Whether it comes through direct or comes through an intermediary. So the way the regulation is cast, management fee is the same for both, and we are absolutely indifferent.
Sure.
But having said so, it's a regulatory requirement that you should offer both, right? You offer direct and you offer the intermediate class, which is regular. Now it's obvious that two reasons why regular has more assets. One clearly is related to maturity of the market, right? Because there are so many people who are just about getting introduced to mutual funds, right? So it's quite likely that a lot of them hear about it for the first time from a friendly neighborhood, mutual fund distributor. It's about access. It's about where do you hear it the first time. And second also is important to understand that I say it on a funny, lighter note that to buy some 300, 400 good companies, we have some 3,000-4,000 different mutual fund schemes.
Yes.
So it's not easy.
Yeah.
Right. Our industry is notorious for making things nuanced and complex. So I think people do need guidance. Right. People do need guidance. They need to be able to sift through. And the best performing fund rotates every 2-3 years.
Yes.
So it's not easy to identify what's the right fund, etc., etc. And I think over the number of years, the regulation has been, kudos to SEBI, regulation has been tightened so much that the difference in commission between fund ABC, XYZ, alpha, beta, gamma, difference is narrowed down consistently. which means that commission is less and less of an influence for a distributor, and meritocracy of products and performance and teams managing those funds is getting more and more prevalence.
Okay.
That's how it's playing out.
Okay, so that's interesting insight, and it's also interesting because you have the insight from a previous organization as well as one that you've set up and that is growing very rapidly. Do you have any unique insights from one to the other in terms of getting your name out there? Does the distribution community help, or is it word on the street? Is it how does it work?
So I'll tell you, like, you know, when an organization is new, clearly talking about yourself to the trade and making them know is the first port of call. But I think thanks to you guys and thanks to the whole digital medium, discovery happens pretty fast.
And organically.
Right? Because two things have happened. One is over the number of years, because of regulation, because of you guys, because of social media, because of awareness with investors, over the number of years, industries become more and more meritocratic. And also because of digital platforms, it's become more and more democratic. So first port of call, always it's the trade or the distributors which get a brand out there. But then otherwise organically also nowadays the timelines have got crunched in terms of how fast discovery plays out.
Okay. Coming back to the conversation on trail commission. So you've understood as things stand that there is a difference between direct and regular. The difference in the total expense ratio is effectively what the distribution fee is and what the distributor gets as a commission on a monthly basis. Now, there was something, Kirtan, called an upfront commission. That doesn't exist anymore. What exists is a trail commission. How does that work?
So Alex, what happens is in a trail commission, ideally what you're doing is as long as that asset stays with you, you are pro rata basis paid on whatever was supposed to be paid out to you for the whole year.
Let's take an example.
What that means is, let's say if you have 100 rupee of AUM and probably a 1% was supposed to be paid out to you, you are ideally supposed to get 1 rupee for the asset staying with you for the entire year.
Sure.
But let's say if the asset stays only for 25% of the year, you get paid only 0.25 paisa, depending on how long the asset has stayed with you. So that's how the industry has actually moved from the upfront entry load / payouts that were made earlier to a trail model, wherein the incentives were aligned for the investor to stay invested, and that's how the entire ecosystem benefits from the AMC to the investor and the distributor.
So
community.
in your example, 1 rupee calculated for the full year, assuming that the investor stayed for the full year, gets split over 12 months, and each month it's calculated based on the AUM.
Yes.
Now, what is this new norm that we're talking about? Because we're talking about, say, okay, let's take an example, right? Kirtan is a distributor, I'm a distributor. I was selling a product, I sold a mutual fund scheme, and I was earning the trail commissions. Now, he has convinced the investor that he's better than I am, and therefore the investor shifted. The investor was not getting the trail commissions in that situation, right?
Yes.
That was the old rule.
Yes.
What was happening to the amount that was set aside for the distribution?
So whatever the amount is would remain, see, because these things work on provisions, because there are no accurate numbers, right? I mean, you're making an estimate that on these much of assets, I have this much of part of the assets raised from a regular plan and some part of the assets raised in a direct plan, right? And as you'll appreciate, all of this is in percentage points.
Sure.
So let us say starting of the month, the assets are 100 crores. End of the month, the assets are 110 crores. Then through the average of that, there is an average trail commission across all distributors. So there is a, you're making a provision in the scheme saying that by end of month, I need to debit this much, but the actual calculation will happen later.
Sure.
Correct? So obviously, there are large pools, and to a small extent where there is change of code, and for that particular asset, which may be a minuscule proportion, you're not going to pay, despite having made a provision, you're not going to pay that. So there will be some excess provision that will get rolled over. It will be set off against some future commissions, etc.
Got it.
So actually, it's not a very big part of the overall assets or the overall commission paid out. But what is interesting to keep in mind is that till now, the rule was that even if the customer decides that I want to move from Alex to Kirtan, right? The policy was that, sometimes he might be doing something to, lure the customer under some false promises. He might indulge in mis-selling. He might say that, okay, Alex has given you this scheme, but there's something wrong with it, and he's not updating you. I'll update you. If you invest with me, you will get better returns. Or in the olden days when the rules were not strict, you say that, okay, I'll pass back some of the incentive back to you.
Right.
There were very many malpractices for which the door would be left open if we allowed this kind of switching and commissions to move.
So what is happening now, though?
Yeah. So at one point in time, the Association of Mutual Funds decided that to end all malpractices, let's do one thing. If a customer says change my distributor, we will not pay any commission to the new distributor, so that there is no change happening because of malpractices or incentive. It happens purely based on probably giving better service, and then over a period of time, that new distributor would get more wallet share from the customer, or otherwise would grow the business. And if this fund doesn't perform, at some point in time in future, it may get switched, and then Now what the Association of Mutual Funds has said is that to not pay commission forever and ever probably doesn't make sense.
Sure.
So let's do one thing. When there is a change of broker code, don't pay for the first 6 months.
Cooling period.
Yeah, cooling period. So don't pay for the first 6 months. After 6 months, if you find that after changing the broker code, the customer has remained with the new distributor, it means that maybe he's happy with that decision and there was no malpractice, and it's been done for the right reasons. So after 6 months, you start paying the commission. So I think it's only fair and square, because what will happen is that no malpractice, at the same time, no reason to keep churning the assets.
Yes. So in this example, Kirtan switching from Alex to Kirtan is not incentivized to tell the investor, hey, you know what, Alex didn't know what he was talking about.
Yeah.
Sell those schemes and buy the schemes that I tell you about. There are a few more implications to talk about, and what it means for competition in this space, and whether or not it will lead to poaching in a certain scenario or few scenarios. We'll talk about that after a very quick break, so do stay tuned.
Amul has completed 50 years in India. PM Modi will attend the Silver Jubilee celebrations of the Gujarat Cooperative Milk Marketing Federation, the owner of Amul. At one point of time or the other, we've all grown up with Amul butter or milk for sure. The famous Amul girl created in 1967 is family. We all recognize her. But as the brand grows 50 years old today, do you remember the full form of Amul? It is Anand Milk Union Limited. From producing 250 litres of milk per day since the time Amul was formed back in the mid-90s to today, where Amul has over 36 lakh dairy farmers and produces nearly 300 lakh litres of milk per day, the brand has had a long journey. The story goes way back in time. In the 1940s, dairy farmers were worried. The middlemen exploited their ways of profitable income, and a poor milk production system made their living difficult. Tribhuvan Das Patel and Verghese Kurian identified these issues and helped in the formation of the first milk union called Kaira District Cooperative Milk Producers Union in 1946. The cooperative model gave farmers direct ownership of the dairy industry. The union helped them process, market and sell milk and milk products without the interruption of intermediaries. And it was in 1955 that this union chose a brand name for itself called Amul, which means priceless in Sanskrit. And then, in 1973, Amul Dairy, along with 16 other district cooperatives, formed the Gujarat Cooperative Milk Marketing Federation, which has now completed 50 years in India. Amul also started India's white revolution that made our country the world's biggest maker of milk and milk products. The brand follows an umbrella marketing technique which has helped GCMMF prevent association clashes and keep an open door for the patrons to coordinate in creating items. As per a report by Statista, the annual sales turnover of Amul from 2011 to 2023 has consistently risen, recording about 55,000 crore rupees of turnover in 2022-2023 alone. And did you know, Amul has also held a Guinness World Record for having the longest continuous run of any advertising campaign that has ever taken place anywhere in the universe. Amul Doodh Pita Hai India and Utterly Butterly Delicious will always strike a chord. Let us know which famous advertising phrases of Amul do you remember.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
So it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future.
We've got your options covered.
Futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
there are different types of stocks. Large cap stocks, mid cap stocks, and small cap stocks.
How to decide which is the one for you? First, decide on the
Don't listen to anyone and everyone.
When it comes to your hard-earned money,
Join us as we put the spotlight on 6 stocks.
on your show,
Welcome back. You're watching the Mutual Fund Show, and we're in conversation with Ashish Somaya of White Oak Capital as well as Kirtan Shah of Credence Family Office. And we've tried to give you an understanding of how trail commissions work and how the norms have changed. Now we're talking about who benefits. Kirtan, of course, you've been distributing for some time. What, according to you, is, if at all, a section of the mutual fund distributor community that will benefit? Will competition be ramped up in a big way?
Alex, I think there are three different ways to look at this. I think there are 3 people who will really benefit. First is the good guys will benefit, because the industry so far was in a way where you had these assets. Even if you didn't do anything on the assets, which is value addition, you were still getting paid the trail commission and getting paid a higher commission every time the AUM went up without you really doing anything. And hence, everybody will have to pull up their socks to now make sure that you are adding value for the money that you are making. And if you don't do that, you will get switched to a good distributor or an MFD who's going to bring that value on board. So I definitely believe the good guys will benefit. Second, I think there are a lot of private bankers or wealth managers who've been a part of the system for a long time, but they've not been able to move out and start on their own because it was not easy to move assets, right? And now those guys will benefit, and the investor community will definitely benefit, because so far what was happening is, even if you know that the person that you were working with was not adding value, but for you to switch to somebody else was always a task, because for the newer distributor to really make money or get incentivized, you would have had to sell your schemes and buy new schemes and pay capital gains tax. Now what can happen is, if you've identified whom you're working with and you're not comfortable and you want to move to somebody else, you can change the broker. The newer broker will also be incentivized and you will save on capital gains tax. So I think all these 3 sections, in my opinion, should benefit, Alex.
Do you think there's another category that will benefit, or do you think there's another implication that we are not talking about yet?
No, not really. I think Kirtan has covered it comprehensively. I think it's a good move, because, you know, if you say that, okay, you're not happy with a particular distributor, you want to move to a new distributor, the new distributor is not going to get any trail, then he or she is also not sufficiently incentivized to provide better service to a newly acquired customer. So I think it's a win-win in that sense. And it's good that, you know, for at least for clients, it's going to be a positive.
It should be. So don't be surprised if you get a few calls. I don't know if it's going to be as aggressive as that. Maybe you guys should tell me on the comment section over the course of the coming weeks whether or not you get approached by your neighbor's distributor or something like that. But it's interesting because incidentally, I was having a conversation with a friend about their investment portfolio. And they were saying that, and I think, Ashish, it may be something that you can tell me about as well, because I know that you do a lot of conversations that give you insight of how investors behave. And what she was saying is that she has had a distributor for the last 3 years. She's had a decent 18% CAGR on an equity portfolio. She's found out that her aunts have been getting a 20+% CAGR, and she wants to shift to that distributor, okay? So this is the context that she gave me, and she showed me the schemes that were being offered by the second distributor, and right enough, there were 3 small cap schemes out of 6 that were being offered. So I was taken aback, because I was wondering, hey, you know, what is the benefit of having 3 small cap schemes?
Yeah.
What I'm trying to understand is, are these still being aggressively sold? And I'm asking in the context of the AMFI numbers that came out for the month of February. Seemingly there's a deceleration in mid-cap and small cap, but is that happening on the ground?
No, not really. I think asset managers have been getting more and more cautious and conscious, and you saw that regulatory nudge also about planning liquidity and stuff. So this time around, what I've seen, asset managers have been a bit more conservative and a bit more cautious. But if you see the flows, not a big discernible slowdown. In fact, for the month of February, the gross inflow into equity mutual fund schemes, if I just take pure equity and you take these balanced hybrid equity oriented funds, that gross inflow was well north of some 74,000 crores. And I'm not even counting ETFs and index funds and the EPFO's money and stuff.
Which is a record.
74, yeah. 74 is probably the largest, right? So you can see that there's no let-up, really speaking. It always happens. You know, I always tell on a lighter note that some people do a lot of analysis and buy what's working well in the last 1 year, and some people don't do any analysis and still buy what is working well in the last 1 year. So the former are just trying to justify why they are buying last 1 year, and the other ones are directly buying last 1 year. So there's this huge penchant for people to buy what worked well in the last 1 or 2 years. But markets are mean reverting and they are cyclical. So in fact, if you have anything to see in the last 1 year, you should make sure you don't buy what worked very well in the last 1 year.
Fair point. Are you changing? I know for a fact that you have over the last few weeks and months, I think, changed the kind of messaging you're giving your clients. What does it stand at right now?
I think, Alex, look, if you're a long-term investor, you largely want to stick to your asset allocation, which fits your risk profile. But of course, this may not work for every client.
Sure.
But there are definitely some clients for whom you have a small tactical allocation, given the nature of the work that you really want to do, and you have an understanding with the client. So on the tactical side of the bet, I think we've had this conversation multiple times that for 24 we've had large cap allocation and we've reduced small cap. But I think this is, look, getting this to be done on the ground is as difficult as easy as it looks while we talk, right? Is because now when you look back 4 months, you would say that this call went right, but it's not always that your calls will go wrong, and you will have to be more prudent, understanding whether or not you're okay taking a bet at this kind of valuation in the small caps, whereas the large caps have not done well. I mean, we were talking last 1 year, large caps have done what, 17-18%?
Sure.
Mid was 40 small plus. Was 45, right? And like Ashish said, there's always mean reversion, right? It's only prudent for you to allocate some more money to large cap, because that's where probably value is.
So the context, of course, is for the last part of this conversation, which is that the market regulators come in and said, look, hey, you need to disclose more on the liquidity side and certain other risk management aspects, which I guess mutual funds are doing anyway. But on the 15th of the month, there will have to be a report on certain aspects. What does that change for you?
No, so basically, it says that we have to report. I mean, whatever work we may be doing internally, like we have a chief risk officer, which is, by the way, a regulated position reporting to trustees and the Securities and Exchange Board. So we do all of that work. You know, that what is the top distributor concentration, top 5 distributors deploying money with us, top investors deploying money with us, what is the concentration, you know, what is the biggest redemption we've received in the past, if we receive such a redemption, how much. So all kinds of liquidity analysis, what is the liquidity of each and every stock, how many days it will take us to completely exit, all of that we do, right? Now what we have to just do is that we have to publicly disclose what was internal. So, you know, we supply fact sheets to investors. So they see our portfolios, they see sectoral allocations, they see who's the portfolio manager, what type of team, what performance. They see all of these things and buy a fund. Now the regulator is probably nudging that, look for one more thing, you know, performance and all is well and good, but is this performance generated by having a lot of money just going pyramiding See, if you have illiquid stocks in your portfolio and you get huge inflow, you keep buying your own stocks.
Right.
So then, that just keeps flying. So sometimes the impact cost, sometimes a lot of flow into a few number of schemes, hence putting money into few number of stocks. So the regulator is just telling investors that amongst the many things you look at, make sure that you look at this also. That's the intent of making public disclosure.
And I think the onus will then fall onto the distributor community and the advisory community to utilize that information, of course, to the investor as well, because this information is going to be publicly available. We'll try and break that down for you as soon as we get a report like that to tell you how best you can utilize the information. But that brings us to the end of this particular edition of the Mutual Fund Show. Ashish, as well as Kirtan, thank you so much for joining us in the studio and for breaking down the latest changes in the mutual fund space. If you've got questions for us, you can write to us on the WhatsApp number that flashes occasionally at the bottom of your screen. There it is right now, or in fact, on the social media platforms that you follow us on. Do stay tuned, lots more coming up over the course of the day, and this is NDTV Profit.
Hello. Good morning, ma'am. I'm speaking from XYZ company. Are you looking for a job or a job change? Have you been receiving unwanted calls from spam numbers? Are you tired of being offered new jobs, insurance schemes, or free health checkups? Well, today we will look at an interesting survey report by local circles on pesky calls that received 60,000 responses. Most unwanted calls are related to financial services, 54%, and real estate, 22%. In fact, the report has taken names. 40% mobile subscribers have identified Bajaj Finance as a top offender, HDFC Group as the second biggest pesky caller. The report reveals that 60% of people received 3 or more spam calls on an average day every day, and 92% of people registered on the Do Not Disturb list still get pesky calls. So is being listed on DND working? Clearly not. But the report also recorded a minute relief, as per which 6% people don't get any such phone calls. This relief comes after the TRAI directive to banks, insurance companies, and other commercial entities. TRAI is the Telecom Regulatory Authority of India. In fact, the Department of Consumer Affairs has constituted a committee comprising members of different regulatory authorities, telemarketing companies, and cellular industry to draft the guidelines to address the issue of pesky calls. So yes, pesky calls are still a worry, but there is a little relief too. Can you ignore them though? Toll-free numbers are identifiable, so institutions have found a new way. According to the report, calls from different mobile phone numbers that seem to belong to companies or brands have risen from 29% in February 2023 to 36% now. And look at the change in trend. Real estate selling has risen from 18% last year to 22% now. However, job offerings have decreased from 10% to 4%, and in the case of those selling financial services, the calls have slipped from 60% to 54%. So the bigger question is, will the nuisance of pesky calls end anytime soon? There should be a system where pesky callers are blacklisted at the Aadhaar level, so they have the risk of not getting a new SIM. Also, brands on whose behalf the contracted callers are calling also need to be held accountable by the Department of Consumer Affairs, so brands institute the right consumer outreach practices both with employees as well as third-party contractors. For more such updates, stay tuned to NDTV Profit.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Hello and welcome back. You're watching NDTV Profit, and this is Large Trades, a show where we talk about all kinds of bulk and block deals, large trades and buzzing stocks. I'm your host Mika Barwe, and with me is Agam Vakil. But before we get on to the buzzing stocks of the day, Agam, how do the markets look like right now?
Well, it's yet another quiet Monday morning, but with some amount of weakness seeping through for the Nifty. Of course, we are looking at a decline, and a decline of around 0.4%. It's gradually shifted lower, and in the last 1 hour of trade, we're looking at a little bit of consolidation coming through. And overall, of course, we are still not too far away from life highs, but it does seem like this afternoon and through the course of the day, we've taken a little bit of a breather, a little bit of a step back. And what is it that's contributing to this decline on the Nifty? Let's pull up the constituents, take a look at where things are pulling and where things are pushing upwards. So what is, of course, weighing down is HDFC Bank. We've had a, well, it's not a disparaging report, but we've had a report which is a tad bit more circumspect around HDFC Bank and the CLSA over the weekend, where they do suggest that the challenges will perhaps persist, at least in the near term. And well, HDFC Bank has a lot to get over, to get that deposit growth going. Along with that, we have a whole host of other banks as well, which are weighing on not only this index, but the Bank Nifty as well. So ICICI Bank and SBI also down. And L&T is, to a certain extent, dragging the indices lower. What is seeing a little bit of recovering is TCS. And we also have some gains in ITC and Cipla as well. Well, but a bulk of your losses, or rather the bulk of your declines today, are on account of the banks. Let's talk about banks then. Let's see how things are panning out there. The Bank Nifty is also trending in the red at the moment, and that is also trending near day's lows. It's down around 1%, losing out nearly 500 points at the moment. How about the broader markets? Let's take a look at that as well. Now, the broader markets, when it comes to that, we have seen, again, largely mixed moves. About a 0.25% decline for the mid-cap index, but a sharper 1.4% decline for the small-cap index. In the broader markets, what we are, in fact, actually seeing is Tata Chemicals, which is down 10%. So a lot of the declines are because of that. We have Tata Tele, which is down 4% as well. Indian Hotels and NMDC and Gujarat Fluorochem also looking at, well, some amount of cuts in the session. And on the gaining end, we have Torrent Power, which is up around 4.4%. Poonawalla FinCorp is once again starting to pick up, perking up, and that's up around 4.2%. And then we have Fortis Healthcare, which also advances by around 3.1%. So all in all, a fairly mixed market when it comes to the broader end of indices and ranges there. And of course, we continue to keep an eye on some of your relatively smaller names. And speaking of large trades and what we have in store in today, well, of course, we're going to start off with Interglobe Aviation, where the stock is reacting to the co-founder and promoter Rakesh Gangwal, who sold a significant part of his stake in the airline. Let's bring in Mahima to give us more details on this one. Mahima.
Yeah, Agam, so as you rightly mentioned, well, as per a Bloomberg report, at present, what we have is that Rakesh Gangwal has sold around 3.9% of its stake, which comes out to around 6,700 crores, approximately $820 million. And this was sold at 3015 per piece. Now, and this is at a 2.9% discount versus its closing price on Thursday, that is 7th of March. Now, if we talk about the trajectory of how the promoters have sold their stake, well, in September 22 to August 23, Rakesh himself has sold around 2.5%, almost 3% stake in Indigo, and Sobha Gangwal has sold her entire stake by August 23. At present, Rakesh Gangwal holds around 11.72%. So if we subtract the 3.9% stake, his stake will come down to around 8%. Now, talking about Indigo overall, well, as per the Jan passenger data, the Indigo's local passenger market was at 60.2% versus that of 61.8%. So their market share did take a slight hit. Well, there are two brokerages that came out on Interglobe Aviation. The first one was Motilal Oswal, which has maintained neutral on Interglobe Aviation with a target price of 3,300, and they expect Indigo to navigate various challenges in near term, and competitive intensity on Air India resurgence and Akasa Air entry could be a barrier for Indigo. There was also a Morgan Stanley report that is maintained overweight on Interglobe Aviation, and they've raised their target price to 4,145 versus that of 3,745 earlier. They're saying that the FY24 capacity growth of 21% versus 17 to 19% guided is a good growth, and they expect 6% growth in FY25. Talking about the stock performance, well, it touched an intraday high of around 3.67% today. 6 months it's been up over 28%. 1 year it's been up over 73%. And lastly, about if we talk about the analyst recommendations, well, 17 say buy, 2 say hold, and 3 say sell. So this is the overall view of Interglobe Aviation, and this is all we have so far. We'll at the end of the day, we'll know who the buyers and sellers were actually.
Thank you so much, Mahima, for those details. Moving on, we have Torrent Power, which is in focus today. Now, it went up to an intraday high of 12.48%, but now it's pared some of its gains down about 4%. The stock has shown strength. It's up 5% in the past month and 2.24 times in the past 1 year. Now, volumes were over 6 times its 30-day average, and the total traded volumes were at 74.31 lakh equity shares, and the buyers did outnumber the sellers. Now, this was on the back of an order win. Now, the company has received a LOA from the Maharashtra State Electricity Distribution Company, which is MSEDCL. Now, the order value is at 1,540 crore rupees, and the project is to be commissioned in 18 months. Now, the company is to supply 306 megawatts of solar power, and this supply will be under the Mukhyamantri Saur Krishna Vani Yojana 2.0 scheme, and the project is to set up 48 distributed locations in the Nashik district, and the power is going to be procured by the Maharashtra State Electricity Distribution through 25 years of a power purchase agreement. Now, in terms of, when you talk about Q4 order inflow, the company has received 4 orders in total, and the order inflow is strong at 4,690 crores. And they also target to expand their renewable capacity to 3 gigawatts, and this target is to be achieved in the next 18 to 24 months, and they expect to incur a capex of 2,500 crores per annum for the next 2 years in order to execute the current pipeline we have. So that's all we had on Torrent Power for now. Let's shift our focus to KEC International. The stock is buzzing in today's trade, and it's reached an intraday high of almost 10%. It's spared some of its gains, right, 5.7%. But let's bring Anushi with more insights.
Right, Mika. So as you mentioned, 10% of an intraday gain over a year. Even the volumes are buzzing with about 7 times its volumes of 30 days average. Now, the stock has been about 64% up in this 1 year. But if you had to look at the company's latest Q3 results. Not much of a hit over here, with the revenue did beat expectations about like 14.4% growth over here, but margins were kind of below the expectations at about 6.14% if you have to look at the Bloomberg tally. Now coming to the order book status of the company, about 38,000 crore of order book till now, which shows about an 8.45% growth compared to the last year. Meanwhile, its order intake was down about 17.4% at rupees 12,850 crores. Interestingly, Share Khan just came out with a report today wherein it has given the stock, it continues to maintain the buy rating for the stock and has revised the target price upwards to 850 rupees. So a couple of reasons over here. First is the strong revenue visibility that they're seeing with the kind of order book that I just described about with in the range of 38,000 crores. So they are seeing a revenue visibility over the course of next 6 to 8 quarters. Now in this, the major order intakes which have happened is from their transmission and distribution segment, which has a shorter timeline in general. So that means that the revenue growth we are seeing is in an accelerated pace as well. Also, one expectation is that the improvement in margin profiles that we can see from the second part of the financial year 2025 onwards, especially in their transmission and distribution segment. So again, that remains a focal point over here. Over here, the report ended with them giving an estimate of about 15% of revenue growth in the course of FY24 to 26 period, with some sequential improvement in margins. Now, if you have to look at the overall analyst recommendations for this company, a mixed sort of a review over here, with 14 having a buy rating, 5 having a hold rating, and 7 having a sell rating. So if you have to look at the overall return potential for the company, that stands in a negative range, that's like minus 10.6%. So this is the overall picture that has been building up for KEC International today.
Thank you so much, Anushi, for those details. Up next, I want to talk about Dwarkesh Sugar Industries. Now, the stock is up intraday high of 7.09%. It's paired the gains. It's around 2.28% in the green. Now, volumes are over 4.8 times the 30-day average, and the total volumes were at 67.23 lakhs, and the sellers were 2 times the buyers. Now, this is mainly on the back of a buyback announcement, where the board has approved a buyback of 30 lakh equity shares. Now, the buyback represents 1.59% of the total equity, and the aggregate consideration about around 4% of the paid up capital. Now, the buyback price is set at 105 rupees per equity share of face value, rupees 10, and the record date set for the same is March 20th. When we talk about the stock performance of this counter, you look at the 1 month trajectory or the 1 year trajectory, it's down, it's shown some weakness. Their Q3 results, the profit was down to 9.81 crores versus 10 crores in the previous quarter. Their sugar sales were down, and this is mainly because the industry did face challenges due to the revised production estimates, the drought impact, and the El Nino factor. But the company is positive because the government has curtailed ethanol blending program in order to boost the sugar production, and they've also raised the production estimates. And that's what we had on Dwarkesh Sugar Industries. But it's time to slip into a short break, but do stay tuned as we have lots more lined up on the other side.
The farmers' protests have been making headlines. Indian farmers have demands such as legal guarantee on MSP, pension and debt waiver, no hike in electricity tariff, reinstatement of Land Acquisition Act 2013, and more. But while the protest becomes important from the point of view of elections and politics, it's not just India that has its farmers agitated. The streets of Spain, Belgium, Hungary, and Poland have been roaring with protests by farmers too. Around 1,400 tractors took part in a protest in Poland, and roads were blocked across the country. What do they have a problem with? Rising production costs, falling sale price, stringent regulations. They say that the European Union is not doing enough to stop cheap imports from Ukraine, which is affecting the demand for local produce. They are also not happy with the European Union's Green Deal that's designed to zero out pollution by 2050 because it limits the use of pesticides, which in turn affects yield. In Greece, farmers have demanded lower electricity prices, tax-free diesel, and subsidized animal feed. In France, farmers have been fighting for improved pay and protection from foreign competition. the French government offered 400 million euros, that's $436 million, in various measures in reciprocation to their problems over low earnings, heavy regulation, and unfair competition from abroad. In Germany, farmers are against the government's decision to phase out tax concessions on agricultural diesel. Their argument is that this will lead them to bankruptcy. In Romania, the protests stem from anger about low prices for produce, rising costs, imports of cheap foodstuffs, and constraints imposed by the European Union's drive to fight climate change. In the United Kingdom, farmers are struggling to keep up with weather changes and war-related supply chain disruptions. The whole of Europe seems to have the agricultural sector in pain as climate change becomes a central focus and production prices increase. And no, it doesn't end there. As per Down to Earth, since 2023, farmers have protested in 67% of countries in South America region for a variety of reasons, such as wanting better export exchange rates and reduced taxes amid an extended economic downturn and Argentina's devastating drought, which have severely damaged crops and agricultural output. And look at this data. Farmers' protests have happened in 12 countries in Africa, 11 countries in Asia, 24 countries in Europe, 8 countries in North and Central America, and 2 countries in Oceania in just a year's time. So let's boil down all this worry to 5 main reasons, India included. Pricing of produce, delayed compensation or subsidy, unfair effects of climate change, policies and regulations, import and export duties, and supply chain discrepancies. What does this say about the world of agriculture? Does it just question politics and governance, or does it hint at a bigger problem, a potential global food crisis?
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Welcome back. You're watching Large Trades, and we move on to the final stock we want to address in Large Trades, and that is a relatively smaller, less known company, GTL Industries. We're going to talk about this not necessarily for its business, but what's happened around the ownership of the company. So firstly, there has been volumes in considerable ones. So the stock is down around 19% and it's currently trading at day's low, as you can see on your screen there. But moreover, its intraday volumes are the highest in 3 months, and also its intraday volumes are 6 times its 30-day average. What does the company do? Well, it does produce and export high-quality galvanized steel tubes and pipes, according to its website, and moreover, the company also produces heavy structural steel and hollow sections. But why is it that we are seeing weakness in today's tier of trade, and there has been such a sharp cut? Now, we have news. In the latest news, an entity called Zenith Multi-Trading DMCC was awarded about 27.6 lakh shares on the 28th of February, and this was pursuant to conversion of warrants. Is that a bad thing? No, it isn't. However, what we understand is that Zenith Multi-Trading DMCC is associated with one Hari Tibrewal. Why is that problematic? Well, the reason is that, according to reports, Hari Tibrewal is involved in enforcement directorate investigations, and these investigations are over money laundering. And because of this indirect ownership in this particular company, there is all sorts of conjecture that that conjecture has led to perhaps some amount of weakness. Most likely it is speculation, but we do have some of this data which is out there, and which does tend to suggest as to why there could potentially be that kind of weakness and selling pressure coming in as far as JTL Industries is concerned. Well, in terms of how things have panned out when it comes to its financials, well, things do look relatively stable with reasonable growth through and through, from being a very small company with revenues of just about 230 odd crores back in March of 2020. Those revenues have moved up to as much as well over 1,500 crores. That is for the financial year ending 2023. And for the last 12 months, it seems it's garnered revenues of around 2,000 crores. So near 10-time revenue growth over the span of the last 4 years. Also, is it a profitable company? It does seem like that, because it did make a profit around 90 crores back in, until for the year 2023. So not much in terms of a fundamental problem. As you can see, it's moved steadily up in the last 12 months. But it's something, the ownership and the allotment of warrants is something perhaps is what's playing on the minds of investors. And from there on, we move on to Crystal IPO. Now, Crystal Integrated Services is all set to open on March 14th with an issue price of around 680 rupees per share and a total issue size of 300 crores. And my colleague Sajid Mangat caught up with the management today. Listen.
The receivable for private sector is between 40 to 60 days. As we have mentioned in our DRHP also, we have good sectoral presence in the corporate also in terms of our business verticals, whether they are malls, hospitals, airports like Mumbai Metro we are servicing, and we have a good customer portfolio. Also, our retention level in the customer and the loyalty is excellent. And post-pandemic also, we've been able to actually keep our credit cycles in check. And because we have our customer mix is very, very good. And I'm very thankful to them that they have been appreciating the services that we are rendering to them. And therefore, we've never, therefore the cycle is between 45 to 60 days in the corporate sector. And we are happy with that cycle as well.
Give me a sense of your client concentration, because I was looking at your RHP and your top client accounts for nearly 30% of your revenues and top 5 accounts for nearly 68% of the revenues. So can you give us a sense of who the top client is?
Yeah, our top, out of the 20, our top 4 customers in the corporate sector gives us, contribute to almost 17.6% of our revenues. And these are the ones who have been with us for over a decade. And also on the government side, our concentration in the healthcare sector is a very good concentration. As I told you, we've been working in the government space for almost 2 decades, and our prowess and our competency in the healthcare sector is emerged as one of the best in the country today. And there in the healthcare sector, it is almost 35% coming from a particular healthcare segment. Having said that, there is also this 35% which is split between 5 zones in a particular geographic area. So that is a very healthy combination, because each zone has a different process of business. So as good as 35% is divided between 5 customers. So it's a great combination of our customer mix. And given the FNS survey report on the industry, it is expected the government will grow in the IFMS outsourcing sector in the government will grow at about 16.5%. It has grown in the last 3 years by 10%. And it is also expected that the corporate sector will go by 10%. So I think we are there in our hands, and our expertise in both these sectors is going to hugely benefit benefit our prospective investors. And at the price band that we are at 680 and 715, and where it is opening on 14 March and closing on 18, I think we are a good buy with the kind of mix of sectoral, the kind of services that we are offering, and the price at which this is happening, the kind of customer loyalty that we have, and the fantastic service delivery team that we have. I think we have one of the best service delivery teams in the country today. So all in all, I think we are at the right time, at the right sector.
Well, that was the management of Crystal Integrated. But up next, we have some good news for Mumbaikars. Maharashtra Chief Minister Eknath Shinde has inaugurated the first phase of the coastal road between Worli and Marine Drive in South Mumbai. It's a 10.5 kilometer long stretch, is now open for traffic in the first phase. NDTV's Radhika gets you the ground report.
Big relief for commuters in Mumbai. Phase 1 of Mumbai Coastal Road project has been inaugurated. In fact, this is a 10-kilometer stretch extending from Worli to Marine Drive. This is going to be open for motorists from tomorrow. In fact, this runs along Mumbai's western coastline and aims to ease traffic congestion and reduce commuter woes witnessed otherwise on regular Mumbai roads. In fact, this entire project has been built at an estimated cost of 13,000 crore rupees, and the entire project extends from Marine Drive to Kandivali, which is close to 30-kilometer stretch. What has been opened today, inaugurated today, is a 10-kilometer stretch that extends from Worli to Marine Drive in South Bombay. In fact, inaugurated stretch, this stretch that you're seeing, will be toll-free. There will be 3 entries, 2 exits. In fact, speed limit imposed for vehicles is 80 kilometer, 60 kilometer for tunnel turning points. Speed limit announced for vehicles, also an entry exit points, 40 kilometers. So there are going to be 3 entry points, 2 exits. Cars and buses will be allowed. There will also be interesting features here. Twin tunnels, green space, public parks, jogging tracks, all that also are set to come up. This will in fact be open for motorists from 8 a.m. to 8 p.m. So clearly, Mumbai Coastal Road going to be a transformative experience for Mumbai's commuters. So good news for them. Worli to Marine Drive stretch open. In fact, what used to take 40 to 50 minutes on regular roads from Worli to Marine Drive is going to take just under 10 minutes.
Right, well, good news for all Mumbaikars. But on that note, it's a wrap on this edition of Large Trades. But lots more lined up on the other side. We get you India markets close. Stay tuned in.
Hello and welcome to NDTV Profit. Today we will talk about tattoos and the worth of this market. The history of tattoos in India can be traced back to prehistoric times when tribal people were captivated by drawings on stone or wood walls. Their attempt to replicate these figures through needles gave birth to the practice of inking skin. Over the course of time, tattoos were embraced by tribals as a mark of bravery, war, religious beliefs, customs, marital status, protection from the male gaze, and so on and so forth. Today, in 2024, tattoos have become a means to express thoughts, individuality, personal experiences, and sentimental designs. The industry is estimated to generate over 20,000 crore rupees per year. What is driving this growth? One of the key drivers behind the growth of the tattoo market is the rising demand for customized and unique designs. Improved technological equipment for making advanced, safer, and painless tattoos have boosted the market. The laser technology for removal or modification of tattoos have also added to the surge. Increased exposure and promotion of tattoo designs on social media have led to widespread influence of tattoo culture on the youth. Take a look at these figures now. As per Fortune Business Insights, the global tattoo market is projected to grow from $2.04 billion in 2023 to $3.93 billion by 2030 at a compound annual growth rate of 9.87%. This is a sharp rise from 3.8% year-on-year growth between 2017 and 2022. As per Custom Market Insights, the diamond jewelry market is expected to grow at a compound annual growth rate of 5.5% by 2032, while the luxury jewelry market at a rate of 8.9%, but the tattoo market is estimated to grow at 9.5%. Is the tattoo business lucrative? According to an article by Opportunity India, tattoo kits are now easily available for less than rupees 10,000, while high-end kits range from rupees 20 to 35,000. Now, in a city like Mumbai, the average cost per inch is rupees 2,000 to 2,500. In Delhi and Bangalore, the cost per inch is between rupees 1,000 to 2,000, and in Goa, it is about rupees 500. We spoke to a couple of tattoo artists in Mumbai and found that at an average, the business earns them a profit of rupees 75,000 to 1 lakh per month. In fact, as per an article by India Today, a person can earn a minimum of 20,000 rupees to rupees 2 lakhs per month depending upon one's work and creativity, with an initial investment of 1.5 to 2 lakh rupees. A beginner level tattoo artist can earn a minimum of 20,000 rupees per month, which gradually increases to a couple of lakhs or more depending upon the caliber of the artist and the uniqueness of their artwork. And I'd like to leave you with an interesting data by Advanced Dermatology that revealed that 63% of people with a tattoo smaller than the palm of their hand regret it. The reasons being impulsive decisions, 35%, significant meaning, 29%, or the idea that it would make them look cool, 18%. Thank you for watching and stay tuned to NDTV Profit for more.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Headlines you start your day with. What
Well, thanks for tuning into India Market Close, and let's show the highlights of the market, because I think we've come off from where we were and trading close to the lowest point of the day. Multiple reasons could be ascribed to them, but I mean 0.5% is par for the course for any single day. So 22372 for the Nifty. The bank Nifty should come up on your screen about 1% higher, and banks are dragging right from private banks to State Bank of India. All of them are down. In fact, if you look at the Nifty constituents on the losing end, it is HDFC Bank, ICICI Bank, as well as, excuse me for this, as well as State Bank of India, which is playing a part there. Bring up the mid caps and the small caps, because the market breadth we know is wobbly, but just the extent of correction in the mid caps, not as much, but the small caps were down over 1%, and now down about 1.66%, arguably trading at the lowest point of the day. Let's get the heat map up on the screen and show you what's moving and what's not, and start off with the losers maybe, and then go on to the gainers. Tata Consumer, symptomatic of what's happened to the Tata Group stocks today, save for Trent and save for maybe TCS and Tata Elxsi. All Tata Group stocks are in the red. So Tata Consumer down about 3%, Tata Steel 2.5%. Like I was saying, banks are looking weak. So SBI is down about a couple of percentage points, giving companies HDFC Bank, IndusInd Bank, as well as Kotak Bank. So that whole set of stocks are looking weak. But there is kind of even Stevens on the gainers and the losers. And what is moving up are not too many heavyweights, but Apollo Hospitals, Nestle, Cipla. So some of the lightweights have some gains to themselves, which is kind of balancing the dismal show of the banks. Now, before I hand it over to Tamanna, as you saw the flash on your screen, iron ore futures in Singapore are down 7% now. They were down about 4.5 at about 10 a.m. or thereabouts. And look at the metal index, save for APL Apollo, which is actually not a metal stock per se. And JSW Steel, almost everything is taking it on the chin. So metals, Tata Group, banking, Tamanna, the list is very, very long of stocks which are just kind of losing a bit of steam today.
Yeah, I think sentimentally, perhaps also a bit of overhang of what the Supreme Court has said to SBI with the deadline that they've given them on electoral bonds. Remember, this is something, of course, apart from those who analyze elections and politics, the market's going to watch, corporates are going to watch when that list is out, and it's an overhang on the banking system and SBI as well. But let's talk about the Tata Group stocks, because that's truly the story of the day. Now, if the run-up didn't make too much sense, because everyone knew that the IPO deadline, if there is one, is going to be towards the second half of 2025. The slide back also doesn't make too much sense, because nothing is fundamentally changed in a Tata Chemical or a Tata Investment or a Tata Tele or an Indian Hotels. And this, I mean, pick up any of those counters. Neeraj pointed some in the Nifty side of things, and all of them are down in the red. And I would say that's really the big story. 25,000 crores of market cap have been wiped out today. In fact, we will be asking our experts in a bit whether there are good opportunities here to pick up something from the group. But that's one story. JTL Industries is the other one, and this has taken a hit on huge volumes today in the steel pipes business. This is because of an affiliate company, actually. A company called Zenith Multi-Trading DMCC has got about 27.6 lakh shares in JTL, because it's a conversion really to equity of warrants, and one of the promoters of that company is set to be under an ED investigation. So by association, in a sense, that stock 20% down today. The other ones I would mark out are the financials: JM Financial, IFL Financial, the ones under regulatory overhang, and you're seeing that in play today. 9% down on JM Financial. IFL Finance also seeing a 7% down tick. Torrent Power is doing fine. I wanted to pick a few stocks which are doing okay. Torrent Power is one of them. LOA from the Maharashtra state electricity body. DB Realty not so much, but that's because their QIP is coming in at a bit of a discount, and you're seeing that on DB Realty. They want to raise about 1,500 crores, and their QIP price is 258. So that's why you're seeing that price correct. But overall, I would say a bit of a somber day in the markets, and you're seeing that I would say uncertainty, Neeraj, play out.
Certainly looks like that, and I think it's great to maybe try and question our experts on the show today. 3 different guests with each specific suite trying to tell us what to do in a scenario like this. Let's get in our first guest, Hemen Kapadia. He's Senior VP Institutional Equity at KR Choksey Stocks and Securities. Hemen, great having you. Thanks for taking the time out. Good afternoon. Not a very good afternoon, especially if you're a small cap investor. But then you will say that's been the pattern the whole of last week too. How are you viewing trade on the benchmarks?
A very good afternoon to you, Neeraj. Thank you for having me on the show. Sorry, the pleasure. Like you said, I think the small caps have been corrected. This is the 6th week in a row. So frankly speaking, SEBI nudge or not, it's already built in somewhere in the price. So mid caps are doing a bit weaker, and small caps are weaker than the mid cap. So that happens. VIX has staged a small recovery, but nothing significant, I'd say. But I was hoping that we'd go below 13 today. That's not happened. We're at 14 though, and slipping a bit. Well, the market seemed to be consolidating a bit, Neeraj. The only worry, if any, is that gold going through the roof. Now, that is disconcerting. Normally, you won't expect the markets, gold, crypto, everything moving together. But so gold going through the roof, somewhere, somehow, something we don't know, or the market is anticipating some geopolitical tensions. But that seems to be the fly in the ointment, so to speak. But otherwise, yeah, we've had a phenomenal move, a little bit of a consolidation, not very surprising. Reliance has cooled off. Bank Nifty is taking it easy. So you need either Reliance and Bank Nifty. You need either IT and Reliance or Adani Enterprise to fire. Now, none of these things are happening. So frankly speaking, I'd be specific. mid cap, small cap, I don't know whether there's going to be a permanent issue, but as of now, it seems like a correction in a up move. So I'd be more stock specific. Metals are looking good, Neeraj. They posted a fresh all-time high index, notwithstanding what has happened today. FMCG is oversold, downside of the limited, and IT seems a bit promising. So I'd say nothing much to worry. Maybe it's one of the days you just take it easy, Neeraj.
I heard you say that metals look promising. Would you be a buyer into any of the metal names at the current levels?
Yeah, because why I'm telling you this, Neeraj, is if you can just take a cursory glance at the NSE Nifty Metal Index, Neeraj, we're off a bit today. Yesterday it posted a fresh all-time high, and we're breaking out of a small consolidation phase again. Now coming down to stock specifics, I think JSW Steel looks interesting. We haven't closed above 840.45 yet. Sale was looking promising. It's in ban. Tata Steel is at an all-time high. It's on a discount. I don't think there's much to lose. But JSW Steel above 840.45. It's been consolidating, Neeraj, for almost 10 weeks now. So this is something which looks promising.
Yeah. Since we're talking about metals, look at what's happening with iron ore, and we'll try and get an analyst in to understand why you've seen such a slide in iron ore futures in the Singapore market. Of course, on the face of it, it's because of weaker than expected Chinese demand, and that's really perhaps, when Hemant is talking about this global overhang and concern, the lack of speed with which China is recovering, or the lack of recovery, to put it simply, is definitely one concern. But Hemant, back home and the focus on banks and what we're seeing with not just the bank Nifty, but its components as well. And SBI, there's a Bernstein note on it, which clearly is not too excited about SBI. What do you make of SBI and the banking pack and the kind of hit that we've seen today?
Well, sometimes one gets the feeling that it's more of a delayed reaction. But yeah, we've just on Thursday, last trading session of the last week, Tamanna, we posted a fresh all-time high. We cool off. Okay. We are overbought on technical parameters. This move from 740 to a fresh all-time high at 793 almost isn't justifiable, because at the risk of getting a bit technical, Tamanna, the daily MACD, RSI and stochastic, they are all in sell mode. So frankly speaking, this move which happened over the last 7 trading sessions shouldn't have happened. Having said that, high tops, high bottoms, all-time high, clear blue sky, nothing much to worry about. Yes, and if a heavyweight stock like State Bank goes from 600 to 792 in a matter of 6 weeks, Tamanna, 7 weeks, I'd say it's ripe for a correction. So Bernstein, great, but sorry, or whatever that brokerage is, I'd see a small cool-off is coming in. 770 breaks, we'll see some slightly deeper correction, but the overall structure, if you see, still remains bullish. Nothing has changed, or I don't expect anything radical.
Right. Now, so, that's interesting. It's also giving me the perfect opportunity for sort of a programming reminder that we're going to be speaking with Bernstein and the author of that report in just a bit from now to get their perspective on why. But so that's Hemant's take on an SBI. Hemant, I have to come in and ask you about the Tata Group stocks and the kind of hit they've all seen. Tata Chemical definitely receding, the biggest pain point in that pack, about 10% down, but the others as well. Anything that you would pick up right now, or would you wait for the dust to settle?
I'd wait for the dust to settle. Why, Tamanna? Because firstly, Tata Steel is in F&O ban. So the momentum is gone. It's finished. So until it doesn't get out of the ban, you can't do anything more. And strangely enough, on Friday, we saw the OI in Tata Chemical. Sorry, we are talking about Tata Chemical, not Tata Steel, Tamanna. Tata Chemical is in ban mode. And Tata Chemical, the OI increased by 18.2%, Tata Power by 17.13%, Tata Steel 11.18%, Indian Hotels 7%, so Tata Comms 3.5%. So like you said, virtually all the Tata Group stocks, especially in the F&O segment, had a huge increase in open interest. And I think one gets the news that maybe they might not have to come out with an IPO, and maybe whatever the fundamental situation is. And plus, the architect was Tata Chemical, and that goes into ban mode. So I'd say wait for the dust to settle. But if I were to pick and choose, Tamanna, I still think that Tata Steel, Tata Power, and Tata Com on declines remain technically positive.
Okay, Hemen, stay on. So much more to talk about. Let's slip into a quick break and we'll come back and talk to a couple of experts on metals and more. Stay tuned to NDTV Profit.
Amul has completed 50 years in India. PM Modi will attend the Silver Jubilee celebrations of the Gujarat Cooperative Milk Marketing Federation, the owner of Amul. At one point of time or the other, we've all grown up with Amul butter or milk for sure. The famous Amul girl created in 1967 is family. We all recognize her. But as the brand grows 50 years old today, do you remember the full form of Amul? It is Anand Milk Union Limited. From producing 250 litres of milk per day since the time Amul was formed back in the mid-90s to today, where Amul has over 36 lakh dairy farmers and produces nearly 300 lakh litres of milk per day, the brand has had a long journey. The story goes way back in time. In the 1940s, dairy farmers were worried. The middlemen exploited their ways of profitable income and a poor milk production system made their living difficult. Tribhuvan Das Patel and Verghese Kurian identified these issues and helped in the formation of the first milk union called Kaira District Cooperative Milk Producers Union in 1946. The cooperative model gave farmers direct ownership of the dairy industry. The union helped them process, market and sell milk and milk products without the interruption of intermediaries. And it was in 1955 that this union chose a brand name for itself called Amul, which means priceless in Sanskrit. And then in 1973, Amul Dairy along with 16 other district cooperatives formed the Gujarat Cooperative Milk Marketing Federation, which has now completed 50 years in India. Amul also started India's white revolution that made our country the world's biggest maker of milk and milk products.
Welcome back. You're watching India Market Close. India Financials. Time to switch back to the private sector banks, downgrading SBI to market perform. That's the title of the Bernstein report out today on SBI. It's interesting. It's also coming on a day when anyway, the banking space is having a tough day. SBI specifically with a rap on the knuckles, actually a little more than that from the Supreme Court vis-a-vis the electoral bonds issue. But Pranav Gundlapalli, Senior Research Analyst and author of this report from Bernstein, is with us now on NDTV Profit. Pranav, pleasure as always to speak with you. Can you elaborate why, I mean, you speak about this in the context of valuations of public sector banks running up massively in the last 2 years, that gap between private sector banks closing, but why the concern on SBI specifically?
Well, so good afternoon. I think SBI is more as a proxy for the public sector banks. I think, I think this, whatever we wrote on the valuations having run up and the operating performance starting to inflect again, I think that applies for the public sector bank set in general. And SBI, which is our coverage stock, remains a proxy for that set, and hence the downgrade to a market perform. And moreover, it's a relative call between the public versus the private sector banks, where we think the room for outperformance that we saw in the last 2 years, we think is largely limited from here, and therefore our call for switching to the private sector banks.
One of the tailwinds perhaps, Pranav, for public sector banks, and because the consistent push for public sector banks in analyst after analyst that we speak to has been there. So this is definitely a different take, I would say. But one of the tailwinds for public sector bank is that a lot of government spend, government capex, government schemes are being funneled and fueled through public sector banks, and that tailwind will remain, right? Is it just the deposit growth and pace of deposit growth that concerns you?
See, I think it's more of the two parts to this. I think one is the growth part, and there is a profitability part. On the growth front, yes, you'll have more of the government schemes and government, policies and efforts being channeled through the public sector banks, which has been the case, over the last 5 to 7 years at least. But what it has not translated into is any sort of reversal in the market share loss on the deposit front. To us, that's the big worry, number one. And number two, the seemingly low LDR doesn't provide as much of a growth runway as what is probably expected, because we see that the LCR ratios for the public sector banks today are just about 10 percentage points higher than the private sector banks, which indicates that they don't have a whole lot of excess liquidity to dip into. In other words, their deposit growth will become a constraint even for the public sector banks. So it's unlikely that they will outperform private sector banks when it comes to growth, even in the medium term. So what you saw, therefore, in the last 2 years would probably be an outlier, and they would come back to being constrained by the deposit growth.
Interesting. So Pranav, the estimates thus far, Neeraj here, good afternoon. The estimates thus far that I see of various analysts seem to be pointing towards a relatively much stronger growth for SBI for the next 2 years, despite the fact that you say that they might face this constraint. And the flip side, the kind of growth that some of the private banks, which have traditionally grown strongly, but are showing in the first few weeks, even for the current quarter, isn't anything to write home about. So why shouldn't a bank which is trading at similar ROEs, better growth rates than the private sector banks, and cheaper valuations than the private sector banks be downgraded?
Okay. See, I think two parts to this, right? So we have a system-wide issue of deposit growth being slower than loan growth. So that's a theme that is applicable for both public and private sector banks, and we saw the impact of that last quarter. But if you look at the loan growth or deposit growth for literally the last quarter, what we see is on the deposit front, that gap remains as wide as ever, in fact, widening as we speak. And on the loan front, yes, it's similar to the private sector banks, but it's again, the gap is beginning to widen. I think FY23 was probably the peak where both the public and the private sector banks saw the same loan growth rate. But if you look at the latest quarter, that difference is starting to diverge again. So the deposit growth constraint is hitting the public sector banks as well. And you're seeing that widen again when it comes to loan growth. Now, more importantly, on the profitability front is where we see a slightly different trajectory, which is despite this excess liquidity and also having a higher share of MCLR loans, which should have benefited more from increasing term deposits, what we are seeing is that the interest spreads for the public sector banks is actually narrowing almost as fast, if not faster, than the private sector banks. In other words, they're having to price aggressively to keep up that growth, which doesn't help them on the margin front. So it becomes a classical margin versus growth trade-off for the public sector banks as well. And therefore, there is no room for EPS outperformance. Remember, from FY22 until the third quarter, we had a phase where the public sector banks delivered a higher earnings growth than the private sector banks. We think that's going to inflect again, and which is where, once you have a slower earnings growth kick in, yes, the valuation is lower, but that is reflective of the fact that their deposit growth is slower and they're losing market share. So unless that changes, there will be a permanent valuation gap between the public and the private sector banks. I don't think there's any scenario where they converge on the valuation front.
Interesting take, and I would say contrarian to the kind of frenzy almost for public sector banks. Just one last point, Pranav, and I know you said you chose SBI as a proxy for the space, and your take is comparative to private sector banks. Nevertheless, today is a day when SBI has been in the news for various reasons. I'm just trying to understand whether you see any overhang of this electoral bond issue and the tight timelines that have been given at all for SBI?
I think that should be a transient issue in my view. I think we should see that going off as an overhang soon. But I think the more fundamental issues around the deposit growth and earnings growth disappointing versus the private sector banks, I think that's the bigger theme that will drive even the short-term movements in the name.
All right. Thank you so much, Pranav. Pranav Gundlapalle there, Senior Research Analyst at Bernstein. Always a pleasure to speak with you. Their take is that the advantage that public sector banks had in terms of valuation, in terms of growth, may be now narrowing, and it might be time to revert to private sector banks. Having said that, let's take a look at what's happening in the markets at this point. And it's been I would say, a bit of a tough afternoon, especially for banks, for financials. That entire space has been under a bit of pressure as well. Tata Group stocks is the other one which has been seeing that kind of downbeat. Healthcare, on the other hand, has been not too bad at all. The other space to talk about definitely is metals, and we reported just a short while ago, you saw it on your screens as well, about how iron ore futures in Singapore were over 7% down. What is the reason? A, B, impact for Indian listed companies in the metal space. Aditya Velekar, Senior Research Analyst, Metals and Auto at Axis Securities, joins us now for more on that. Aditya, great to speak to you here this afternoon on NDTV Profit. Let's begin by understanding what's happening. Why this plunge? Is it all because of China?
Yes, iron ore prices, they have increased since because of before the lunar holiday, the iron ore prices have increased substantially because there was a restocking by the Chinese steel mills. Post the lunar holiday, the prices have been on a downward trend, and currently they are trading in the range of $120 to $150 per ton. So it's one of the reasons is now that the port inventory of iron ore at China has increased. And post the lunar holiday, the pickup in the steel production or iron ore consumption has not increased, and that is one of the reasons why the iron ore prices have corrected. As far as the Indian stocks are concerned, directly it doesn't impact the Indian iron ore miners, but eventually, if the prices go on a correction mode, then definitely the benchmark international iron ore prices will have some bearing on domestic iron ore prices. But per se, the domestic iron ore market is in a deficit, and the steel production is increasing in future. And because of that, the domestic iron ore prices will find some support, and that will be supportive for the iron ore players like NMDC and other private players like Lloyd Metals and Energy.
So the domestic demand will support maybe iron ore prices. Sentimentally, perhaps you'll see an NMDC react today, a VEDL, all of these perhaps react sentimentally. But on the flip side, Aditya, what about steel stocks? This would be positive for them if a key raw material cools off in terms of prices. Do you hope to see that impact?
For integrated players like Tata Steel and SAIL, it doesn't have much bearing on the iron ore prices because they have a raw material integration with respect to iron ore. So it really doesn't matter how the international prices moves there. But for JSW Steel, they are dependent on iron ore. So for them, the price fluctuations will either increase or compress their margins. But as far as Tata Steel, SAIL and JSPL is concerned, they have a substantial amount of integration with respect to they have their own iron ore mines. So that fluctuation doesn't impact them much. As far as in general steel stocks in India are concerned, the prices are range bound, steel prices, and then coking coal prices are still at a higher level in the range of $290 to $300 per ton, and they have corrected slightly from $330 to $300 per ton now. But still the spot margins are under pressure, and that may get reflected in the coming quarter. So margins may find some pressure for all these companies.
Aditya, just one question. What's the way ahead? Because iron ore supply in Australia is picking up as well at a point of time when prices are starting to correct a bit. Do you reckon a larger, steeper correction is in store?
It all depends down on how the Chinese economy in general and specifically how the China.
But thus far, the queues aren't turning out great, right? They're trying multiple things. They are not working. If the same status quo continues, you reckon lower prices are in the offing?
Yes, means if they continue to export the steel in the range of 7 to 8 million tons per month, then definitely it's not a good sign. Means if the China produces steel and they keep on exporting steel, then definitely the iron ore prices in India that will find some pressure. That will be under some pressure. So it all depends how they manage and produce, how much steel they produce in future. So if they continue to keep on producing steel and keep the exports elevated, then yes, the prices may remain slightly under pressure.
Got it. Aditya, much appreciate. Thanks for taking the time out and giving us your thoughts. Really appreciate your time. NMDC, Vedanta, or some of the others, some of the stocks that are looking very wobbly in the session today. Look at that, 4% off for an NMDC. Actually, Hemant, a quick 30-second view because we have to hit that break. But any views on NMDC? It's trading at the lowest point of the day.
Oh, no, it should take support at 222, maybe a couple of days more.
Okay, you're saying, okay, a couple of days more of a corrective move maybe, but support at 222. Thanks, Hemant, for that. Stay tuned. Viewers, we'll be right back. Hemant Kapadia is with us. We'll also get in Sudeep Bandyopadhyay. Also get in the latest or the buy today, sell tomorrow ideas or sell today, buy tomorrow ideas from Hemant in a few minutes.
Hello. Good morning, ma'am. I'm speaking from XYZ company. Are you looking for a job or a job change? Have you been receiving unwanted calls from spam numbers? Are you tired of being offered new jobs, insurance schemes, or free health checkups? Well, today we will look at an interesting survey report by local circles on pesky calls that received 60,000 responses. Most unwanted calls are related to financial services, 54%, and real estate, 22%. In fact, the report has taken names. 40% mobile subscribers have identified Bajaj Finance as a top offender, HDFC Group as the second biggest pesky caller. The report reveals that 60% of people received 3 or more spam calls on an average day every day, and 92% of people registered on the Do Not Disturb list still get pesky calls. So is being listed on DND working? Clearly not. But the report also recorded a minute relief as per which 6% people don't get any such phone calls. This relief comes after the TRAI directive to banks, insurance companies and other commercial entities. TRAI is the Telecom Regulatory Authority of India. In fact, the Department of Consumer Affairs has constituted a committee comprising members of different regulatory authorities, telemarketing companies, and cellular industry to draft the guidelines to address the issue of pesky calls. So yes, pesky calls are still a worry, but there is a little relief too. Can you ignore them though? Toll-free numbers are identifiable, so institutions have found a new way. According to the report, calls from different mobile phone numbers that seem to belong to companies or brands have risen from 29% in February 2023 to 36% now. And look at the change in trend. Real estate selling has risen from 18% last year to 22% now. However, job offerings have decreased from 10% to 4%, and in the case of those selling financial services, the calls have slipped from 60% to 54%. So the bigger question is, will the nuisance of pesky calls end anytime soon? There should be a system where pesky callers are blacklisted at the Aadhaar level, so they have the risk of not getting a new SIM. Also, brands on whose behalf the contracted callers are calling also need to be held accountable by the Department of Consumer Affairs, so brands institute the right consumer outreach practices both with employees as well as third-party contractors. For more such updates, stay tuned to NDTV Profit.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some
Welcome back. Just about half hour to go for markets to close, and it's not looking too pretty, to be honest. Sensex nearly 500 points down, Nifty about 0.5% in the red. But let's take a look at what's happening on the F&O queues. Agam is joining us. Agam, are you seeing that bit of nervousness?
We certainly are, and it's evident in the kind of numbers with respect to the options market. I'll come to that in just a bit. Let's take a look at how things are panning out for the futures. And for the Nifty, very little change. Again, going back to the trend of seeing less than 1% decline or an addition in open interest for the March futures. So overall, we have seen very, very little traction, say for a 1 odd day, 1 or 2 odd days over the span of the last 7 or 8 trading days. That said, we're still looking at a 0.5% cut for the Nifty, currently trading near day's lows, so some amount of weakness coming through. What about the Bank Nifty? Let's pull that up, and that is where we are seeing further unwinding, even as the index comes off by a whopping 1%. A lot of weakness once again on account of HDFC Bank and ICICI Bank, and it's something which is weighing on the markets. Let's talk about the options market then. As far as the Nifty goes, currently continuing to see writing around 22,500, specifically with respect to calls. And from here on, over the next maybe 1 or 2 days, 22,500 may just become a little bit of a resistance area for the Nifty to move about. And if it does move about that substantially, then that's when we start seeing a lot of covering of those shorts, and that could perhaps lead the Nifty higher even from those levels. This is, of course, your overall in open interest distribution. And as I've been suggesting, the most amount of OI stands at around 22,500. Let's move on and talk about stocks then. And I reckon there's a lot more traction in stocks in today's day of trade. So Interglobe Aviation, after Rakesh Gangwal goes ahead and sells a little more stake in the company, the stock is up around 4%. ICICI Prudential, Siemens, all of them looking at substantial gains. In fact, Siemens has made a new life high right now. And shorts for Apollo Tyres and Tata Steel. And on the other hand, in terms of stocks which are seeing unwinding in trade, we are looking at about a short covering for Pidilite and Chola Finance. But Tata Chemicals are now looking at a correction of well over 10% as we speak. SAIL and MGL among others, which are also seeing unwinding. So that's where we are seeing weakness. But it's a fairly mixed market. And even in the broader markets, it's been more about stocks than the index itself. And that perhaps is likely to be the case over the course of the next few days and weeks as well.
All right, thank you for that, Agam. Now, let's take a look at one more space. This morning, you had life insurance companies in focus after Feb data that came out over the weekend was quite positive. You're now seeing general insurance data coming in. And among them, Star Health has seen a 19% uptick in revenues year on year. That's looking positive. Overall, your standalone health players seem to have done better than your general insurance pack. We look at some of that data coming in. New India Assurance not responding too positively to its set of numbers though at this point. But we can just pull up a few more of them, ICICI Lombard as well, and look at what's happening to the stock price right now. Let's also pull up the life insurance plays, which had seen a positive start to the day at least, but that seems to have reversed. Look at LIC near its day's lows, nearly 1% down. SBI Life doing well. A clutch of brokerage notes today also looked at SBI Life as one of the best performers in terms of the company on the back of that life insurance data. Joined now by Sudeep Bandopadhyay of IndiTrade Capital. He's joining in on the show. Sudeep, very good afternoon to you. Great to have you on. Since we're talking about insurance data, general and life, just wanted your take on this space and how interesting you find it. Anything that you like over here?
Now, I do like the life insurance space. I think there is tremendous scope for growth of life insurance players in India. We all know we are just scratching the surface as far as insurance penetration is concerned. And I think we have very well established industry now. The private sector is very well established, and SBI Life has been our favorite for some time, and we believe that SBI Life can be purchased even at current levels. Also, I must mention that normally this quarter, February, March, Jan, March is a strong quarter for life insurance industry. The February numbers came and they were pretty impressive. Our March numbers also should be good the way things are panning out. So yes, life insurance is a sector which we are looking at. We believe that there is a lot of merit in acquiring life insurance companies for long term. SBI Life is our favorite at this stage.
Okay. Hemant, let me get your take on that. Is SBI Life there on top of the charts for you as far as the life players are concerned? What about the general insurance players?
I think SBI Life is one of the better stocks. Tamanna, why I'm telling you better stocks is simply because last month and this month, we posted fresh all-time high. Now, whether you look at ICICI Lombard, HDFC Life, ICICI Pro, none of them have posted new highs, but SBI Life has. So, I mean, yeah, I think the technical setup for ICICI Pro life insurance is also looking better, but I think SBI Life leads the market, and I don't think that has changed. So it looks good even now, Tamanna.
Okay. The other one which seems to have taken a bit of a beating today, aside of course, the Inox Winds of the world, which are down, and some of the others like IIFL Finance, which are correcting, is Zomato. Zomato has come off a bit in the session today, about 3% off the lows of the day, but certainly still lower. Now, Sudeep, this whole talk of what if Flipkart comes into this business and some others come into the business and what it could do to the market shares and the moats of some of players like Zomato, are you worried as well, or you think that companies will take it in their stride?
Neeraj, I think the companies will take it in their stride. Yes, competition is intensifying. It's still a duopoly between Swiggy and Zomato. If you look at the market, the way they are servicing the market, but this quick service, quick delivery players, whether it's a Blinkit or whether it's a Zepto or it's the possible entry of Flipkart into that, I think there will be a competition because at some stage they are both trying to catch the same customer, service the same segment, so there will be competition. But having said that, I think Zomato is a very well established player with great systems and processes. So is Swiggy. So I think I would put Zomato and Swiggy at a different place altogether. We have seen the valuation upgrades in the unlisted space, which Swiggy is getting, and Zomato is getting in the listed space. Today's correction may be on the back of the fact that Flipkart possible entry into somewhat similar space, but I will still back a Zomato or a Swiggy and not the potential entry of a Flipkart offshoot.
Okay, so that's on Zomato, a stock under pressure today. Sudeep is constructive. Sudeep, are you constructive on Indigo? The stake sale getting absorbed very easily. Travel is on a high. Their numbers must be looking solid. Crude isn't jumping up in any fashion. Is Interglobe Aviation a good bet, or is the best behind us already?
Well, Neeraj, normally I don't like to buy airline shares or recommend airline shares. Globally, airlines have never done consistently well beyond a limited period of time, other than probably Singapore Airlines. So this is one space where I'm very, very careful. But having said that, I think there's a strong tailwind behind Indigo at this stage. The way they have been able to garner market share, I think is amazing. Last year, if you had asked me this question, I would have probably said that Indigo will be under pressure because Tata acquiring Air India as well as Vistara and Air Asia. Combination of these three probably will give Indigo a run for their money. But somehow that hasn't happened. Indigo is going from strength to strength, and as you rightly said, the travel there's been a real boom in travel. New routes have opened up, and Indigo has been undoubtedly the market leader by a mile. Under the circumstances, with oil prices remaining constant and the way the airports and the flights are packed, I think Indigo will do definitely well in March quarter. They will come out with a very good set of numbers. That's what is my expectation as far as their March quarter numbers are concerned. And you may play in Indigo tactically. I'm not saying it's a long-term bet, but tactically one can buy Indigo for a short term and hope to make some profit.
The hunt for an Indian airline company that could make profits has been on for a long time, and Indigo seems to have cracked the code. So, which is why Interglobe becomes an interesting play. But let's talk a bit about GAIL. GAIL is in focus today. The company has entered into an MOU with ONGC and Shell Energy. Stock down about 3% now. There was a con call earlier in the day as well, where an analyst sort of call where there was quite a few inputs coming in. Mehika joins us to get the key details. Yes, Mehika.
Yes, so first I'll talk about the MOU. Now, GAIL has entered an MOU with ONGC and Shell Energy India. And they're going to explore opportunities for the import of ethane and other hydrocarbon particles, and also develop an evacuation infrastructure at Shell Energy Terminal in Hazira. Now, there were multiple brokerage notes that we also got on the Vijaypur plant visit. First, we have CLSA, which has maintained a sell rating at a target price of 188.55 rupees target. While they do have a positive outlook on the future opportunities, they're little the sell rating is on valuation discomfort. On visiting the plant is a core to multiple businesses and will be operational in FY24 and will be responsible for 60% of all transmission volume. Now, the company also mentioned about certain projects that it does have in focus right now, and one is a small-scale LNG plant, which is going to cater to the domestic LNG demand that has been growing in India, and other factors like gas turbine electrification and their LHC storage augmentation is to benefit the company, says CLSA. Then we had Motilal Oswal, which has maintained a buy rating of the stock at a target price of 215 rupees. Now, they've remained positive in terms of the capex cycle that the company has unwinded. They also mentioned about the small-scale LNG project, which will improve the availability in the under-penetrated areas that GAIL does not currently have as much reach. The company also announced a green hydrogen project, which is to be commissioned this year itself in May of 2024, and the management has planned a 20% hydrogen blending in their CGD network in Indore, while currently the rate is at 2%. And lastly, the management also mentioned that they are exploring ethane import at the Pata plant, which is in line with the latest MOU. Motilal finally expects a 14% EBITDA CAGR over FY24-26, and this growth expectation is mainly on rising volumes and the improved profitability of their petchem business as well.
Thank you for that, Mehika. So, the stock not responding too well. Let's just pull up the line chart of the day. The stock about 3% down right now. Sudeep, do you like GAIL?
I'm a little careful. I think there are too many international pulls and pressures on the gas prices at this stage. Fundamentally, they're doing well at this stage. And I think Motilal Oswal report, which talks about 14% CAGR, is realistic. But the uncertainty regarding global oil prices, I think, is what is a little bit of a concern. Also, PNGRB, the regulator, has been talking about keeping a cap on the local domestic prices. So I think that also is an area which is a little gray, because the statement coming out of PNGRB can be read both ways, whether they want to contain the profitability of these gas companies or not, or whether they want to encourage the spread of gas usage of gas as energy across the country. That also can be read, and in that case, GAIL has a stronger future than what we are envisaging today. So it is a bit confusing at this stage. So I will not probably jump to buy GAIL right now.
Okay, what about you, Hemen? Sudeep is a little circumspect when it comes to GAIL. How do you place it?
Actually, for the time being, it looks a bit overbought, Tamanna, on technical parameters. The current rise once again hasn't been supported, but actually, whatever I'm telling you is based on the daily chart, Tamanna. So I wouldn't take even myself that seriously. What I'm saying is things change. I mean, today is Monday. By Wednesday, Thursday, things might have changed. But yeah, we've had a humongous run up, and we are taking a breather. 176, 166, two possible targets on the downside. But yeah, I wouldn't short the stock. But yeah, there is heaviness, and this has resulted. The overbought situation resulted in some price weakness. The 55-day moving average is at 187. So sorry, it's at 172. So yeah, I would say more or less I'd agree with what he's saying. Absolutely.
All right, stay on, please, Sudeep and Hemen. I just want to also talk a bit about what the SEBI chairperson said today, and her comments come on a day when truly mid and small cap stocks are cracking. Microcap 250 is nearly 2.5% down right now. But SEBI chairperson Madhvi Puri Butch, in a conversation with women journalists, said that AMCs will have to disclose the results of stress tests for small and mid-cap mutual fund schemes by March 15th. She also talked about when T+0 settlement will be a reality. Listen in.
We are a disclosure-based regime. The objective is disclose so that the investor is an informed investor and can take an informed decision. So in terms of the disclosures, there is a format of a disclosure which has been approved, and that is mandatory. That's not optional for any mutual fund. They will disclose. I think the date is 15th March. So you will see that. We needed to give, a couple of weeks. So the stress testing, so let me explain. So what does stress testing mean? Okay, and what is the purpose of stress testing? The purpose of stress testing is to assess that if there is an adverse environment. So first of all, there must be stress in a stress test. Otherwise, what's the point? Right? So if there is an adverse environment, and how is that adverse environment defined? We have discussed with the industry as saying that if there is a significant redemption pressure, because what is the biggest risk that a mutual fund scheme runs? The biggest risk it runs is that it is a daily redemption product and the underlying market may not be that liquid, and therefore how do you deal with redemption pressure? That's the most important risk that any mutual fund scheme runs. So T+0 will come by the end of this month, and we've already announced the calendar of option. So this is optional T+0 end of this month and optional instantaneous in March of next year. Right? Now, one of the things which the industry, when we were having these deliberations, the industry asked us that, look, we are already well ahead of every other jurisdiction in the world with T+1. So what is the need to move to T+0 or instantaneous? Now, our answer to them was very simple, and I can only tell you that the entire room, and there must have been at least more than a dozen stakeholders in that room, instantly said, that's why. Okay, we agree with you. So what was that, that's why, was we made a simple point. We said, look, we know from where we sit in our ISCO meetings, etc., crypto is going to come.
Okay, correcting it to crypto as well, but FPIs may or may not come, some set of investors may or may not come. And that's interesting. Frankly, people who do BTST trades will not choose T+0. People who are using the broker money for margin calls will not choose T+0.
Yeah.
So there's a set of investors who will completely stay out of this. But, well, India can do it. India is wanting to do it.
What I really also like about the regulator and the SEBI chairperson is the clarity of thought and communication, and also forward-looking. The fact that the market is also always on its toes when the SEBI chairperson speaks is, I think, a good thing.
Yeah.
As well.
So Deep, just very quickly here, I mean, this T+0, big deal you think, or not quite?
Well, not quite today, because we are already at T+1. But I'm not sure, how that moves the needle, whether it will be convenient or not, who all it will benefit. I think it's a little doubtful, whether the incremental cost and operational challenges is worthwhile for this small change. So I'm not very gung ho on T+0, and there will be a lot of challenges of BTST, STBT, and all these products, and broker funded products. So let's see how things pan out. We have optional starting in this March, and compulsory thing happening from next March. So we'll wait and watch and see how things pan out.
Since it's optional, let's wait and watch how many people indeed go for it. But it's a good note to get in Hemen Kapadia for his BTST ideas or STBT ideas, as the case may be. Hemen, what would your recommendations be?
Okay, firstly, Neeraj, I have a BTST on AU Small Finance Bank. It's from the rounding bottom. It's after a buy call. The mechanical indicators on the hourly charts and not only the hourly charts, but also the 2 hourly charts have turned positive. They've given a crossover buy. So buy at around 584, stop loss of 579, target of 594, risk reward ratio of 1:2, and STBT on DLF. One can sell DLF at 1 rupee higher at 912, stop loss of 917, target of 902. Once again, risk reward ratio 1:2, 5 rupee stop loss, 10 rupee target. PTSG on AU Bank, STBT on DLF.
All right. So AU Bank and DLF on Hemen's radar. Sudeep, I want to know your take on the Tata pack. And yeah, they're ending the day also with pain. You're seeing that weighing down on the Nifty. Tata Consumer down now by 3.5%. Tata Steel. Of course, Tata Chemicals, the one bludgeoned the most. And we should pull up all of those companies here. Do you reckon that the pain will continue? Or is this, one day's reaction?
I honestly think this is one day's reaction. Like we had seen the reverse happening, they were all moving up last week based on the assumed theory that Tata Sons will get listed and hence Tata Chemicals will be the biggest beneficiary, blah, blah, blah. The market kind of took up all the Tata companies. And because the reports came that they are probably not looking at listing, but some other structure to meet with the RBI requirement, I think this crash or whatever you call it, we are seeing today. Of course, Tata's Tata Steel has a different reason with global iron ore prices moving down the way they are. China stimulus not really coming in. There is a bit of a disappointment as far as the metals market is concerned, and that is probably reflecting on Tata Steel and some of the other steel company share prices.
Tata Chemicals, I mean, Sudeep, the story has been the rage of town the whole of last week, and today it's kind of seeing some bit of gravity. Now, subject to when the IPO were to happen, is it pricing in some of those positives already, or could there be more?
It was priced in. I mean, if you had asked me Thursday, it was more than priced in, and that's why the price went up where it went up. And now with that not happening, the prices are coming down. I think, the company has improved its performance significantly, but the caustic soda ash bit, there was a challenge, and we did see it in the last quarter's numbers. We'll have to wait and watch. I think, even today, I think it's more than fully priced. So I don't think we should rush into Tata Chemicals at this stage.
Okay. Don't rush into Tata Chemicals at this stage. Some other stocks too have corrected a bit in the session today, I must say. The NBCC, NCC, real estate stroke infrastructure pack has really been beaten down today in shape, out of shape today. So watch out for that one. Amongst other things, GMM Pfaudler with this 4% correction at 1263 must be trading at multi-quarter lows, if you will. So watch out for that one as well. Let's see how these shape up. Sudeep, are you in the market putting in money to work, or are you biding your time because you believe there'd be better levels? I mean, if so, which pocket, which stock, which sector are you looking forward to?
I am kind of biding my time. In fact, this entire PSU, particularly, and I've been vocal, I think I've spoken about it to you as well on your show. The entire defense pack, the valuation was looking unrealistic. So in the railway side, I think both are fantastic sectors. The government of India is putting a lot of money behind both these sectors, and justifiably so. Defense Make in India is a fantastic opportunity, once in a lifetime opportunity for India and Indian companies. But unfortunately, what happened is share prices went to stratospheric levels, probably without having the right fundamentals in place. I think the time correction or the logical correction, what was supposed to happen, is probably happening. Some reports have started coming out questioning the valuations. And once they become a bit more reasonable, I think these will be great buys for long term. Both on the railway side as well as the defense side, particularly defense electronics, shipyard companies. I think they have a great future.
Okay, gentlemen, Hemen as well as Sudeep, thanks so much for taking the time out and being with us. Really appreciate your time this afternoon. We are 2 minutes away from the markets to shut. Let me just quickly talk about how the large caps are doing in a minute, and Tamanna will bring you up to speed with the broader end of the spectrum, where usually the larger piece of the action is. But today, the large caps are ending at the lowest point of the day, the intraday of the Nifty very quickly, and then the heat map, and just show you how it's turned out. So the intraday of the Nifty will come up on your screen, and as you can see, we are ending at the low point of the day. So not a great sign, by the way, if you are bullish on the markets, because it's not turned out to be a great day. It wasn't expected to be a really good day, but this has kind of turned out to be slightly more weak. Bring up the heat map and show you what's moved and what's not, and bring up the contributors list posts that are a bit more red than green on the screen. The set of losers remains the same, but for the fact that SBI is now trading even worse than what it was, and giving it company at ONGC and HDFC Bank too. What's done well? Well, some bit of a defensive bent to that, some life insurance, some FMCG. So that's the long and short of it. Just the contributors list before Tamanna brings us up to speed with the broader end of the spectrum. But I think you'll probably see HDFC Bank, you'll probably see SBI. The Nifty contributors will come up on your screen. HDFC Bank, Reliance, SBI, ICICI Bank. Bobbing between that and Infosys is the set of losers hardly any gainers worth talking about. So a lot of red on the screen, Tamanna.
Absolutely, and I think if you look at the advanced decline ratios overall, you'll see the kind of pain that we have seen through the day, that gap widening right towards the end. And Neeraj, we're talking about pain in the Nifty and the Sensex. Just pull up the small cap, the micro cap, mid cap. All of them have had a tough afternoon. And you've seen that, maybe not the mid cap so much, but pull up the small cap index down 2%. I want to just pull up the Nifty micro cap as well, because you're understanding where really the pain is lying, that nearly 2.5% down. Insurance companies, one of the bright spots in SBI you spoke about, maybe a Narayana Hrudayalaya as well, apart from a Max. Apollo, which we also saw on the Nifty. Narayana Hrudayalaya up about 8% in trade. But the big losers, Tata Chemical, we have to see how Tata Chemical closed. Indian Hotels, Tata Investment, the whole lot of them. Tata Chemical shut about 11% down. Indian Hotels about 3% down. Rallis as well. We can pull up and see what happened to Rallis at the end of it. Tata Investment, after being stuck on the upper circuit for several days, now on a lower circuit, as well as Rallis. Just IIFL and JM Financial is the other two that I would mark out for stocks with a tough day. 7% down, IIFL Finance, JM Finance nearly 10% down. So those broad themes, one reckons, of finance taking a bit of a beat, definitely continue. Not too much on PSU stocks overall as well, apart from PSB banks. A bit of profit booking coming in.
Most certainly.
Yeah.
Let's see how this shapes up tomorrow. But for now, from Tamanna and me and the team that has put India market close together, thanks so much for tuning in.
The farmers' protests have been making headlines. Indian farmers have demands such as legal guarantee on MSP, pension and debt waiver, no hike in electricity tariff, reinstatement of Land Acquisition Act 2013 and more. But while the protest becomes important from the point of view of elections and politics, it's not just India that has its farmers agitated. The streets of Spain, Belgium, Hungary and Poland have been roaring with protests by farmers too. Around 1,400 tractors took part in a protest in Poland and roads were blocked across the country. What do they have a problem with? Rising production costs, falling sale price, stringent regulations. They say that the European Union is not doing enough to stop cheap imports from Ukraine, which is affecting the demand for local produce. They are also not happy with the European Union's Green Deal that's designed to zero out pollution by 2050 because it limits the use of pesticides, which in turn affects yield. In Greece, farmers have demanded lower electricity prices, tax-free diesel and subsidized animal feed. In France, farmers have been fighting for improved pay and protection from foreign competition. The French government offered 400 million euros, that's $436 million, in various measures in reciprocation to their problems over low earnings, heavy regulation, and unfair competition from abroad. In Germany, farmers are against the government's decision to phase out tax concessions on agricultural diesel. Their argument is that this will lead them to bankruptcy. In Romania, the protests stem from anger about low prices for produce, rising costs, imports of cheap foodstuffs, and constraints imposed by the European Union's drive to fight climate change. In the United Kingdom, farmers are struggling to keep up with weather changes and war-related supply chain disruptions. The whole of Europe seems to have the agricultural sector in pain as climate change becomes a central focus and production prices increase. And no, it doesn't end there. As per Down to Earth, since 2023, farmers have protested in 67% of countries in South America region for a variety of reasons, such as wanting better export exchange rates and reduced taxes amid an extended economic downturn and Argentina's devastating drought, which have severely damaged crops and agricultural output. And look at this data. Farmers' protests have happened in 12 countries in Africa, 11 countries in Asia, 24 countries in Europe, 8 countries in North and Central America, and 2 countries in Oceania in just a year's time. So let's boil down all this worry to 5 main reasons, India included. Pricing of produce, delayed compensation or subsidy, unfair effects of climate change, policies and regulations, import and export duties, and supply chain discrepancies. What does this say about the world of agriculture? Does it just question politics and governance, or does it hint at a bigger problem, a potential global food crisis?
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies.
Welcome. You're watching the Small and Mid-Cap Show. This is Mahima Vajrajani. Kalyani Steels is in focus. The stock is down around 2.37%. Well, the stock is trading with cuts today. The company signed an MOU with Odisha government for over 6,626 crore along with order of manufacturing of defense components. Additionally, and iron ore futures have been lower by 11.66% in the past 1 month. So what will be the impact on raw material prices, and the China's demand has been disappointing. To discuss all of this and more, we have R.K. Goyal, Managing Director of the company with us. Welcome to the show, sir.
Good morning.
Good morning. My first question to you is that the MOU that you've signed with the Odisha government, well, it's approximately 6,000 crores MOU. My first question to you would be that what is the stake, what is the share of Kalyani Steel in this? And to add to that, what kind of top line addition are you expecting from this particular MOU?
You see, as far as this MOU is concerned, it is 100% Kalyani Steel. As of now, we are not envisaging any contribution from any of the other companies. It is basically Kalyani Steel. And once this project is commissioned, we are still working out on a product mix and all. It will be much better, much better than what we are doing currently. Basically, because the type of products we are going to produce will be largely very different than what we are doing now. It will be all high alloy and are of very different specs in terms of size, dimensions, clean steel, cleanliness and all. And it will be for different segments than what we are doing currently.
Right. So since it's different segments, I believe this will be margin accretive. At present, your EBITDA margins are around 20%. So do you expect your margins, like higher margins from this particular MOU, one thing, and what kind of top line addition are you expecting from this MOU?
You see, currently our top line is close to 2,000 crore. And even if we produce at 90% capacity, it will be definitely more than 2.5 to 3 times of the current top line. At the same time, the average margin per ton, we definitely expect it to be much more than what it is today.
Right. So, sir, the iron ore prices have gone down around 11% in the past 1 month, and this signifies that the futures will also go down. And this means that lower cost of raw material for you in the coming future. So what kind of impact will this have on your P&L, both profit and margins?
You know, when you are talking of iron ore price, I believe you are talking of international price of iron ore. They are not in tandem with the local iron ore prices. In fact, local iron ore prices have gone up in e-auctions, particularly in Karnataka. So definitely there is an increase in cost rather than any decrease in cost.
Okay. And what does your inventory cycle look like especially for your raw materials?
So we do not carry a very huge inventory. Everything is close to 1.5 month maximum, all put together. Everything, whether it is raw material, whether it is WIP, whether it is FG put together.
Right. And do you also export? If yes, what is your export-import mix?
So we export very little quantity, negligible quantity. It's insignificant as we like to cater to our local domestic customers. And our capacity is just adequate to take care of them. In fact, we are short of material, and that's why we are going for expansion.
Right. And at present, for all your plants, what is the capacity utilization at present, and where does this go by, let's say, FY25?
You know, currently, since last several years, we are utilizing our capacity by and large at 100%, except for certain period during COVID and all. Otherwise, it is all 100% capacity utilization.
Okay. And in terms of capex, what was the capex for your 9 months FY24, one thing, and where will it stand by the end of FY24? And coming FY25, what is the capex that you're aiming at?
You know, as far as the capex part is concerned, in the existing plant, we had to spend only some money in Coke Oven. Rest all we did not do anything. Now, whatever additional investment we will do it in Orissa. We are still working out the detailed modalities.
Right. Also, in terms of your revenue guidance, if you can tell us what kind of revenue are you looking at in terms of CAGR growth by FY25?
You know, as far as the current operations are concerned, they will continue maybe marginally better than what it is. The new expansion project will definitely take some time. You know how much time it takes typically to set up a steel plant, starting from 0 day to get EC, and then most of the equipments are long delivery. So it will definitely take almost 4 years of time.
Right. But overall, if we see revenue growth of what CAGR are we looking at, let's say by FY25?
So you see, it depends on we are already utilizing 100% capacity. So if there is an increase in price, only to that extent the revenue will grow, otherwise not.
Right. And in terms, so let's say if your EBITDA margins at present are at 20%, where does this EBITDA margin go by FY25, by the end of FY25?
This itself is a challenge to maintain this level of EBITDA. So we do not expect it to go up substantially further. Yes, there may be something here and there, but we may be operating at the current level, maybe marginally here and there, based on some further improvements which we bring in the manufacturing operations.
Right. Okay. So thank you so much for speaking with us at NDTV Profit, sir. It was a pleasure speaking to you. It's time for a short break, but don't go anywhere. We have NLC India's Prasanna Kumar Motupalli joining to talk about company's recent projects in Rajasthan and Gujarat. Stay tuned.
Co-presented by Patanjali Chyawanprash, world's best Patanjali Chyawanprash made from 51 precious herbs.
Hello and welcome to NDTV Profit. Today we will talk about tattoos and the worth of this market. The history of tattoos in India can be traced back to prehistoric times when tribal people were captivated by drawings on stone or wood walls. Their attempt to replicate these figures through needles gave birth to the practice of inking skin. Over the course of time, tattoos were embraced by tribals as a mark of bravery, war, religious beliefs, customs, marital status, protection from the male gaze, and so on and so forth. Today, in 2024, tattoos have become a means to express thoughts, individuality, personal experiences, and sentimental designs. The industry is estimated to generate over 20,000 crore rupees per year. What is driving this growth? One of the key drivers behind the growth of the tattoo market is the rising demand for customized and unique designs. Improved technological equipment for making advanced, safer, and painless tattoos have boosted the market. The laser technology for removal or modification of tattoos have also added to the surge. Increased exposure and promotion of tattoo designs on social media have led to widespread influence of tattoo culture on the youth. Take a look at these figures now. As per Fortune Business Insights, the global tattoo market is projected to grow from $2.04 billion in 2023 to $3.93 billion by 2030 at a compound annual growth rate of 9.87%. This is a sharp rise from 3.8% year-on-year growth between 2017 and 2022. As per Custom Market Insights, the diamond jewelry market is expected to grow at a compound annual growth rate of 5.5% by 2032, while the luxury jewelry market at a rate of 8.9%, but the tattoo market is estimated to grow at 9.5%. Is the tattoo business lucrative? According to an article by Opportunity India, tattoo kits are now easily available for less than Rs 10,000, while high-end kits range from Rs 20 to 35,000. Now, in a city like Mumbai, the average cost per inch is Rs 2,000 to 2,500. In Delhi and Bangalore, the cost per inch is between Rs 1,000 to 2,000, and in Goa, it is about Rs 500. We spoke to a couple of tattoo artists in Mumbai and found that at an average, the business earns them a profit of Rs 75,000 to 1 lakh per month. In fact, as per an article by India Today, a person can earn a minimum of 20,000 rupees to Rs 2 lakhs per month depending upon one's work and creativity with an initial investment of 1.5 to 2 lakh rupees. A beginner level tattoo artist can earn a minimum of 20,000 rupees per month, which gradually increases to a couple of lakhs or more depending upon the caliber of the artist and the uniqueness of their artwork. And I'd like to leave you with an interesting data by Advanced Dermatology that revealed that 63% of people with a tattoo smaller than the palm of their hand regret it. The reasons being impulsive decisions, 35%, significant meaning, 29%, or the idea that it would make them look cool, 18%. Thank you for watching and stay tuned to NDTV Profit for more.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right.
Welcome back. You're watching the Small and Mid-Cap show. This is Mahima Vachrajani. Well, the other company on our radar on Small and Mid-Cap show today is NLC India. The company recently won an MOU with Rajasthan government of around 7,000 crores to set up a joint venture for adding thermal renewable capacity. Additionally, the government has opened an offer sale on March of 6 to raise capital worth 2,100 crores. Furthermore, the company is targeting to double the mining and renewable power capacity by 2030. Prasanna Kumar, CMD NLC India, joins us now. Welcome to the show, sir.
Thank you, madam.
Right.
Good morning.
Good morning. So my first question to you is that this JV with Rajasthan government, it's around an investment of 7,000 crores. Now, first question is that what is your stake in this JV and when will this be operative and what kind of revenues are we expecting out of this?
Yes. Madam, as you know, Rajasthan is blessed with lignite resources and NLC is having expertise in utilization of lignite. That's why this JV is formed to utilize the lignite in the Rajasthan and setting up of thermal power generation there. And we are also setting up of 1,000 megawatt solar power plant also in the Rajasthan. So the total investment will be 7,000 crores and the majority of stake will be with NLC and it will be operated by NLC. And we are expecting after making it operational, we are expecting a return of around 15 to 16% from these investments.
Right. And also recently you signed a power purchase agreement with the Gujarat government with GUVNL for 600 megawatt solar power in Gujarat. What are the kind of synergies that you're expecting out of this? What kind of revenues will flow to your PNL through this MOU?
Madam, this 600 megawatt solar project is the largest at one place for NLC India, and it is being constructed in Khavda Solar Park, where the radiation levels are highest in the country. So we are expecting very good efficiencies out of it, and we will be investing around 4,000 crores for this project. And here also we expect a return of around 15% from this business.
Right. So considering both of these projects, where does this take your margins at once when you start realizing gains from these projects?
But we will be completing these projects in the next 1.5 year, and we expect that our it will add to our revenue as well as profit substantially, and that will improve our bottom line.
Right. Can you just give us a number as to how much your margins will improve by?
It is very preliminary to talk about the margins, madam, but the margins will be substantial.
Right. Okay. And so considering these two plus the entire order pipeline that is there with NLC right now, what is the pipeline at present and what does the execution timelines look like for the entire pipeline?
Madam, as on date, we are 1.4 gigawatt renewable capacity company, and we are targeting to become a 6 gigawatt company by 2030 with an investment of more than 24,000 crores. So, as on date, 2 gigawatt projects are in pipeline. 600 megawatt in Gujarat, 810 megawatt in the state of Rajasthan, and in the Pugal Park, and 300 megawatt in the Bikaner district. Total 2 gigawatt projects are in pipeline, and these 2 gigawatt projects will be completed in next 1.5 year. And subsequently also we are having projects in pipeline. We are installing solar power plant in the mine reclaimed land also, which is first time in the country of 50 megawatt capacity. With all these things, we will become a 6 gigawatt company by 2030, madam. That is our plan and target.
Right. And what is the capacity utilization of all your plants at present?
The capacity, when you are talking about the solar plants, these plants are in operation for last 4 or 5 years. It is capacity utilization is in line with the design. It is different from different projects. For some projects it's 19, for some project it's 20. They are in line with the design. They are operating in line with the design. Apart from the focus on the installation of the solar plants, we are focusing on the O&M of the solar plants also, so that we can get maximum benefit out of the solar plants.
Right. And in terms of lignite versus power, what is the revenue mix at present?
Madam, actually, our lignite lignite production and power production both are interrelated, because we feed our own lignite to our thermal power stations. So most of our revenue comes from the power generation portfolio. More than 70% our revenue comes from power generation portfolio. But it is a combined revenue of both for mines as well as thermal power generation. Whereas in our coal sale, we are also going for the sale of the coal substantially, and it is more than the whatever we did in the last financial year.
Right. And in terms of your under recovery, what was the under recovery total for the 9 months that have gone by, and where will this stand at by the end of FY24, and how has this impacted your top line and bottom line?
Actually, madam, last financial year there was a problem in land acquisition in the Neyveli area, and also there were a number of problems because of the heavy rains, and that happened. Because of that, one of our unit was under shutdown. So the approximate under recovery is around 400 crores, and we will end up with around 400 crores of under recovery, which will be less than the last financial year.
Right. And how has this impacted your top line and bottom line?
This under recovery 400 crores is direct impact from the top line and bottom line. But this we are compensating by increased production in the last quarter of this financial year. Already our lignite production reached 1 lakh metric ton per day. And also we are compensating through the sale of the coal that is happening at Talabira. With all these things, we are trying to reduce the impact.
Right. And with reference to your OFS sale, you must have met your investors. Are there any concerns that the investors have been raised, and have you addressed those concerns? What are these concerns, if you can tell our viewers about it?
Madam, overall, in whatever interaction we had, the investors are very happy about the performance and the strategy we are following in balancing the conventional power generation and renewable power generation. And there is a positive feedback from all the investors. And whatever doubts are there, those doubts we already cleared. And the investors are, overall, they are happy with the performance and strategy being followed by NLC.
Right. Thank you so much for speaking with us at NDTV Profit, sir. It was a pleasure talking to you.
Co-presented by Patanjali Chyawanprash, world's best Patanjali Chyawanprash made from 51 precious herbs.
Amul has completed 50 years in India. PM Modi will attend the Silver Jubilee celebrations of the Gujarat Cooperative Milk Marketing Federation, the owner of Amul. At one point of time or the other, we've all grown up with Amul butter or milk for sure. The famous Amul girl created in 1967 is family. We all recognize her. But as the brand grows 50 years old today, do you remember the full form of Amul? It is Anand Milk Union Limited. From producing 250 liters of milk per day since the time Amul was formed back in the mid-90s to today, where Amul has over 36 lakh dairy farmers and produces nearly 300 lakh liters of milk per day, the brand has had a long journey. The story goes way back in time. In the 1940s, dairy farmers were worried. The middlemen exploited their ways of profitable income, and a poor milk production system made their living difficult. Tribhuvan Das Patel and Verghese Kurian identified these issues and helped in the formation of the first milk union called Kaira District Cooperative Milk Producers Union in 1946. The cooperative model gave farmers direct ownership of the dairy industry. The union helped them process, market and sell milk and milk products without the interruption of intermediaries. And it was in 1955 that this union chose a brand name for itself called Amul, which means priceless in Sanskrit. And then in 1973, Amul Dairy, along with 16 other district cooperatives, formed the Gujarat Cooperative Milk Marketing Federation, which has now completed 50 years in India. Amul also started India's white revolution that made our country the world's biggest maker of milk and milk products. The brand follows an umbrella marketing technique which has helped GCMMF prevent association clashes and keep an open door for the patrons to coordinate in creating items. As per a report by Statista, the annual sales turnover of Amul from 2011 to 2023 has consistently risen, recording about 55,000 crore rupees of turnover in 2022-2023 alone. And did you know, Amul has also held a Guinness World Record for having the longest continuous run of any advertising campaign that has ever taken place anywhere in the universe. Amul Doodh Pita Hai India and Utterly Butterly Delicious will always strike a chord. Let us know which famous advertising phrases of Amul do you remember.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles.
Tata stocks plunged after media reports speculated that Tata Sons may be looking for ways to avoid a forced IPO. Supreme Court dismisses SBI's request for an extension to put out the details of electoral bonds, orders it to furnish the details by tomorrow. Big relief for stock market traders, same-day trade settlement to start by March 28, says SEBI chief. SEBI mulling additional disclosures to curb the manipulation and IPOs of SMEs, says Chairperson Madhvi Puri Bush, adds that the small offerings are easier to manipulate. NDTV Profit news break confirmed. SEBI Chairperson Madhvi Puri Bush says that the AMCs will have to declare the stress test outcomes for small and mid-cap mutual funds by this Friday, that is March 15th. Byju's vacates all its offices except the Bengaluru headquarters to cut costs. Sources say that the process had been going on for the last 6 to 8 months.
Hello and welcome. You're watching The Reporter on NDTV Profit and I'm your host Pragati Oberoi. As always, the show aims to bring you the market headlines along with national and global news as well. But before we delve deep right in, let's take a quick look at how the markets fared during the day. Now, both Sensex and Nifty fell nearly 1% each. Pharma and healthcare were the only indices that ended the day in green. My colleague Neeraj Shah joins in with a quick wrap of all the market action.
A week close for the markets today and closing at the lowest point of the day, even for the broader end of the spectrum. It's not just the Nifty which took it on the chin, not on the chin really, but down today. But the mid-cap and the small caps in particular also look slightly wobbly, and that is where the worry came in because the market breadth was very, very adverse, 2% lower for the small caps. The large cap end was punctuated by losses to banks. If you just look at the top contributors or the top losers, you will see what I'm talking about. Banks looked weak. HDFC Bank, ICICI Bank, Kotak Bank, IndusInd Bank, they were amongst the set of top losers today. And amongst the set of top contributors as well. Reliance had a bit of a wobble. Infi had a bit of a wobble today. And as you can see on the gaining side, not too many strong hands out there. TCS had that meager 3-point contribution on the gaining side. So therein lay the problem. But the broader end of the spectrum was, and by the way, FMCG did well. So you saw everything from a Nestle to some others having a decent outing on the Nifty at least. There was a bit of a defensive bent, life insurance and select FMCG names which did well. Now bring up the Nifty 500 winners and losers on the screen, and we'll see the broader end of the spectrum too having some bit of an issue. Tata Chemicals was symptomatic of what happened to the Tata Group stocks. Save for Trent and Tata Elxsi and maybe TCS, none of the stocks were in the green. But Tata Chemicals led the fall. JM Financial corrected in the session today as well. There was weakness in IFL Finance yet again. Aegis and Sham Metallics were some of the others which corrected. On the flip side, some gains for Narayan Rudalaya, NLC, because the OFS got over, Kalpataru Projects, Linde India, Wellspin. There were a few names which kind of stood out. But overall, there was a lot of pain. Media was the top contributor or the top loser, and that index doesn't seem to be being able to recover. And just look at the kind of falls that came into some of the stocks. Media 2.9%, but metals, energy, real estate, iron ore futures at the lowest point at about close were all key reasons why the market looked very wobbly. Let's see what is in store tomorrow.
That was the market wrap for you at the start of the week. Now straight to the top story of the day. The Supreme Court has dismissed the SBI's request for an extension to put the details of the electoral bonds out. Now SBI has to furnish all the details by tomorrow. My colleague Varun joins in with more details on what all transpired at the court during the day. Varun.
Yeah, hi, thanks Pragati. So yeah, the Supreme Court has dismissed the State Bank of India's appeal for an extension to disclose the details of electoral bonds and has ordered the bank to furnish the details by March 12th, that is tomorrow. Further, the court has also directed that the Election Commission of India should compile and publish all the details that will be furnished by the State Bank of India on its official website by no later than 5 p.m. on March 15. The top court has noted that the contributors under this scheme were required to submit a KYC form and a proof of payment which was made through a demand draft or a check. And therefore, the details of the contributors are readily available with the State Bank of India, the apex court had noted. Further, the court said that India's biggest public sector bank, State Bank of India, didn't need more time to furnish the data regarding the electoral bonds. Now, arguing for the bank, Harish Salve said that the problem is that the bank will have to take out the name of each purchaser and the names will have to be correlated with the redemption details of the political parties, and that all this will have to be done physically and that none of this information was available in the bank's central database. Chief Justice of India D.Y. Chandrachud observed that SBI had been asked for a plain disclosure and added that we have not asked you to undertake a decoding exercise as has been pleaded in the SBI's plea. He added that for every purchase, you had to have a separate KYC and therefore you already have all the details. In essence, the court has said that the details of the contributors and the redemption details pertaining to political parties need not be bridged and that a separate disclosure will suffice in this matter. Now, a 5-judge bench of the Supreme Court was also dealing with the separate contempt proceedings against the State Bank of India. However, the court has dismissed the contempt action as of now, in view of the extension that was sought by the State Bank of India. However, the court has said that if the State Bank does fail to comply with the orders that were issued today, it might initiate a contempt action against the State Bank.
All right, Varun, thanks so much for sharing those details with us. The Chief Justice of India, D.Y. Chandrachud, has also asked SBI Chairman and MD to file an affidavit and comply with the top court's verdict in this. Now, here's what he said in the court.
SBI shall file an affidavit of its Chairman and Managing Director upon compliance with the directions which have been issued above. Stop. While we are not inclined to exercise the contempt jurisdiction at this stage, bearing in mind the application which was submitted for extension of time, we place SBI on notice that this court may be inclined to proceed against it for willful disobedience of the judgment if SBI does not comply with the directions of this court as set out in its judgment dated 15 February 2024 by the timelines indicated in this order.
That was the CJI on the contempt proceedings. But how will India's largest bank now act towards Supreme Court such a tight deadline? We are now joined by Vishwanath Nair to tell us more on this.
So with the Supreme Court having given a definitive deadline to State Bank of India to submit all details regarding the electoral bonds in India, now India's largest lender will try and meet with this deadline, that is tomorrow evening. What State Bank of India raised as an issue during the hearing was that it could not actually match the details of the investor in the electoral bond with the details of any redemption by political parties on the other end, and that process would likely take a longer period of time. However, the Supreme Court's order specifies that you could probably submit it in two different documents, one with the redemption details and the other with the actual investor information. So now that part is clear, and SBI through its lawyer Harish Salve have said in court that they have this information ready, but in two different silos. So it's likely that State Bank of India will submit all of the details sought by the Supreme Court by tomorrow, thereby avoiding any kind of a contempt contempt of court problem coming up at the Supreme Court.
That was the update that we had from sources on SBI. Now, in what may come as a relief for the stock market traders and investors, SEBI is all set to start the T+0 trade settlement on optional basis by 28th of March. Here's what Chairperson Madhvi Puri-Buch had to say about the same day.
So T+0 will come by the end of this month, and we've already announced the calendar of option. So this is optional T+0 end of this month, and optional instantaneous in March of next year. Right? Now, one of the things which the industry, when we were having these deliberations, the industry asked us that, look, we are already well ahead of every other jurisdiction in the world with T+1. So what is the need to move to T+0 or instantaneous? Now, our answer to them was very simple, and I can only tell you that the entire room, and there must have been at least more than a dozen stakeholders in that room, instantly said, that's why. Okay, we agree with you. So what was that, that's why, was we made a simple point. We said, look, we know from where we sit in our ISCO meetings, etc., crypto is going to come.
Now, SEBI is also mulling additional disclosures to curb the price manipulation in the initial public offerings or the IPOs of SMEs. Now, let's quickly take a look at what the chairperson had to say on this.
Many of the surveillance measures like ASM, GSM, which earlier were not applicable on the SME board, have been made applicable there. And the principal objective of that is really to try and mitigate the risk of price manipulation. Having said that, the reality is that these are relatively small entities. The market cap is small, the free float is small. It is relatively easy to manipulate both at the IPO level and at the trading level. So is there something more that needs to be done? I think as a first step, we are clear that some more disclosure in terms of risk factors. So for investors to understand that the SME segment is different from the main board, the regulations are different, the disclosures are different, and therefore the nature of the risk is different. I think it's important for SEBI to underline that in terms of disclosures to the investors.
Now, at the same press meet, SEBI chairperson once again, Madhvi Puri Buch, confirmed that a previously reported NDTV Profit exclusive that AMCs will have to share the stress test outcomes for small and mid-cap funds by March 15th. We have my colleague Saloni Kothari joining us with more details on this. Saloni, thanks so much for joining in. What more insights can you share from this recent press meet?
Thanks, Pragati. So as we played the bite, apart from that, she also mentioned on the mutual fund stress test that we've been extensively covering is that a disclosure on the format of disclosures which has been approved, and the same will be released on 15th of March on the AMFI website. Now, the stress test was done for adverse environment, and this is on the back of the assumption of a redemption pressure for any reasons that may arise, and at that time to assess how many days will any mutual fund schemes will take to be able to exit from its underlying portfolio. So some disclosures related to that as well is something that we need to track on March 15. Now, the second important point that she made is the regulation on performance validation agencies, which is expected to be coming out soon. It can be in this board or next board meet in June. Now, this is coming after the misleading claims of performance that has been made by many finfluencers for that matter, and a consultation paper on the same was released last year. So to have a wider set of regulations on that area, however, the details of what the regulations will be and when it will come into force is something that we need to be keeping a watch out for.
Right, Saloni, thanks so much for bringing us those details from the press meet. Let's also take a look at Tata Group stocks, because these stocks ended lower after reports suggested that the company is trying to avoid a forced IPO. Now, 14 out of the 19 Tata Group's companies tumbled during the day's trade. Spark Capital also claimed that Tata Sons could potentially fetch a value of 7 to 8 lakh crore rupees at the current market cap. Now, earlier in the day, we also spoke to Vidit Shah, the analyst at Spark PWM. Let's quickly take a look at what he had to say about it.
There were a few reports that were published the week prior about the potential listing of Tata Sons in a year and a half's time. And deep diving digger, we noticed that there is a lot of value that one could ascribe to the Tata Sons group. So we ascribed about 8 lakh crore value to the group. And to answer your question whether the IPO is the only way out, no, it isn't. The RBI has classified it as one of several upper layer NBFCs, and it's classified as a core investment company. The mandate is to list within 3 years of this identification, which was back in September 22. So that's one way out. The other way out would be to restructure its group holdings and debt for it to not be classified as an upper layer NBFC. So those are the two primary options available to the group as of now.
Well, now in another update we have from Byju's, and the troubles are mounting for the EdTech firm. Now, in the latest update, Byju's has vacated all its offices except the Bengaluru headquarters, all to cut the costs. Now, sources tell my colleague that the process has also been going on for the last 6 to 8 months. We are joined in by Rishabh Bhatnagar for more details on this.
That's right, Pragati. The latest we have on the Byju's crisis, rather the implosion that's happening at the EdTech, is that they have vacated all their offices apart from the one headquarter building that they'll continue to retain, that's in Bangalore. That would mean that about 14,000 of its employees will now work from home purely, apart from the 1,000 odd employees that will continue to work from the headquarters. This is not something that's happened overnight. It has been going on for about 6 to 8 months now. The leases that have been sort of dying down. They haven't been renewed by Byju's over the past 6 to 8 months. This is all a part of cost-cutting measures. Why these cost-cutting measures are needed? Because obviously the company is very, very deep in losses. They reported about an 8,500 crore loss for FY23. And we don't see that improving considerably going into FY24. They're also in the midst of multiple legal battles. Their $200 million rights issue is also in limbo. They're not allowed to access that money, due to which they also can't pay their employees now. So we'll continue to track the implosion that is happening at Byju's.
Thanks so much for bringing us those details. Now, another very important story on the KYC process. Now, this year's union budget proposed to simplify the KYC process from the current one-size-fits-all to a risk-based approach. But the problem is that it is still a work in progress, as the regulators are yet to arrive at a point of consensus on how to improve this entire system. My colleague Janni joins us to give us more perspective on this. Janni, what are exactly the headwinds that you're facing in this, or rather you're picking up from your sources?
The multiple ways in which a customer today can complete their KYC documentation. There is Aadhaar OTP, Aadhaar biometric, CKYC, there is even digital KYC, video KYC. There's also the old school physical verification where you can be present in person, called the OSV, Original Seen and Verified. And this can also happen digitally via the DigiLocker facility. So all of this begs the question of a standardized system of data upload and usability across regulators and regulated entities. Now, this is where the simplification of KYC agenda came up in the 2023 budget announcement. But like you said, it's been a bit of a standstill announcement, and that's primarily because regulators have not arrived at a point of consensus on how they can bring about this uniformity. Now, the Finance Ministry has said to have established a committee under Finance Secretary T.V. Somanathan to look at RBI's report on a risk-based KYC. A risk-based KYC is where, based on an individual's level of engagement, be it for opening a bank account, be it for trading in the markets, based on that, they will be giving the KYC details that they need to give. Accountability in terms of what happens if there is a data leak, responsibility for that data, and also in terms of regular updation. These are some of the problems that have not been solved. We have multiple regulators having multiple systems at this point. And since businesses, for businesses, this is not a profit generating venue, this is just a compliance measure. So we're not getting a lot of enthusiasm from them either. So this is where things stand as of now, but we'll keep tracking this and bringing you more updates as we know better.
Well, it's time to slip into a short break, but please stay tuned because we have lots more lined up for you.
Hello. Good morning, ma'am. I'm speaking from XYZ company. Are you looking for a job or a job change? Have you been receiving unwanted calls from spam numbers? Are you tired of being offered new jobs, insurance schemes, or free health checkups? Well, today we will look at an interesting survey report by local circles on pesky calls that received 60,000 responses. Most unwanted calls are related to financial services, 54%, and real estate, 22%. In fact, the report has taken names. 40% mobile subscribers have identified Bajaj Finance as a top offender, HDFC Group as the second biggest pesky caller. The report reveals that 60% of people received 3 or more spam calls on an average day every day, and 92% of people registered on the Do Not Disturb list still get pesky calls. So is being listed on D&D working? Clearly not. But the report also recorded a minute relief, as per which 6% people don't get any such phone calls. This relief comes after the TRAI directive to banks, insurance companies, and other commercial entities. TRAI is the Telecom Regulatory Authority of India. In fact, the Department of Consumer Affairs has constituted a committee comprising members of different regulatory authorities, telemarketing companies, and cellular industry to draft the guidelines to address the issue of pesky calls. So yes, pesky calls are still a worry, but there is a little relief too. Can you ignore them though? Toll-free numbers are identifiable, so institutions have found a new way. According to the report, calls from different mobile phone numbers that seem to belong to companies or brands have risen from 29% in February 2023 to 36% now. And look at the change in trend. Real estate selling has risen from 18% last year to 22% now. However, job offerings have decreased from 10% to 4%, and in the case of those selling financial services, the calls have slipped from 60% to 54%. So the bigger question is, will the nuisance of pesky calls end anytime soon? There should be a system where pesky callers are blacklisted at the Aadhaar level, so they have the risk of not getting a new SIM. Also, brands on whose behalf the contracted callers are calling also need to be held accountable by the Department of Consumer Affairs, so brands institute the right consumer outreach practices both with employees as well as third-party contractors. For more such updates, stay tuned to NDTV Profit.
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit.
Welcome back. You're watching The Reporter on NDTV Profit, and now let's take a look at another big story of the day. Congress leader Jaya Thakur has filed a plea in the Supreme Court against the appointment of the new Chief Election Commissioner and other election commissioners. My colleague Varun joins us once again with more on this. Varun, can you hear us?
Hi, thank you. So in the wake of Arun Goel, I can hear. So in the wake of Arun Goel leaving the post of election commissioner, a plea has been moved in the Supreme Court seeking a direction to set aside the provisions pertaining to the appointment of the chief election commissioner and other election commissioners. Now, the plea alleges that since the 2024 general elections are just around the corner, a new election commissioner will have to be appointed shortly. And in this backdrop, the court has been asked to issue a direction to the effect that the election commissioners should be appointed in tune with the top court's ruling. It must be noted that earlier this year, a bench of the top court led by Justice Sanjeev Khanna had declined to stay the application of this new law. However, the court had agreed to consider the law's application. Now, as per this law, the Chief Election Commissioner and other election commissioners will be appointed by a panel consisting of the Prime Minister, the Leader of the Opposition, and a Union Cabinet Minister, which will be appointed by the Prime Minister itself. However, a judgment of the top court, which came out in March last year, had said that the panel should consist of the Prime Minister, the Leader of the Opposition, and the Chief Justice of India. Since both the top court's ruling and the centre's law are against each other, therefore this plea was moved earlier this year. Now, it must be noted that 2 election commissioners are likely to be appointed by March 15. PTI has put out a report citing sources, and therefore this plea requires an urgent hearing, and that's why Congress leader Jaya Thakur moved this plea in the court today, and it remains to be seen when it will be listed before the top court.
Right, Varun, thanks so much for bringing us those details. Now, moving on, the Delhi High Court Judge, Justice Pratibha Singh's book on patent law was also launched by the Finance Minister Nirmala Sitharaman on Saturday. Our team NDTV spoke to Pratibha Singh and asked her how the patent law affects the common public. Let's take a quick look on what she had to say on this.
Patent law will have a big effect on the common man because everything that we use on a daily basis is covered by patents, whether it is phones, whether it is medicines, whether it is technology, computers, everything is covered by patents. We don't realize it, but it is all governed by patent law, and therefore every common man is affected by these gadgets and by medicines and by mechanical inventions, and therefore I feel that there is a big need to understand patent law.
Ma'am, you are also sitting judge. You have to do many judicial works.
Yes.
So how difficult it was for you to write a book? So means volume, so big volumes, many pages, thousands of pages. How you manage it?
It was very difficult. I started when I was a lawyer in 2015. I signed the agreement. Till 2017, I wrote a few chapters. But after that, I could not write for 3-4 years. It is only in the COVID-19 lockdowns that I was able to write.
Well, now we have some good news for Mumbaikars. Maharashtra Chief Minister Eknath Shinde has inaugurated the first phase of the coastal road between Worli and Marine Drive in South Mumbai. A 10.5-kilometer long stretch is now open for traffic in the first phase for the time being, but only cars and buses will be allowed on the coastal road, at least for the time being. Now, all other vehicles, including two-wheelers and three-wheelers, are barred for now. And as of now, no tolls have also been imposed. That's the visual on your screen from the coastal road inauguration during the day. That's all that we have for you on The Reporter, but please stay tuned to NDTV Profit for more news and updates.
The farmers' protests have been making headlines. Indian farmers have demands such as legal guarantee on MSP, pension and debt waiver, no hike in electricity tariff, reinstatement of Land Acquisition Act 2013 and more. But while the protest becomes important from the point of view of elections and politics, it's not just India that has its farmers agitated. The streets of Spain, Belgium, Hungary and Poland have been roaring with protests by farmers too. Around 1,400 tractors took part in a protest in Poland and roads were blocked across the country. What do they have a problem with? Rising production costs, falling sale price, stringent regulations. They say that the European Union is not doing enough to stop cheap imports from Ukraine, which is affecting the demand for local produce. They are also not happy with the European Union's Green Deal that's designed to zero out pollution by 2050 because it limits the use of pesticides, which in turn affects yield. In Greece, farmers have demanded lower electricity prices, tax-free diesel and subsidized animal feed. In France, farmers have been fighting for improved pay and protection from foreign competition. The French government offered 400 million euros, that's $436 million, in various measures in reciprocation to their problems over low earnings, heavy regulation, and unfair competition from abroad. In Germany, farmers are against the government's decision to phase out tax concessions on agricultural diesel. Their argument is that this will lead them to bankruptcy. In Romania, the protests stem from anger about low prices for produce, rising costs, imports of cheap foodstuffs, and constraints imposed by the European Union's drive to fight climate change. In the United Kingdom, farmers are struggling to keep up with weather changes and war-related supply chain disruptions. The whole of Europe seems to have the agricultural sector in pain as climate change becomes a central focus and production prices increase. And no, it doesn't end there. As per Down to Earth, since 2023, farmers have protested in 67% of countries in South America region for a variety of reasons, such as wanting better export exchange rates and reduced taxes amid an extended economic downturn and Argentina's devastating drought, which have severely damaged crops and agricultural output. And look at this data. Farmers' protests have happened in 12 countries in Africa, 11 countries in Asia, 24 countries in Europe, 8 countries in North and Central America, and 2 countries in Oceania in just a year's time. So let's boil down all this worry to 5 main reasons, India included. Pricing of produce, delayed compensation or subsidy, unfair effects of climate change, policies and regulations, import and export duties, and supply chain discrepancies. What does it say about the world of agriculture? Does it just question politics and governance, or does it hint at a bigger problem, a potential global food crisis?
Different people believe in different things. In cricket, some hail the king, some believe in God. Some wait for Mr. Right, some believe in swiping right. Some run away from risk, others run after it. For some, kids mean babies. For others, kids mean puppies. Some want a home to settle in the future. Some want to roam the world today. Some make a career in a company. Some make a career out of building companies. But when it comes to money, everybody believes in only one thing: profit, profit, profit. And for profit, watch only NDTV Profit. We all love money.
Headlines you start your day with. What matters worldwide is now in the palm of your hands.